High probability trading strategies. Entry to exit tactics for the Forex, futures, and stock markets. Preface. High probability trading strategies is one of the few trading books from which you can learn a complete trade management plan from entry to exit. If you are a new trader or one who has not yet found consistent success in the business of trading futures, stocks, or Forex, you will learn specific trade strategies from how to identify high probability trade conditions to the specific entry and stop price through exit strategies that are designed to maximize the gain from any trend. If you are an experienced and successful trader, I know that you will recognize several key strategies to incorporate into your existing trade plan that should immediately increase your success. I've been teaching these strategies for over 20 years to traders around the world. I've refined and simplified the strategies over the years to get to the core of the most important information a trader needs to make a trading decision and manage the trade. The combination of book and CD will provide more information in a better learning environment than I can offer in an expensive weekend workshop. You will learn my unique approach to the 4 main factors of technical analysis, including multiple time frame momentum setups and the 1 main guideline to recognize the pattern structure of trends and corrections. Plus, you will learn my dynamic price and time strategies to identify in advance the probable price and time targets for trends and corrections. You will learn 2 powerful and logical objective entry techniques and how to manage a trade for short and intermediate term gains through the trade exit in any market and any time frame. I've also devoted an entire chapter called Real Traders, Real Time, Chapter 8, with trade examples submitted by my past students who show how they apply every day the strategies you learn in this book to markets from around the world. The video CD takes the learning experience to a much higher level than any book is able to do on its own. In the video CD, you will see more examples of how to apply the high probability trading strategies for many markets and timeframes in bar-by-bar and step-by-step recordings. Be sure to read the book first, cover to cover, before watching the video CD. The CD material assumes you have learned the techniques and strategies taught in the book. I'm sure high probability trading strategies and the accompanying video CD will become one of your most important trading reference materials. It may even become the complete trading plan you have been looking for to manage trades from entry to exit for any market and any time frame. Part 1. Chapter 1. High probability trading strategies for any market and any time frame. This book is unique. Unlike most trading books, it will teach you a complete trading plan from entry to exit. Not a few well-chosen examples of isolated trade setups and strategies, but exactly how to recognize optimal trade conditions, objective entry strategies with the exact entry and exit price, and how to manage the trade with stop-loss adjustments to the trade exit. The majority of trading books focus on a few techniques and show a plethora of carefully chosen examples to support whatever is being taught. Some of the phrases often used are, "You could have bought around here or taken profit around here." Depending on whether you are a conservative or aggressive trader, you could do this or that. Markets usually fluctuate around the volatility band, which is a good place to buy or sell. And lots more non-specific statements. Brokers don't take orders around this or that price level. They only take specific price orders. There is no such thing as a conservative or aggressive trader. There are only traders who either follow a trading plan or don't. To maybe do this or that around a volatility band or any other indicator or chart position is not a trade strategy. A trade strategy is a specific action to take, including the specific buy and sell price. In other words, worthwhile instruction will teach you exactly what to do and how and when to do it. While many trading books do teach some useful specific trading techniques, or at least provide some ideas to explore, it is very unusual for a book or any other type of trading course to teach exactly what to do, from how to recognize a trading opportunity to the exact entry and stop price, and how to manage the trade until it is closed out. That is what this book does. It will teach you a high probability trade plan with specific strategies from entry to exit. Most important, it will teach you how to think about the 4 key factors of momentum, pattern, price, and time. How to recognize what is useful and relevant market information that can be used to make a specific trade decision, and then how to execute the trade decisions from entry to exit. A book is a static medium. It takes a lot of screen captures of charts to illustrate a trade campaign from entry to exit, no matter what market or time frame is used. Thus, this book has a lot of charts. I've taken care that the information on each chart should be quickly and easily understood. Most charts include text comments pointing out the most relevant information based on what I teach you throughout the book. When John Wiley & Sons approached me regarding this book, I insisted I would do it only if it included an instructional CD where I could record additional examples, bar by bar, using trading software training mode. They agreed, and the addition of the CD trade examples makes this package a complete learning experience. Don't rush to watch the CD. The book provides all the background for what is shown in the CD. In the CD recordings, I assume you have read the book, cover to cover. I assume you are familiar with all the terminology, trade strategies, and book examples. You will be lost watching the CD if you haven't first read the book. The CD is not a review or regurgitation of the material in the book. Rather, it provides the medium to be able to show more examples, but in a bar-by-bar recording, so you can better see how the strategies taught in the book are put into practice day by day and bar by bar for many different markets and many different time frames. I believe this book and CD combination provides a better learning experience than even most live workshops, because you can study all the material at your own pace and replay the recorded CD examples over and over. Any market, any time frame. The trade strategies you will learn in this book may be used for any actively traded market and any time frame. Stocks, exchange-traded funds, ETFs, futures, and Forex examples are used. The same market structure is made day in and day out in all of these markets and in all time frames, from monthly to intraday data. If an example is not a market or time frame you typically trade, ignore the symbol and focus on what is to be learned. The strategy taught will apply to all markets and time frames. Conditions with a high probability outcome. The objective of any trade strategy is to identify conditions with a high probability outcome and acceptable capital exposure. You will learn the 4 main factors of any market position and how to identify if each is in a position for a high probability outcome. When a market is set up for change from 4 different perspectives, the trader has an enormous edge, much more so than if only 1 or 2 of the factors are in the same position. To win in the business of trading, just as in any other business, you must have an edge. The edge you learn in this book is to recognize when a market is in a position to complete a correction or a trend, so you can enter a trade at the end of a correction in the direction of the trend or in the very early stages of the new trend, and sell in the very late stages, often within 1 or 2 bars of the low or high. Just as a farmer must know the optimal time to plant and harvest a crop, the trader must know the optimal time to buy and sell a position. Buying or selling too early or too late can result in, at worst, unacceptable losses, or at best, not maximizing the return from a position. The trader must clearly understand the relevant information about the market position to recognize the optimal conditions to buy or sell. Markets can seem very complex. The plethora of relatively inexpensive trading software available with hundreds of studies and indicators can overwhelm a trader with often conflicting information, making it difficult to focus on the relevant information needed to make a confident trade decision. The high probability approach taught in this book recognizes 4 market perspectives: multiple time frame momentum, simple pattern recognition, price reversal targets, and time reversal targets. The information from any one of these 4 perspectives could be overwhelming. But in this book, you will learn how to focus on just those few bits of relevant information from each perspective that should quickly identify both the market position and whether a market is in a high probability position for a trade. I rarely do live workshops, but when I do, I present a special exercise at the end of the session. I tell the students that I can apply what I have taught them to any symbol, including stocks, ETFs, futures, or Forex, and it will take 3 minutes or less to process all of the information needed to identify whether the symbol is in a high probability position for a trade setup or what that particular market must do to become a high probability trade setup. I have the students write any symbol on a piece of notepaper. We collect them in a hat, and I draw them out one by one. In less than 3 minutes, I apply everything I have taught them and arrive at a conclusion. What is the probable market position of the symbol and the specific trade strategies? You, too, will be able to do this after you have studied this book and viewed the CD examples. If a trader focuses on just the limited relevant information needed to make a high probability trade decision, the chance of success is great. Leading and lagging indicators. The vast majority of traders use only lagging indicators for their trade strategies. Every indicator or oscillator in every trading platform and charting program is a lagging indicator. A lagging indicator will show you how the current market position relates to past data for the look-back period, but has little predictive capability. A momentum indicator can be useful to help identify trend direction and trade execution if used with the unique multiple time frame momentum strategy you will learn in this book. But the momentum strategy is still only useful when it is part of a trading plan that includes leading indicators. A leading indicator will prepare you in advance for probable trade conditions. Using my unique approach to dynamic time and price strategies, developed over the past 20 years, you will learn how to identify in advance the probable price and time target zones, not just for support and resistance, but more importantly, for trend reversal. We call these price and time strategies leading indicators because they identify in advance conditions with a high probability outcome. If a market fulfills those conditions, a trade setup is made. I know they will become a very important part of your trading plan when you learn the power of being prepared in advance for specific price and time targets for trend reversal. What you will learn in this book and video CD. In this book, you will first learn the 4 dimensions of market position: multiple time frame momentum, pattern, price, and time. Each factor provides an important piece of information you will use to make a trading decision. A trading plan that does not include these 4 market dimensions is missing a big piece of the market puzzle and is much less effective than one that includes all 4 dimensions. Most readers are familiar with momentum studies, also called indicators or oscillators. A momentum indicator by itself is not of much practical use to the trader. All momentum studies are lagging indicators. They are great for showing you the current market position relative to the past, but are not of much help in pointing to the probable trend position in the future, unless you use them in the unique way you will learn in Chapter 2. Chapter 2 presents a momentum strategy used by few traders that will teach you how to use lagging momentum indicators as a powerful technique, as a filter for trade direction and execution setups. This multiple time frame momentum strategy will become the most useful and practical momentum application you can add to your trading plan. Elliott wave pattern analysis has been so overcomplicated and misinterpreted over the years that many traders avoid it like the plague. I don't blame them. In Chapter 3, you will learn simple guidelines based on Elliott wave structures to identify 3 frequent patterns for all markets and all time frames. One simple guideline will instantly reveal if a market should be in a trend or counter trend. This single guideline alone can make a noticeable difference in your trading results. It is critical for the trader to recognize whether the current market condition is part of a correction or a trend, and more importantly, whether that correction or trend is nearing completion. This information can become a powerful part of your trading plan and help you prepare for market reversals across any time frame. After you have learned the pattern guidelines in Chapter 3, you will be able to quickly recognize the probable structure position of any market and any time frame. Most traders are familiar with Fibonacci, fib, price retracements. Like a single time frame momentum study, they are not of much practical use by themselves to make a trade decision. Chapter 4 teaches you how to identify in advance which retracement level is likely to complete a correction of any time frame. It also teaches you how to project the probable trend targets in advance to be prepared for the price level at which a trend should be complete. You will also learn some new ratios that are not a part of the Fib ratio series that are a key to correction and trend price targets. Once you learn my dynamic price strategies in Chapter 4, you should be prepared not just for temporary support and resistance levels, but for the specific price levels for trend and counter-trend reversals. Market timing in its true sense, identifying specific time target zones for trend change in any time frame, is rarely used by most traders. W.D. Gann taught many years ago, when time is up, change is inevitable. Chapter 5 teaches you my unique dynamic time strategies I've developed over the past 20 years, which will allow you to project the probable minimum and maximum time targets for trend reversal. You will also learn how to project time bands in any time frame to target a relatively narrow time range with a high probability for trend change. Practical market timing should be an important part of every trader's plan. After you have learned these 4 key factors of market position that will prepare you to recognize optimal trade conditions, Chapter 6 teaches you 2 completely objective entry strategies and how to quickly determine the maximum position size for any trade. The strategies you learn in Chapter 6 will completely eliminate any guesswork on what price you should enter a market and what should be the stop-loss price. Most important, you will learn what all successful traders know. The proper position size for any trade setup on any time frame is one of the most important keys to long-term success in the business of trading. Earlier, I promised that you would learn how to manage a trade from entry to exit. Chapter 7 is the heart of this book, as far as I'm concerned. This is where you learn to apply all of the practical strategies, from recognizing high probability trade setups to the specific entry strategy, stop loss adjustment, and exit strategy. In other words, Chapter 7 teaches you how to manage a trade from entry to exit. You will learn how to make confident and logical decisions throughout the trade process. Chapter 8 gives trade examples from students of my live and online workshops, educational CD programs, and other educational trading material I've produced over the past 20 years. These examples by other real-world traders show you how what you learn in this book has been put into practice every day, in many different markets and many different time frames. Chapter 9 offers more insight into the business of trading, what it takes to be successful, and a whole lot more. A lot of misleading information, and sometimes just plain misinformation, has been published about the business of trading. You'll find in this chapter that I don't pull any punches. If you thought I was a bit opinionated as you read through the earlier chapters, wait until you get to Chapter 9. I want you to be successful, and Chapter 9 will help keep you on track on the road to a successful trading business. The video CD included with this book is an important part of the learning experience. Again, do not play the CD until you have read the book cover to cover. It will be a valuable resource, but you will only get the full benefit if you have first familiarized yourself with all the background material in the book. Let's get started. It's time to get started and learn high probability trading strategies, from entry to exit for the futures, Forex, and stock markets. We begin with a unique approach to momentum strategies, the multiple time frame momentum strategy in Chapter 2. Chapter 2, Multiple Time Frame Momentum Strategy, an objective filter to identify high probability trade setups. The multiple time frame MTF momentum strategy is the most powerful approach I've discovered in over 20 years to filter any market and any time frame for trade direction and execution. The MTF momentum strategy is a key factor to the trade plan that identifies high probability trade setups with minimal capital exposure. Just about every trading book or course will emphasize that you always want to trade with the trend. It's great advice. If you are always trading with the trend, you should mount up some very impressive gains. 2 big questions are usually not clearly answered. How do you objectively identify trend direction? And is the trend in the early or late stages? In almost every trading book and course I've seen over the past 20 or more years, the trading educators show many after-the-fact examples of how their trend indicator identified the trend direction long after the trend was established. It is easy to show a trend on any chart long after the trend is established. But how do we identify trend direction in the early stages? How do we identify when an established trend is in the later stages and in a position to make a trend reversal? Without some approach to help identify where within the trend the market likely is, typical trend analysis will usually be too early or too late to be useful over time. It is easy to fill a book with after-the-fact examples of trends. Trend lines, moving averages, channels, momentum indicators, and many other techniques can show the trend on historic data. Unfortunately, none of these techniques can reliably alert you to the beginning stages of a new trend or whether a trend is in its final stages. They can only identify an established trend, usually long after the trend is established and the optimum entry is long over. I know we could say that a trend line break indicates a trend is complete and a reversal has been made. For every trend line break that follows a trend reversal, I can show you a trend line break fake out that is followed by a continuation of the prior trend. Moving average crossovers are notorious for false trend reversal signals. In fact, most methods of identifying a price trend are doomed to failure for practical trade strategies, with as many false reversal signals as confirmed ones. This is a bold statement, but I believe it is true. It's time to stop the madness and deal with the reality of trend position. I defy any trading educator to provide evidence that his so-called trend indicator consistently provides an accurate signal of trend position and trend reversal in a timely manner that a trader can take advantage of. How can I make this statement? Let's think logically. What does a trend line, channel lines, moving average, or other indicator represent? Every moving average, channel, or indicator is based on historic price data. It can only represent what has happened or what is the current market position relative to the look-back period. It has little predictive value in and of itself. It will always be a lagging indicator of the trend position, never a leading indicator of what is likely to happen in the future. Why are some of these techniques promoted over and over again as trend indicators with value for making practical trade decisions? Because it is easy to find lots of chart examples that seem to illustrate how valuable the indicator is. However, let me make you this promise and this challenge. Name a trend indicator, and for any market or any time frame where you are given an example of how it defines the trend, I will show you 2 examples where it quickly failed. Every one of these techniques, whether a trend line, volatility channel, moving average crossover, or momentum indicator, can be a useful part of a comprehensive trading plan, but none of them alone will be of much use in identifying the probable trend direction for a future period. Over and over again, you will find that price reversals do not coincide with indicator reversals. For every well-chosen example given, there will be multiple cases where the indicator failed to identify a reversal in time. However, there is a way to use some of these indicators to identify high-probability trade setups. In this chapter, you will learn how to use just about any momentum indicator as a trend indicator for trade direction in a unique but very logical way that you have probably not been taught before. We are not concerned with identifying the exact price swing high or low of a trend. Rather, we are concerned with identifying trades in the direction of the trend, including near the early stages and avoiding the later stages. The multiple time frame momentum strategy that you are about to learn is the most powerful strategy to filter any market for trade direction and execution setups. Not only do I believe it is the best use of an indicator for trading strategies, I believe it is the only practical indicator strategy for real-world trading. The multiple time frame momentum strategy is not a standalone trade system, although it is probably much better than most systems sold for thousands of dollars. But when it is combined with time, price, and pattern strategies, you will have a powerful trade plan. This plan will identify high probability trade setups with minimal capital exposure and also warn you when a trend is near the end and a major reversal is likely. I use the term capital exposure to describe what many educators call risk. Risk is the probability of an event happening. Capital exposure is the amount of money that may be lost if the market moves against you. I will discuss this in more detail later in the book. Let's begin with the concepts of trend and momentum before we look at charts or specific rules. What is momentum? In trading, there are hundreds of momentum indicators, also called oscillators. Most of these indicators use the same information, the open, high, low, and close of a price bar, and represent essentially the same concept, the rate of change of price. There is nothing mysterious about this. All indicators look back over a defined period, called the look-back period, process the data, and compare the recent price position with the earlier price position. Different indicators display this differently, but they all represent how fast price is moving. Indicator reversals represent changes in momentum, the increase or decrease in the rate of change of price. That is why almost any price-based indicator can be used for the multiple timeframe momentum strategy. The first and most important concept is this: momentum indicators do not represent price trends. They represent momentum trends. This sounds obvious, but many traders expect price to reverse every time a momentum indicator reverses. It doesn't work that way because the indicator does not represent price. If it did, trading would be extremely easy. We would simply reverse positions every time the indicator reverses and make money continuously. In reality, price and momentum do not always move together. A momentum indicator may turn bearish while price continues to rise. This happens because the rate of price movement is slowing down, even though price is still advancing. The trend is still bullish, but momentum is weakening, so price and momentum can move in opposite directions. Let me repeat this clearly. Momentum indicators represent momentum trends, not price trends. Never expect price to reverse just because the indicator reverses. Sometimes price and momentum reverse together, but often they diverge because the trend is slowing, not reversing. Most traders don't fully understand this point. So remember this: momentum indicators track the strength of a move, not the direction of price itself. Price and momentum will not always move in the same direction, and not every momentum reversal leads to a price reversal. You can only make money on price trends, at least until someone comes up with a momentum contract to trade. Even though momentum and price trends often do not move in the same direction, you will soon learn how we can use momentum trends in a simple and practical way as the primary indicator of trade direction and trade execution setups. You will also learn how, by incorporating dual timeframe momentum trends in a comprehensive trading plan that also includes the time, price, and pattern position of a market, you can identify whether the market is at or very near a price trend reversal. Multiple timeframe momentum strategies. In over 20 years of trading and educating traders, beginning in the mid-1980s, multiple timeframe momentum strategies have become the most powerful trade direction and execution approach I've added to my trading plan and taught my students. For at least the first 10 years I traded, I never used an indicator. I was basically a pure chartist, using time, price, and pattern position to identify trade setups and targets. My strategy was based on Gann, Elliott, and Fibonacci. In 1989, I released what I believe was the first futures trading home study course, called the W.D. Gann Home Study Trading Course, based on Gann, Elliott, and Fibonacci trade strategies. This course is no longer available. It wasn't until the late 1980s that I even had a computer with a charting program. I studied a lot about indicators and discovered I could always find an indicator, or adjust its look-back period or settings to confirm whatever price trend bias I already had. There was never an indicator on my charts, simply because everything I read and tested on indicator strategies didn't seem to work out, and I could not find a logical and practical application for them. Around the mid-1990s, at the prompting of one of my students, I began to explore how a momentum indicator could help confirm pattern and price position. It took a couple of years to develop practical strategies for using momentum as part of a real-world trading plan. Then, several years later, I began working with momentum strategies across multiple timeframes, and the results were striking. These strategies proved extremely valuable for identifying trade direction, executing trades, and confirming potential price reversals at key price or time targets. Like everything taught in this book, these strategies apply to any market and any time frame, from day trading to position trading. The basic dual time frame momentum strategy. I first teach the concept and application of a momentum strategy using 2 timeframes. Later, I will show how to use more than 2, but 2 are all you need. You will learn how to integrate this strategy into your overall trade plan. Let's get down to the basic strategy for the dual time frame momentum reversal strategy. It is simple and logical, and you may wonder why you haven't been using it since your first trade. Strategy: dual time frame momentum trade in the direction of the larger time frame momentum. Execute the trade following the smaller time frame momentum reversals. It is that simple. The choice of time frames depends on your trading style. Position traders may use weekly and daily charts. Swing traders may use daily and hourly charts. Day traders may use 60-minute and 15-minute charts, or even smaller time frames. Let's break this down into its components. And it's just a larger time frame momentum trend identifies trade direction. We know that momentum does not always move in the same direction as price. However, a well-configured indicator with an appropriate look-back period will usually align with price and reverse within a few bars of a price reversal. When price and momentum diverge, for example, when price is trending upward but momentum turns bearish, the larger time frame momentum can help keep you out of trades when the trend is weakening. The strategies you will learn later will help avoid trades during such divergence, reducing losses. And losses are inevitable, so minimizing them is essential. Dual time frame DTF momentum rule 1. Only trade in the direction of the larger time frame momentum trend unless the momentum position is overbought or oversold. The larger time frame momentum defines direction. It does not trigger a trade. It simply tells you whether to look for long or short opportunities. The actual setup comes from the smaller time frame. Execute the trade following smaller time frame momentum reversals. The core of this strategy is using at least two time frames, one to define direction and one to define execution. We only want to take trades when both timeframes align in the same direction. This significantly increases the probability of success. If a trader relies on only one time frame, they are at a disadvantage. Momentum may trend steadily without reversing, while price undergoes corrections, sometimes significant ones, without triggering a momentum reversal. Or the trend may slow down without a reversal signal. Wouldn't it be better to identify when a correction is likely ending or when momentum is about to increase? That is exactly what this strategy helps you do. DTF Momentum Rule 2. A trade execution may be made following a smaller time frame momentum reversal in the direction of the larger time frame momentum trend. The setup is complete when the smaller time frame momentum reverses in the same direction as the larger time frame trend. This alignment offers the best opportunity for strong price movement with controlled capital exposure. Momentum reversals. A momentum reversal occurs when the indicator shifts from bullish to bearish, or from bearish to bullish. For indicators with two lines, such as stochastic or RSI, a reversal occurs when the fast line crosses above or below the slow line. The fast line represents raw data, while the slow line is typically a moving average of that data. When these lines cross, it signals a likely change in momentum. This is similar to a moving average crossover, except it is based on indicator values rather than price itself. Some indicators also use overbought, OB, and oversold, OS, zones. In these cases, a reversal may be indicated when the indicator moves out of these zones. Other indicators behave differently. For example, with MACD, changes in bar height or signal line crossovers indicate changes in momentum speed. Each indicator has its own signals, but all reflect the same underlying concept. The price trend may be reversing, slowing down, or accelerating. Later, we will look at chart examples. But for now, focus on understanding the concepts. Understanding these principles first is essential. It allows you to apply the strategy effectively across any market, any time frame, and under any market condition. A smaller time frame momentum reversal into the direction of the larger time frame momentum is the dual time frame momentum setup for a trade. It is a precondition that must be met before a trade is even considered. A dual time frame momentum strategy will be the best filter you have to identify optimum trades. It can be a standalone trade strategy, but we use it as part of a trading plan that also considers the price, pattern, and time position for high probability trade setups with acceptable capital exposure. Trade in the direction of the larger time frame momentum. Execute following a smaller time frame momentum reversal. These are the setup conditions that must be met before a trade is considered. Okay, it's time to look at some charts and illustrate what you've learned so far. So at any time, you can bring up a chart of any market and any time frame and almost instantly identify if the market is in a high probability position to consider a trade. Most price indicators represent rate of change. Figure 2.1 shows 3 different indicators with the bar chart plus a simple rate of change, ROC. The 3 indicators are a stochastic stock, relative strength index, RSI, and DT oscillator, DT-OSC, which is a combination of RSI and stock. All 4 studies have an 8-period look back. The momentum trends are about the same in all 3 indicators. While it is a little difficult to see this in the black and white screenshots, the momentum reversals for each indicator, where the fast line crosses the slow line, are all within a bar or 2 of each other. What's the point of this comparison? Most price-based indicators represent about the same thing, that momentum cycles act and react about the same time. The settings for any indicator, including the look-back period, can be tweaked for different markets and timeframes for the most reliable signals. But as you can see from figure 2.1, even without tweaking the settings, each indicator still represents the momentum cycles about equally well. Later in this chapter, you will learn how to choose the best settings for any indicator for any market and timeframe. Figure 2.2 is another screenshot with just 2 indicators, stock and DTOSC, with less data so you can see the momentum cycles more clearly. I've drawn thick vertical lines in the indicator window at each bullish and bearish momentum reversal, where the fast line crosses the slow line. The momentum reversals in both indicators were made plus or minus 1 bar of each other. Either the stock or DTOSC would be equally helpful to identify momentum reversals for this data. Don't let anyone sell you on some magical, mystical indicator for momentum trading. All momentum indicators represent the same momentum cycles, and most make reversals about the same time. The black box system scammers will claim they have a secret, foolproof indicator, but more than likely, it is one you already have in your charting program. There are only so many ways to process the open high-low close of price bars. Most variations arrive at similar results and can be equally useful. Momentum and price trends often diverge. Remember how I said earlier that price and momentum do not always trend together? If they did, this book would be almost complete. However, they don't. When a price trend slows down but doesn't reverse, the momentum trend will often make a reversal and move in the opposite direction to price. Let's take a look at an example. Figure 2.3 is 60-minute ES0607 data. I've marked off a price momentum divergence with arrow lines. Near the high point of this data, the price trend continued to a new high, but the momentum trend made a bearish reversal and declined while price continued higher. How can this happen? The rate of price advance slowed down, even though price continued higher. Most price-based momentum indicators represent the speed of the trend, and the speed slowed down here, so momentum turned bearish even while price made a new high. Let's look at one more example. Figure 2.4 is a 60-minute EUR-USD Forex chart. I've drawn arrow lines to show a period where price and momentum diverged. Price continued higher while momentum declined. Why? Again, the rate of advance slowed down even though price kept rising, causing momentum to turn bearish for a period. Every indicator will diverge from price at times. This is why I challenge anyone who relies on a single indicator to prove a consistently profitable system across markets. Many so-called systems optimize settings based on past data and claim impressive results, but they fail in real conditions. I've also seen entire trading plans built around price momentum divergence, supported by carefully selected examples. However, for every example that worked, there are usually many that didn't, and those are often ignored. It's common to see articles where the author highlights a successful setup while overlooking identical setups on the same chart that would have resulted in losses. But let's stay focused on what matters: how to use dual timeframe momentum strategies effectively for trade setups. How dual timeframe momentum strategies work. The concept for dual timeframe momentum strategy trade setups is simple, practical, and logical. Trade in the direction of the larger timeframe momentum. Execute the trade following the smaller time frame momentum reversals in the direction of the larger time frame momentum. Let's take a look at a couple of charts and see how valuable this strategy will be. We'll use the SPX daily data for the higher time frame momentum and 60-minute data for the lower time frame momentum reversals for this example, but it works the same for any market and any two time frames. Figure 2.5 includes about 3 months of daily SPX data with the DTOSC momentum indicator. The dates of each momentum reversal are shown during this period. The dates across the top are bearish momentum reversals, and the dates along the bottom are bullish momentum reversals. Most of the momentum reversals were made within a couple bars of the actual price, high or low. Okay, I did cherry pick this example somewhat so that I can clearly show the momentum reversals, but I want to be sure you get the idea. No matter what indicator or settings you use, all momentum reversals will not always be made this close to the actual price reversals, although most of the time they will. We'll have plenty of time to show you examples in the book and CD that are not so perfect, but first, let's get the concept clearly down. Figure 2.6 is the SPX 60-minute data for one of the periods shown on the previous chart when the daily momentum was bullish. The dual time frame momentum strategy is to trade in the direction of the higher time frame momentum, daily in this case, and execute following a momentum reversal on the smaller time frame, 60-minute in this case. On the 60-minute 60 EBIT chart, I've marked off a period when the daily momentum was bullish from February 10th to February 23 and drawn an arrow line between the closes of those two dates through the price bars. Before and after this arrowed line, the daily momentum was bearish, so we would not consider the smaller time frame bullish reversals as trade setups. I've also drawn a vertical arrow line from each 60-meter momentum bullish reversal pointing up to the bar when the reversal was made. The momentum bullish reversal is when the fast line crosses above the slow line. Any one of these smaller time frame 60-minute momentum bullish reversals could be a setup for a long trade. Some were followed by sharp advances, some only modest advances. All were immediately followed by some advance. It only makes sense that advances should follow. If the larger time frame daily momentum is bullish, a smaller time frame 60-minute momentum bullish reversal puts two time frames of momentum in the same direction, which is a high probability setup for a continued advance. Ponder this chart for a minute and consider when you think the most optimal times would be to take dual time frame momentum strategy setup trades without considering any other rules, guidelines, or factors of your trading plan. How about soon after the higher time frame daily momentum makes its bullish reversal, like the first couple of smaller time frame bullish reversals? I know this is only one example so far of dual time frame momentum strategy trade setups, but think of the logic of making it a part of your trading plan to focus on setups soon after the higher time frame momentum reverses. We'll consider this more later in the chapter. Let's take a look at another example using 60 meters data for the higher time frame and 15 meters data for the lower time frame. Figure 2.7 shows the EUR/USD Forex 15-meter data for about at a 24-hour period. The upward sloping arrow through the bar data is a period when the higher time frame 60-meter momentum was bullish. The vertical arrows show the four lower time frame 15-meter momentum bullish reversals during the time when the higher time frame 60M momentum was bullish. I've labeled them 1 through 4. The first 15-meter momentum bullish reversal was followed by the EUR/USD continuing lower for a few bars. Would a long trade have been entered? We haven't talked about entry strategies yet, so we will pass on this question for now. Remember, the smaller time frame momentum reversal in the direction of the larger time frame momentum is only the condition that must be met to consider a trade. It is not a trade execution strategy. The second and third 15-meter momentum bullish reversals were followed by strong advances. The fourth reversal was followed by several sideways to down bars before the higher time frame 60 meters momentum made a bearish reversal where the arrowed line along the bars ends. Regardless of the specific trade execution strategy used, based only on the dual time frame momentum strategy setups, there were 2 setups for clear-cut winners and 2 no trades or small losses. The next example is bond weekly and daily data, which may be used to position trade bond futures or a bond exchange traded fund, ETF. Figure 2.8 shows the higher time frame bond weekly data. I've labeled the 5 weekly momentum trends for this 18-month period. I chose this period because it includes a fairly prolonged cycle of price momentum divergence when the weekly momentum was bearish, while bond prices continued sideways to up. The 5 momentum trends during this period are labeled 1 through 5 in the indicator window below the bar chart. Period 1 is a bullish momentum trend that began in May and ended in August. For the next several months, the momentum trend was bearish, period 2, although bonds eventually went higher, but ended the period with little net advance. How can there be a price bull trend with a momentum bear trend? You know the answer to this. The rate of advance slowed down compared to what it had been. The bond market became choppy with short swings up and down. This decreased rate of change and choppy market would force any price momentum indicator to become bearish. It would be nice if we knew in advance when a market was going to go into a trading range or slow down a trend, but we can never know this in advance. We are always trading on the right-hand side of the chart after the last bar, which is the unknown side of the chart. We can only use the information available as of the last price bar to make a decision. I've actually read articles and chapters in books about how to trade a trading range. You can never know in advance if a market is going to begin a trading range. Never. If any trading instructor tries to teach you special strategies for trading ranges, run, don't walk. The strategies will all have worked great after the fact, but you will never know in advance when to use the so-called trading range strategies because you can never know in advance if a market is going to begin a trading range. During periods 3, 4, and 5, the weekly momentum and price trended together. Let's take a look at the smaller timeframe daily momentum trends and reversals for each of the 5 weekly momentum trends shown on this weekly chart. First daily bond chart, figure 2.9, is for weekly period 1, when the weekly momentum was bullish from May through August. Bonds made 2 daily momentum bullish reversals below the overbought zone during this period. The overbought line is the 75% horizontal line near the top of the indicator window. One of the daily bullish reversals was made in the OB zone between the points I have labeled 1 and 2. The momentum bullish reversal made in the OB zone is not numbered. You will learn later why we ignore momentum bullish reversals in the overbought and momentum bearish reversals in the oversold zones. Since the higher time frame weekly momentum is bullish for this period, only daily momentum bullish reversals would be potential long trade setups. The weekly momentum turned bullish the week ending May 21st. The first daily momentum bullish reversal on June 10th was made almost 3 weeks after the weekly momentum bullish reversal. For this 3-week period, bonds continued the bear trend. If a trader only looked at one time frame, in this case, the weekly momentum, a bullish momentum setup would have been made, although the bond market continued to decline. Waiting for the smaller time frame daily momentum bullish reversal before considering a long trade kept you out of a long trade immediately following the weekly momentum bullish reversal, when price continued to decline, but made a great setup June 10th following the daily momentum bullish reversal. This is an excellent example of why you must always consider at least 2 timeframes of momentum position before even considering a trade. Both smaller timeframe daily momentum reversals were followed by a strong advance. There was one additional bullish momentum reversal between points 1 and 2. Why is it not considered a setup? It was made in the OB zone. A smaller timeframe momentum bullish reversal must be made below the OB zone to be a valid setup. If the momentum bullish reversal is in the OB zone, the upside should be very limited, and you will want to avoid a long trade. The next daily bond chart, figure 2.10, is for weekly period 2. That was the period when the higher time frame weekly momentum was bearish, yet price was sideways to marginally up by the end of the period. If the higher time frame weekly momentum is bearish, only short trades would be considered following daily momentum bearish reversals. The first daily momentum bearish reversal, point 1 on the daily chart, was made on a wide range down day, which ended up being a swing low. Would this be a losing trade? I want to stress again, the dual time frame momentum strategy setups are not about trade execution. They meet the minimum conditions to consider entering a trade. Specific trade entry and stop strategies will be taught in a later chapter. For now, consider that a low of a daily bar was not taken out following the daily momentum bearish reversal. A hint of trade strategies you will soon learn. Regardless of the time frame you trade, a trade is not entered until a bar high or low is taken out following the smaller time frame momentum reversal. Daily bearish reversal 2 was made on the swing high bar followed by a sharp decline. Nice setup. Daily momentum reversals, numbers 2, 3, 4, and 5 were all made within a bar or two of a swing high, and followed by very tradable multi-day declines. Now, I don't want you to think at this point that every dual time frame momentum strategy setup will result in a profitable trade. Nothing could be further from the truth. A complete trading plan depends on more factors, including trade entry, stop loss, exit strategy, multiple units, acceptable capital exposure per trade, and more. All I want you to learn at this point, until it becomes second nature to you, is that a trade setup is made following a smaller time frame momentum reversal in the direction of the larger time frame momentum. This is a completely objective, logical, and practical strategy for high probability, low capital exposure trade setups for any market and any time frame. Trade setups are not trade executions. Trade setups are simply conditions that must be met before a trade is considered. During this bond weekly period, bonds were essentially in a trading range, making nice swings up as well as down. The daily momentum made bullish reversals within a bar or two of each price low. However, because the higher time frame weekly momentum was bearish during this period, only short setups would be considered. Wouldn't it have been nice to know in late August that bonds were going to make nice, clearly defined trading range swings for the next 4 months? We could make a ton of money with a trading range strategy. Wait a minute. We never know in advance when a trading range is going to begin or end, so we don't have a trading range strategy. Only academic authors with questionable trading experience have a trading range strategy, and we're not going to listen to their nonsense. The third weekly momentum trend was bullish from the week ending December 23rd through the week ending February 18th, figure 2.111. During this higher time frame weekly bullish momentum period, the smaller time frame daily momentum made 2 bullish reversals. Each was followed by a strong move up. Let's note a couple of important things at this point. First, I haven't changed the daily momentum settings for any of these examples to optimize the signals. You will learn how to choose the best settings for any indicator later in this chapter. Second, I also haven't talked about stop loss or exit strategies, both of which are crucial to a sound and consistently profitable trading plan. Those also come later in the book. Right now, I'm just focusing on identifying trade entry setups based on the dual time frame momentum position. Let's look at the next period, when the higher time frame weekly momentum reversed to bearish. Figure 2.112. During this period between the weeks ending February 18th and April 8th, the smaller time frame daily momentum made 2 bearish reversals. The first daily momentum bearish reversal during this period was made about 3 weeks after the weekly momentum turned bearish. The market immediately made a minor corrective rally after the short setup. Any short trade strategy would have been a small loss. The second daily momentum bearish reversal was made just 1 day after the swing low in March and would have also resulted in no trade or a loss, depending on the entry and initial protective stop strategy. Wouldn't this have been aggravating, considering bonds made a consistent decline of almost 5 points following the weekly bearish reversal and bearish momentum trend? No matter what your trade strategy, this can happen. This is another reason I used this period to illustrate the dual time frame momentum strategy setup. I could have picked a series of well-chosen examples that worked flawlessly every time, but I want you to learn the realities of trading. You never know what's going to happen on the right-hand side of the chart. That's the side without the bars. That's the side you have to make decisions for. If you don't stick to your trading plan, you are doomed to failure. Period. End of story. Probably the primary reasons such a high percentage of traders blow out and quit within months are no trading plan and no consistency. Now let's look at the fifth weekly momentum trend shown earlier on the weekly chart, the bullish momentum period from the week ending April 8th through the week ending June 17th. The daily chart, figure 2.13, shows 3 daily momentum bullish reversals during this period. The first daily momentum bullish reversal was not made until about 3 weeks after the weekly bullish momentum reversal. The daily momentum was overbought through most of this period, which is a typical momentum position in a strong trend. The first smaller time frame daily momentum bullish reversal, point 1, was made just before a price high, followed by a corrective decline that lasted several days. It would have been a no trade or small loss. The second daily momentum bullish reversal was followed by a consistent rally of several points. The third and last daily momentum bullish reversal for this weekly bullish momentum period was made just before bonds made a significant high, another no trade or small loss. I purposely chose this 18-month period for bonds and the weekly and daily data because it illustrates most conditions you will run into with dual timeframe momentum strategy setups. There were periods for strong winners, periods of price momentum divergence that still would have resulted in some gains, periods of marginal gain because the smaller timeframe reversals lagged the higher timeframe momentum reversals, and at least one period that would have probably resulted in a small net loss. I could have easily filled the chapter with unlimited examples of ideal setups that always resulted in massive profits, like so many other trading books and educational courses do. That is not the real world of trading. Yes, there can be some quick and significant gains, but there will always be periods when either the market does not set up for potential trades according to your trading plan, or, regardless of your trade plan, the setups will not follow through with successful trades. That is the reality of trading. Believe it, and you should be on the road to success. The purpose of all trade strategies is to identify conditions with a high probability outcome and acceptable capital exposure. The dual time frame momentum strategy is a completely objective approach to identify trade setups as just one part of a comprehensive trade plan. This approach is applicable to any actively traded market and any time frame, from position trading with monthly, weekly, and daily data to day trading with intraday data. The principles and application are the same regardless of the market or time frame. There are a couple of important questions about momentum studies and indicators that you should have come up with so far. Which indicator should you use? And what are the best settings or look-back periods to use? Let's address both of these now. Which indicators to use for multiple timeframe momentum strategies? I've made the point several times in this chapter that most price indicators represent about the same thing, rate of change, and will give you about the same results for our purposes. In the examples so far, I've mostly used the DTOSC, which is a proprietary indicator included with my Dynamic Trader software. Let's take a look at other indicators you can use and how to use them. The stochastic stock indicator is very popular and included in all trading software. The stock has overbought, OB, and oversold OS zones, plus a fast and slow line, both characteristics that are helpful for our purposes. Overbought and oversold are not really good descriptive terms for an indicator that reaches extreme levels, but since these terms are commonly used, we will use them as well. Just because an indicator reached the OB zone at the upper extreme of the indicator range does not necessarily mean that the market itself is ready to turn down. It only means the indicator is near the extreme level. It will take some history and looking at many momentum cycles for the indicator to determine if price is usually at or near a position to make a reversal when the indicator reaches the OB or OS levels. An indicator like the stock, which has a fast and slow line, is also helpful. The slow line of an indicator is usually just a moving average of the fast line. The slow line will react more slowly to momentum change. When the fast line crosses the slow line, we call it a momentum reversal. It warns that the rate of momentum is changing, which is often preceded or followed within a couple of bars by a directional price change. If the fast line crosses above the slow line, it is called a momentum bullish reversal. If the fast line crosses below the slow line, It is called a momentum bearish reversal. We'll talk more about indicator settings and look-back periods later. But for now, we just want to learn about how an indicator acts and reacts to price momentum changes and how we might use the OBOS zones and momentum reversals as a trade setup. Let's take a look at a couple of charts with a stock indicator. Figure 2.1 shows S&P daily data for about a 4-month period. This period had a series of well-defined swings up and down with a bullish bias. I've drawn thick horizontal lines at the 75% OB and 25% OS zones, upward pointing arrows for the momentum bullish reversals, and downward pointing arrows for the momentum bearish reversals. The stock did a very good job of making momentum reversals within a bar or two of each price reversal, which would make it a good momentum indicator for our purposes. The momentum reversals are not trade signals, but conditions that must be met in order to consider a trade. Do you notice anything interesting about the position of the indicator reversals and the OB and OS zones? For this series of S&P daily data, both lines of the stock reached well into the OB zone prior to a momentum bearish reversal. However, both lines did not typically reach the OS zone prior to the momentum bullish reversals. Why is that? The trend bias for this period was bullish. It is a characteristic of a stock indicator to hang in the OB zone if the trend is bullish and makes relatively shallow momentum corrections in the indicators, often not reaching the OS zone on price corrections. This is a characteristic that you should be aware of. The larger degree trend bias will affect how the stock indicator cycles. Let's take a look at more data. The next daily S&P chart, figure 2.15, was for a 4-month period with a strong bullish trend with only minor corrections. The chart has the same stock indicator with the same settings as the previous chart. Do you note any differences in how the stock cycled with the price cycles in this chart compared to the earlier one? The stock hung in the OB zone for much of the trend, only making momentum declines below the OB line on the larger corrections that lasted several bars. Frequent momentum oscillations were made in the OB zone without a decline to below the OB line. This is a similar stock momentum pattern to what we saw on the previous chart, which had much larger corrections during the bullish trend. Even that chart showed a stock bias to hang in the OB zone and make relatively shallow momentum corrections. The momentum pattern on this chart is just more pronounced because of the stronger bullish trend. So it looks like we need to make a set of momentum trading rules for the wide swinging periods with a modest bullish bias and a set of rules for a stronger bullish trend. That way, we can take full advantage of each market condition. At least, that is what some trading educators will teach you. Different rules for different market conditions. But as we are well aware, you never know what type of trend is developing on the right-hand side of the chart. We can never have a different set of momentum rules for bull or bear or trading range, or for volatile or stable markets, or any other unique market condition, because we never know what type of market lies ahead. If we choose an indicator and a particular set of settings, we have to stick to them until we have a very compelling reason to change. MACD Momentum Indicator. The Moving Average Convergence Divergence, MACD, momentum indicator is another very popular indicator found in all charting packages and familiar to most traders. The MACD measures the difference between two moving averages and is usually displayed in the indicator window as vertical bars in what is called a histogram. A shorter bar than a previous bar represents a narrowing range between the two moving averages and a loss of momentum. If a bar is made on the other side of the center line, signal line, it means the faster moving average has crossed above or below the slower moving average. Many traders base their momentum decisions on the MACD, and lots of systems and trade strategies have been developed around MACD signals and patterns. Does the MACD hold the momentum secret for traders? Let's take a look at it. Figure 2.16 shows the same S&P daily data we used to look at the stock indicator. The arrows show the momentum bullish and bearish reversals. A momentum bearish reversal occurs when a bar above the center line, also called the signal line, is shorter than the previous bar. A momentum bullish reversal is made when a bar below the center line is shorter than the previous bar. Each of these situations represents a narrowing spread between the shorter-term moving average and the longer-term moving average, or a decrease in the momentum. A change in momentum represents a change in the price rate of change. Usually it coincides with a change in the price trend. Sometimes it does not. Do these momentum reversals represented by the up and down arrows look familiar? They should. Every one of them is within 1 bar of the stock momentum reversals for the same data you saw in figure 2.14. It looks like both the stock and MACD give about the same momentum information. This is no surprise since both are price indicators that represent about the same thing, a change in the rate of change of the price trend. A difference between the MACD and the stock is that the MACD does not have OB and OS zones. This doesn't prevent you from using the MACD for dual timeframe momentum strategies. The change in bar heights works just fine. Figure 2.117 uses the same S&P daily data used in figure 2.15. This S&P period was a strong bull trend with only minor corrections lasting a few days. The MACD made momentum bullish and bearish reversals within a bar or two of each minor price high and low. It would have been very effective to identify entry signals during the larger timeframe bull trend. So, which indicator is best to use for the dual timeframe momentum strategy? You could just about throw a dart at a list of price indicators and use whichever is hit. I prefer to use an indicator like the DTOSC, which is a combination of stochastic and RSI, or a stochastic itself or other indicator that has overbought and oversold zones. But the MACD or another indicator that you have used and are familiar with can be just as useful. What are the best indicator settings to use? I wish I could give you the quick, easy, and definitive answer to this question. Unfortunately, there isn't one. Anyone who tells you there is such an answer is full of beans, and I suspect has a very high-priced trading course or system to sell you. For any given momentum indicator, there will usually be different settings for different markets and usually different settings for different time frames of the same market. Once you find the best settings for the recent data for a given market and given time frame, will those settings ever change? You bet they will. And anyone who tells you different is full of more beans. The primary setting for any indicator is the look-back period. The look-back period is the number of bars back from the most recent bar that the indicator looks at to make the momentum calculations. Why may the settings change? Momentum trends cycle from low volatility and relatively infrequent momentum reversals to high volatility and relatively frequent momentum reversals. Ideally, we would have a system or indicator that would warn us of the type of momentum cycles that will be made in the future. Unfortunately, no such system exists, any more than there is a system to project in advance when a market is going to be in a trading range or a consistent trend. So occasionally, we may adjust the settings for an indicator to reflect the most recent momentum volatility. What is the primary variable for most indicators? It is the look-back period, or the number of bars, prior to and including the most recent bar the indicator will use to make its calculations. The current value of any indicator is the relationship of the last completed bar to the look-back period. Everyone is familiar with a simple moving average. It is the average price of the past X number of bars, usually the close. The look-back period is the number of bars used to calculate the moving average. A longer look-back period will be less sensitive to price change than a shorter look-back period. It will take a longer period of recent momentum change to influence the longer look-back period momentum indicator. The upside to the longer look-back period is there should be fewer false reversals made by short-term momentum changes. The downside of the longer look-back period has the potential for a lag between price and momentum reversals. Price may have made a reversal several bars before the momentum indicator makes the reversal. Let's take a look at a few charts and indicators and look-back periods. We'll begin by looking at the same data with different indicator look-back periods to see which may be more useful. Figure 2.118 is daily S&P index, SPX data with the DTOSC with a 21-day raw look-back period. The DTOSC indicator is a combination of stock and RSI. 4 numbers show in the indicator window. The first number is the raw look-back period, while the other numbers are periods the raw data is smoothed. Don't get hung up on the details of the indicator. Just grasp the concept of how the indicator acts and reacts to price trends based on the look-back period. How useful would this indicator have been to signal overbought and oversold positions and price reversals? Two things are immediately obvious. While the indicator oscillated nicely with the price swings, most of the indicator momentum reversals did not reach the OB or OS zone. For a two-line indicator like the DTOSC, stochastic, and others, both the fast and slow line must be in the OB or OS zone to consider the indicator OB or OS. If an indicator has an OB and OS zone, we want to use it to our advantage, and ideally use an indicator look-back period, so the indicator reaches the OB or OS zone most of the time before a momentum reversal is made. The second important factor is that most of the momentum reversals, which are made when the fast line crosses above or below the slow line, were made several bars after the extreme swing high or low, and after price had moved a significant distance from the high or low. If an indicator momentum reversal is part of our trade plan setup before an execution can be made, stops would typically have to be a long way from the entry price with a relatively long look-back period. The 21-day look-back period is probably too long to use for this data because both lines of the indicator usually do not reach the OB and OS zones before a reversal is made. And the lag from price reversal to momentum reversal is usually several bars when price has moved a significant distance from the swing high or low. Let's take a look at a shorter 8-day look-back period. Figure 2.19 shows the same period as the SPX 21-day look-back, but with a little less data, so you can see the momentum reversals more clearly. The up and down arrows show most of the momentum reversals. I've also circled a couple of periods in the indicator window when the momentum became choppy with reversals every few bars. There are a couple of obvious factors from this data and indicator chart. First, at the price highs and lows, the momentum reversals tended to be made in the OB and OS zones and right on or within just 1 or 2 bars of the price high or low. For any indicator, a relatively shorter look-back period will always result with the indicator making momentum reversals very close to the price swing highs and lows. This would seem to make a short look-back period ideal. However, the more timely signals come with a cost. A shorter look-back period will usually have lots of false momentum reversals. When very short-term momentum changes cause an indicator reversal, that is quickly reversed again as the trend continues. I've circled 3 areas on the indicator window when the indicator became choppy and gave momentum reversal signals that were again reversed within a bar or 2. Too short a look-back period will produce too many momentum whipsaws. There must be a reasonably happy medium, and there usually is. Figure 2.20 shows the same SPX data with the same indicator, but a 13-day look-back period. What do you notice about this 13-day look-back setting compared to the prior 2 charts? The characteristics are: 1, the indicator reaches the OB or OS zone at most of the momentum reversals. 2, the momentum reversals are within a couple of bars of the price highs and lows. And 3, there are no false momentum reversals between OB and OS zones. Of the 3 look-back periods we have looked at for this data, the 13-day is the best. Let's take a look at all 3 look-back periods on the same chart, figure 2.21. While the 8-day look-back period usually made momentum reversals from the OB and OS zones right on or within a bar or 2 of most price swing highs and lows, it also made a lot of whipsaw reversals mid-range that quickly reversed again. While the 21-day look-back period was very smooth with no mid-range fake-out reversals, the momentum reversals usually lagged the price reversals several bars, and most did not reach the OB and OS zones. The 13-day look-back period made most of the reversals from the OB and OS zones and within a bar or 2 of the price swing highs and lows. This is how I decide which settings or look-back period to use. It's very simple. Test a few settings on recent data and see which best meets the criteria for a useful indicator. When I occasionally do a live workshop, I'll ask the students to write down any stock, ETF, futures, index, or Forex symbol of any time frame, and I'll be able to choose the best settings for any indicator within 1 minute. I do the entire analysis and trade strategy for any market and any time frame within 3 minutes. You'll be able to do this yourself when you finish this book. There are only so many variables and so much useful data needed to make a trading decision. Once you have developed a trade plan, you can very quickly understand the probable position of a market and what the market must do for you to consider a trade. This has only been one example from a limited set of data. The concept and process is the most important thing for you to learn. Once you've learned it, the exact same concept and process is used for any market, any time frame, and any indicator. You should have a big question about now. You chose the best settings for this limited period of just a few months of SPX daily data. That's easy. It's called optimizing the historical data. Are these settings going to continue to be useful in the future? The answer to that is usually. I wish I could say always. Some trading educators claim there is one best set of settings for an indicator that you use all of the time. These guys have probably never actually traded, because I can guarantee there will be periods when market volatility and momentum cycles change, and the indicator settings you have been using will be much less useful. So here's how it works. Look at a series of data for any market and any time frame. Test out a few look-back periods for your favorite indicator over 2 or 3 different periods of time for the data and choose the most useful settings. Assume that these settings will continue to be useful. That's the best you can do, and don't let anyone tell you otherwise. You're not Nostradamus. You can't see into the future. You can never know if the volatility and momentum cycles will change in the future. Okay? You have to assume they will continue. If a market changes trend, speed, and volatility in the future, and the best settings you have found in the past are no longer optimal after a few momentum cycles, you may need to shorten or increase the look-back period. Figure 2.22 shows the data for several months following the examples I used previously. The same settings that were found to be useful for the earlier few months continued to be useful for months after. Near the end of the data shown in Figure 2.22, it looks like the bull trend became stronger and the correction smaller in time and price, so the indicator did not reach the oversold zone on the corrections. That doesn't mean the indicator was not valuable, because if the larger time frame trend is bullish, any smaller time frame momentum bullish reversal below the OB zone is a setup for a long trade. If the indicator made a couple more oscillations without reaching the OS zone on the corrections, we would probably change to a shorter look-back period. It is a quick and easy process to find the best indicator settings for any indicator and any market or time frame, as I have described. You are not looking for perfection. It doesn't exist. You are looking for the best fit, and that is as good as it is ever going to get. If you are ever taught by a book or course that there is one indicator and one setting that will consistently make reversals at price highs and lows, drop the book or walk away from the classroom. You are not being taught the truth by an experienced and successful trader. Trading is like any other business. You have to use the information available, study, gain experience, and make decisions. I wish we had room in the book to put 100 more examples of dual time frame momentum strategy setups, indicators, and their settings. But this is just one chapter and just one part of the trading plan. It is much more important to understand the principles, concepts, and applications than to see lots of repetitive examples. If you understand the concepts and applications, you will be able to use this information with any indicator, any market, and any time frame. Tash, dual time frame momentum strategy rules. The dual time frame momentum strategy identifies when a market is in a position to consider a trade. It is the first filter for a potential trade. It is one part of the trading plan that will have completely objective rules, regardless of which indicator is used. All you have to do is define what is a momentum reversal for the indicator you want to use, and you are set. If the indicator you use has overbought or oversold zones, you will incorporate them into the rules based on how the indicator typically acts and reacts to changes in momentum. First, let's take a look at the rules we would set up if using the DTOSC, which tends to reach the overbought and oversold zones with most price swings. We can put the rules in a simple table, Table 2.1. The first column lists the 4 possible positions of the higher timeframe momentum. The second column is the trade strategy given the position of the smaller timeframe momentum. Table 2.1 Dual Timeframe Momentum Strategy. Trade setup rules, DT Hosk. Higher timeframe momentum versus smaller timeframe momentum. Bull, not OB, long following a bullish reversal as long as bullish reversal is made below the OB zone. Bull, OB, no new long position. Possible short position following a bearish reversal. Bear, not OS, short following a bearish reversal as long as the bearish reversal is made above the OS zone. Bear, OS, no new short position. Possible long position following a bullish reversal. The dual timeframe momentum strategy setups are not trade execution signals, but objective conditions that must be met to consider a trade. Row 1. If the higher timeframe is bullish and not OB, only long positions should be considered following a smaller timeframe momentum bullish reversal. This is the ideal dual timeframe momentum strategy go long setup. 2 timeframes of momentum are going in the same direction. The setup is made immediately following the smaller timeframe momentum bullish reversal in the direction of the larger timeframe bull momentum. Row 2. If the higher timeframe is bullish but OB, the upside should be limited and no new long positions should be taken. Short positions may be considered following a smaller timeframe momentum bearish reversal. If the higher timeframe is OB, the upside is usually limited before a momentum high is made, and there usually is not enough profit potential to execute a new long trade. A higher timeframe overbought momentum is not a reason to exit an existing long position. It is merely a reason to avoid entering new long trades. Row 3. If the higher timeframe is bearish but not OS, a short position setup follows a smaller timeframe bearish reversal. This is the ideal dual timeframe momentum strategy go short setup. 2 timeframes of momentum are in the same direction, and the setup is made immediately following the smaller timeframe momentum bearish reversal in the direction of the larger timeframe bear momentum. Row 4. If the higher timeframe is bearish but OS, the downside should be limited and no new short positions should be taken. Long trades may be considered following a smaller timeframe bullish reversal. These conditions are simple, logical, and very powerful. There is no interpretation to the momentum position and how we use this information as part of a trading plan to make specific trade decisions. The dual timeframe momentum strategy is completely objective. Use it with any trading plan, and I know you'll be very happy with your results. These dual timeframe momentum strategy rules are good for any 2 timeframes of data, from weekly, daily to 15 mies per 5 mies. Let's take a look at just one more example to illustrate that the dual timeframe momentum strategy. Figure 2.23 shows 15 UR USD Forex data. The 60 member data is the higher time frame and 15 meter data is the lower time frame. During most of the period of this 15 meter data, the higher time frame's 60 minute momentum was bearish, as represented by the arrow line pointing to the right. The 60 minute momentum turned bearish just a few bars before the big pop up. The 15 meter momentum bearish reversals would be setups for short position trades as long as the lower timeframe 15 meter bearish reversal was made above the OS zone. There were 8 15 meter momentum bearish reversals made over about an 18-hour period following the 60 minute momentum bearish reversal. The second, third, and fourth 15 meters bearish reversals shown in figure 2.23 were made with the market in a fairly narrow trading range and turned out to have little, if any, profit potential, although we wouldn't have known that at the time they were made. The first and the last 4 50-meter bearish reversals each were followed by strong moves down in the direction of the larger time frame 60-meter bearish momentum. Each would have resulted in great setups for short position day or swing trades. Table 2.2, dual time frame momentum strategy, trade setup rules, stochastic. Higher time frame momentum versus smaller time frame momentum, bull, not OB. Long following a bullish reversal as long as bullish reversal is made below the OB zone. Bull, OB, no new long position. Possible short position following a bearish reversal. Bear, not OS, short following a bearish reversal as long as the bearish reversal is made above the OS zone. Bear, OS, no new short position. Possible long position following a bullish reversal. I've set up the rules for the stochastic in table 2.2 the same as I used for the DTOSC, since the stochastic also has OB and OS zones. Figure 2.24 uses the same 15-minute EUR USD data shown with the preceding DTOSC example. The stochastic momentum turned bearish a few 15-meter bars before the DTOSC did, but the first 15-meter stochastic momentum bearish reversal was also after the strong pop-up. While the stochastic didn't reach the OB zone on the momentum highs during this bear momentum trend, each 15-meter momentum bearish reversal was followed by a decline. All were good day trade setups, and most were good swing trade setups. What rules would you set up for an MACD or any other indicator you are already familiar with and have used for other momentum strategies? That is your assignment. You've learned the principles of dual time frame momentum strategies. The principles and process are the same for any indicator. Identify what the indicator activity is that represents a change in momentum, and devise the rules for the 4 conditions of the higher time frame momentum. Is a change of momentum represented by a fast and slow line crossover, by a higher or lower histogram bar, by a push above or below an OB or OS line? Now that you know the principles for a dual time frame momentum strategy, you can devise the rules for just about any price indicator. Identify minimum conditions that must be met on the 2 time frames to consider a trade, and you have the first part of a trading plan that will give you an edge in trade setup identification. Dual time frame momentum strategy trade filter. The dual time frame momentum strategy is a powerful filter to identify a trade setup. It may be used with any type of market and any 2 time frames. It is not a trade execution strategy. A later chapter will teach you specific trade execution strategies to use once you have identified the optimal trade condition. The higher time frame identifies trade direction. The lower time frame momentum reversals in the direction of the higher time frame momentum are important filters to identify a high probability trade setup. If you have the discipline to consider a trade only when a dual time frame momentum strategies has been made, your trade results should improve dramatically. Chapter 3. Practical pattern recognition for trends and corrections. Recognize trend position and reversals for trade position. In this chapter, you will learn simple pattern recognition that will help you to identify whether a market is in a trend or correction and what the position of the market is within the trend or correction. To be aware in advance if a market is at or near a reversal gives the trader a huge edge and will be an important part of any trading plan. The prior chapter explained how to use dual time frame momentum position to identify the conditions for which side of the market to trade, larger time frame momentum, and the momentum reversal condition for a trade execution setup, smaller time frame momentum reversal. The dual time frame momentum position is 100% objective. There is no decision for the trader to make. Simply identify one of the 4 possible momentum positions: bull, bull OB, bear, bear OS, on 2 momentum timeframes for the trade direction and trade execution setup. As you also learned in Chapter 2, momentum trends do not always coincide with price trends. A momentum reversal may only represent the slowing down of the price trend, not necessarily a price trend reversal. Most important, a momentum reversal does not indicate where the market is within the price trend or if the trend itself is at or near a reversal. The pattern position is the second of the 4 technical factors you will learn that provide the 4 key pieces of information you will use to make a trade decision. Pattern recognition objectives help identify whether a market is in a trend or correction. Ascertain whether the pattern conditions have been met that typically warn a trend or correction is at or near completion. Predict what is likely to follow the completion of the trend or correction. This will be very valuable information for practical trade strategies for any market and any time frame, as the trend position is another key to the trade direction and trade strategies. In this chapter, you will learn the one important guideline that will indicate if a market is in a trend or correction, and 2 simple patterns that will help to identify if the minimum conditions have been met that indicate completion of a trend or correction. Why is it important to identify a trend or correction? It can be very useful, and by that I mean profitable, For a trader to be aware if a market is making a trend or correction and what the position of a market is within a trend or correction. Let's take a look at a few examples. Figure 3.1 shows a strong bear trend making lower lows and lower highs. The last bar on the chart is a wide range outside down day, often a trend continuation signal. Would this be a great setup for a short trade and the continuation of the bear trend? It would be, unless the bear trend is in the final stages and about to make a reversal. Is there any way to know if the bear trend is in the final stages? If there is, we might not be so anxious to take a short trade following the outside down day trend continuation bar. If the pattern position suggests the bear trend is in a position to be complete, followed by a substantial reversal up, we would probably avoid a short position on the daily outside down day. Bearish continuation signal, or at the least, only have minimum expectations for a continued decline and adjust the trade strategy accordingly. Figure 3.2 adds several more bars to the prior chart. On the day following the last bar on the prior chart, which was a wide range outside down day, this market reversed up for a substantial advance. A wide range outside down day is typically seen as a trend continuation signal. But a short position following this wide range down day would have been taken right at the low that preceded a significant advance and a losing trade. The last bar on this chart is a wide range up day, which took out a swing high and closed near the high of the day. Taking out a swing high is a traditional signal for a swing trader's go long strategy. It looks like this market is very bullish and ripe for a long trade setup for a continuation of the bull trend. But what if the advance is just a correction to a bear trend? If so, the upside may be very limited before the market reverses to continue a bear trend to new lows. The pattern position may help to identify whether this is the case, which will have an important influence on the immediate trade strategy. We would be very cautious about taking a long trade if it is a corrective rally with little upside potential, and would want to prepare for conditions for a reversal from a corrective high and a short trade to take advantage of a continued decline to a new low. These are just a couple examples of how helpful it is to be aware of a few simple pattern position guidelines to help identify if a market is in a trend or correction and whether the minimum conditions have been made to complete the trend or correction. Simple pattern recognition based on Elliott wave. The simple guidelines for pattern recognition and simple patterns in this chapter are based on Elliott wave, E-wave analysis. You may have already had some exposure to Elliott wave analysis and become so confused by the overcomplicated approach to cycle degrees, subdivisions, and alternate wave counts taught by E-wave academics that your eyes are already starting to roll around. Stay with me, because in this chapter, you are going to learn a very simplified, practical, and valuable approach to pattern recognition that you will clearly understand and immediately be able to put into practice. E-wave analysis has been made way overcomplicated by E-wave academics. I know traders who have got bogged down in the paralysis of E-wave analysis for years and never figured out how to use it to make practical trade decisions. I'm going to teach you just one guideline and 3 patterns based on E-wave structure, which can be learned quickly and applied for practical trade strategies. You will learn how to look at any section of data of any market and any time frame and quickly determine if a market is likely in a trend or correction, and if the pattern conditions have been made to complete the trend or correction. You will also learn how and why this information is valuable and how to make it a part of your trading plan. The pattern guidelines I teach for trends or corrections do not involve a complicated counting scheme or getting lost in the paralysis of analysis. You will learn just one key guideline to identify if a market is in a trend or correction, and just 3 patterns to help identify trend and correction position. That is all we need to help make specific and practical trade decisions. Identifying patterns is only academic unless we can use the information to make specific and practical trade decisions, which of course is what this book is about. Trend or correction, the overlap guideline. There are 2 important pieces of information that we want the pattern position to tell us. Is a market in a trend or correction? And what is the position of the market within that trend or correction? Let's tackle whether a market is in a trend or correction first. This simple piece of information can be very helpful to a trade strategy. The key is to identify if a market is making a correction. Why? If a market is making a correction, it should not take out the extreme that began the prior trend, but should eventually continue the trend direction prior to the correction and make a new extreme. Let's illustrate how this simple information can be very valuable. Figure 3.3 shows a market that is making a decline following a strong advance. If the market is making a correction to the bull trend, it should not decline below the March 14th swing low shown on the chart and should eventually make a new high. It would be very valuable to have reliable information if the decline is a correction, because the downside potential would be very limited and the upside following the end of the correction would be very significant. There is one simple pattern guideline that is very reliable to warn if a market is probably making a correction and not a new trend to a new extreme. If a market overlaps a section, more than likely it is making a correction. An overlap is when a market makes a new low or high and then trades back into the range of the prior section. In figure 3.4, the Philadelphia Gold and Silver Index, XAU, made an initial swing low labeled A, then a short rally followed by a new low below A, and then traded back up into the range of section A. The market overlapped, or traded back into the range of section A, which warned the decline was probably a correction and not a bear trend to new lows. The next chart, figure 3.5, adds more data and shows how the market continued to make overlapping swings, confirming it was probably making a correction and would eventually make a new high without trading below the low on the chart. Bars later, the XAU did eventually make a new high as anticipated without trading below the low of the prior trend. Knowing early on that, following the first overlap, the XAU was probably making a correction and would eventually continue the bull trend to a new high, gave the trader a huge edge. The downside should be limited with significant upside potential. Figure 3.6 is another example of an overlap pattern that signals the decline is a correction, and the mini Dow Jones Futures YM will eventually make a new high. This would be extremely valuable information, particularly after the market had made such a sharp decline, which would have made many traders bearish, just at a time when the market may be ready to take off to the upside following a corrective low. Figure 3.7 adds more data to the previous chart and shows how the decline was a correction as anticipated by the overlap, and the market did eventually make a new high, also as anticipated. Wouldn't it be helpful to your trading to recognize, a few bars after the section C low, that the YM in the previous two charts was probably making a correction, which would be followed by a new high without taking out the low shown on the chart? Let me answer that for you, just in case you're not paying attention. Very helpful. You would then use the momentum, price, and time tools taught in this book to determine if the market was in a position to complete a correction for a long trade setup well before it continued to advance and take out a swing high. Pattern position signals can be a key component of any practical, real-world trading plan. The simple guidelines like the overlap guideline can give an early warning of the probable outcome of the current market position. Have you ever read a book or taken a trading course where every example showed how every market responded to whatever signal was being taught? A better question may be, have you ever read a book or taken a trading course that made a point that whatever was being taught did not work every time? This book is about the real world. No technical analysis technique, pattern signal, or trade strategy works every time. A market may run against an ideal setup. An ideal pattern position that usually results in a corrective high or low may be followed by a strong trend continuation. I've said this before and you'll hear it again and again. The business of trading is to identify conditions with a high probability outcome and acceptable capital exposure. We will not be right all of the time, but we should be right most of the time. And when wrong, the cost is acceptable. If you ever read a trading book or take a trading course where the author instructor does not clearly state that whatever strategy he is teaching will not be profitable with every trade and doesn't show examples that don't work out, get out as quickly as possible before it costs you a lot of hard-earned money. The author instructor is not being honest and does not have your best interests at heart. Not every correction will have an overlap of swings before the correction is complete. Not every overlap of swings will be part of a correction. Figure 3.8 is a 60-minute chart of the S&P Mini Futures Contract, ES, and shows a correction that was just one strong swing up, followed by a continued bear trend to a new low. There was no overlapping swing in this correction. Swings may overlap and not be a part of a correction. Figure 3.9 clearly shows the overlapping sections in the box, which typically signal the market was making a corrective rally. However, the SPX eventually continued to advance to a new high for a failed overlap corrective pattern signal. I actually had to do quite a bit of searching through several markets and time frames to locate these two failed pattern examples, because most corrections do have a swing overlap, and most overlaps are a part of a correction. Of the two types of failed examples, the most infrequent is an overlap that is not part of a correction. Always remember that there are no sure things with any type of trade strategy. However, we want to put the odds in our favor and give ourselves an edge by identifying conditions with a high probability outcome. If most swing overlaps are part of a correction, this guideline will be an important part of our trading plan that we can use to make specific low-risk, high-probability trade decisions. ABC, and away we go. If overlapping swings are typical of a correction, it implies a correction will usually have at least 3 swings. A frequent type of correction for all markets and all time frames is 3 swings, called an ABC correction. However, corrections may take many forms and have more than 3 swings. Traders obsessed with Elliott Wave have identified 13 complex corrective patterns, not including the so-called irregular ABCs. For our purposes, the most important piece of information is a correction should have at least 3 distinct swings. We're going to keep it very simple, as usual, and always make the assumption that a correction will have at least 3 sections called a simple ABC. In E-wave terms, an ABC zigzag. A correction will often have more than 3 swings or a form other than a simple ABC, but we always first look for at least 3 sections. Let's take a look at a simple ABC example and then learn the rules and guidelines and how this information can be used for practical trade decisions. I'm going to use E-wave type nomenclature to identify the pivot highs and lows and usually call them waves. The terms wave, swing, and section are all used to identify the same thing. Waves that are a part of a correction are labeled with letters, such as wave A, WA, wave B, WB, etc. Figure 3.10 is a daily chart of American Airlines, AA, showing an ABC correction followed by a bull trend to a new high. Following the wave C low, AA traded up into the range of wave A for an overlap and pattern signal that AA should be making a correction to a bull trend, not a bear trend to a new low. Once the overlap is made, we don't know if the correction has ended as a simple ABC or will develop into a complex correction. What we do know is that it probably is a correction and will eventually continue to advance to a new high. We also know that the minimum 3 sections for a correction are complete. A continued advance to above the wave B high is a pattern signal that the corrective low is probably complete and the advance will continue. This one example illustrates the 3 guidelines for ABC corrections, the minimum expected pattern for a correction. ABC Guidelines 1, the wave C should exceed the extreme of wave A. 2, if the market trades back into the range of wave A, the minimum conditions for a correction are complete. 3, a trade beyond the wave B extreme is a pattern signal that the correction should be complete. Figure 3.11 is the daily Russell 1000 ETF, IWD, and shows another ABC correction. IWD made 3 distinct sections up for a potential ABC and then traded into the range of wave A to signal it was probably making a correction and would eventually decline to a new low. IWD traded below the wave B low to signal the correction should be over and the bear trend should continue. Let's review a few important things before we continue. We make a trade decision based on what we know. We use the information that we know to identify conditions with a high probability outcome. The assumption is that a correction will make at least 3 sections, also called swings or waves. If an overlap is made, it meets the 3-section criteria, and is a pattern signal that a correction is probably being made. We know the market has made a section overlap, and we know the minimum 3 sections are complete. At this point, we would only consider trades against the correction direction. If the wave B extreme is taken out, more than likely the corrective high or low has been made and is an all-out go long or short signal, depending if the wave B is a high or low, with a stop no further than the potential wave C extreme. Notice that I continually use the words potential, probable, more than likely, and such. Why? Remember that the objective of all trade strategies is to identify conditions with a high probability outcome and acceptable capital exposure. Probability is the key word, so I never imply that a particular strategy, whether pattern recognition, dual time frame momentum, price, or any other strategy, will always have the expected outcome. I am teaching you strategies and market conditions that will have a probable outcome. As of the last bar on the daily QQQQ chart in figure 3.12, QQQQ has traded into the range of wave A. The minimum conditions to complete an ABC correction have been made, and QQQQ is likely to eventually continue to advance to above the high shown on the chart. It will still take a trade above the wave B high to confirm the corrective low should be complete. Notice that the wave B, which is a correction itself to the wave A down, made a small ABC. Since a wave B is itself a correction, its pattern should also meet the guidelines for a correction for what we call a smaller degree pattern. We are not going to complicate pattern analysis with subdivisions and degrees. While it can be helpful, it is an entire course of study in itself and is not necessary for the trading strategies taught in this book. As of the last bar on the QQQQ daily chart in figure 3.112, we don't know if an ABC correction is complete or if it will take a more complex pattern, or even if the QQQQ won't decline to a new low. What we do know is the conditions for a correction have been made with the 3 sections and overlap trade into the wave A range. That information alone gives us an edge to immediately consider long trade strategies for a probable advance to a new high. The weekly British pound chart in figure 3.13 shows another ABC correction. The first weekly bar off the potential wave C low traded above the wave B high for a pattern confirmation signal that an ABC correction was probably complete and the bull trend would eventually continue to a new high without trading below the wave C low. The corrective trade strategies are applicable to any actively traded market and any time frame, whether stocks, ETFs, futures and indexes, or Forex. You've learned about simple ABC corrections and how to identify the initial signal that the market is in a correction and the initial conditions that signal an ABC correction may be complete. In Chapter 4, you will learn how to identify in advance the high probability price target to complete an ABC and other corrections. While the simple ABC correction is a frequent type of correction, a correction can take many forms. Let's take a look at complex corrections. Complex corrections. A complex correction is any correction that makes more than 3 waves or sections. E-wave academics have identified 13 patterns of complex corrections. We are not going to examine the many patterns of complex corrections here. In fact, we're not going to examine any particular complex correction patterns because it serves little purpose for practical trade strategies. All that we want to do is recognize that a correction is probably being made. If we can do that, we know to orient our trade strategy to trade against the direction of the correction for a probable continuation of the trend to a new high or low once the correction is complete. A complex correction typically has several sections that overlap. That's the key, overlapping sections. Once we identify that the market should be making a corrective pattern and eventually trend to a new high or low, we can use other strategies including dual time frame momentum, price, and time position to help identify if the correction is in a position to be complete and continue the trend. Figure 3.114 is an example of a complex correction in the GBP USD 60-minute data. While the last advance of the correction made a new high, the sections had already overlapped and even made a slight new low. The pattern signals a correction to the bear trend was probably being made, not a new bull trend. The GPUSD eventually completed the correction and continued the bear trend to a new low. Figure 3.115 shows another complex correction for the EUR-USD 15-minute data. I'll let you tear your hair out putting labels on each of the sections in the correction. The most important factor, each of the small sections overlapped as the EUR-USD struggled higher. Eventually, a swing low was taken out, which usually signals a correction is complete, and the EUR-USD continued to decline to a new low, below the low where the correction began. It is always easy to show after-the-fact examples. Just remember what you need to learn here. If the sections overlap, more than likely a correction is being made. That information itself is very valuable and will help you to identify the probable position of a market and probable next major trend direction. The overlap will be an important signal to trade direction. Figure 3.116 is a daily chart showing another complex correction. Near the end of the correction, GM traded to a new high for the correction, but below the bull trend high shown on the chart, then traded back into the range of the first section up, signaling more than likely it was making a correction and would eventually continue lower. As soon as a market makes the overlap, it is a strong pattern signal. A correction is being made. The market may continue in a complex correction, making several overlaps. Throughout, the strategy will be to identify the end of the correction in order to position for a trade in the direction of the trend. Later in this book, you will learn specific reversal and breakout trade strategies. Wouldn't it be nice and infinitely profitable if every market and every time frame worked out as expected? Figure 3.17 shows 60-minute Dow Jones mini futures contract YM data. If we were to add bar by bar during the period shown in the box, the only conclusion from a pattern perspective would be that the YM was making a correction in a bull trend. We could call it a complex correction, a consolidation, a trading range, or any other corrective name you want to give it. The main factor is the sections were overlapping, typical of a correction. How did it turn out? Eventually, the YM declined strongly to a new low, not a new high as would have been anticipated from the probable corrective pattern position. As in any other business, the best data, strategies, and plans sometimes don't work out. Markets may do just the opposite of what is anticipated from the information available. And just like with any other business, that is why strategies are so important to limit losses when things don't work out as planned. Trade strategies and trade management are just as important as the technical analysis that identifies the high probability setups. Later in this book, you will learn specific trade strategies and trade management from entry to exit that will help minimize losses when a setup does not work out and maximize gains when it does. Overlap is the key to identify a correction. We don't need to look at dozens of examples of ABC and complex corrections, since there is just one guiding principle to identify if a market is in a correction. Once the sections overlap, it is an early alert signal. The market should be making a correction. While a market may continue to trade higher or lower depending on the direction of the correction, the overlapping sections continue to signal that the market is in a correction, that it should not make a new extreme, and that it will eventually continue to trend in the direction of the trend prior to the beginning of the correction. Trends and five-wave patterns. You learned that corrections are usually at least 3 sections, and the overlap of a section is the pattern guideline that signals the market should be in a correction and not a trend. A correction may make more than 3 sections for a complex correction, but once an overlap is made, more than likely the market is making a correction and will eventually continue in the original trend direction before the correction began and reach a new high or low. Trends usually make 5 sections, and the sections do not overlap. In E-wave terms, a trend is called an impulse wave. We are going to stick with the term trend because all that we are concerned with is using pattern guidelines to identify 2 basic market conditions: trends and corrections. We have used letters to label the sections of a correction: wave A, wave B, etc. Numbers are used to identify the sections of a trend, such as wave 1, W1, wave 2, W2, and so on. A trend usually makes 5 sections or waves in E-wave terms. There are 3 rules accepted by E-wave traders for 5-wave trends. They are good rules with one modification. So let's learn them first and then take a look at a chart. Since I've modified one of the accepted E-wave trend rules, I'm going to call them guidelines instead of rules. Trend pattern guidelines. 1. Wave 2 cannot trade beyond the beginning of wave 1. 2. Wave 3 cannot be the shortest in price of waves 1, 3, and 5. 3. Wave 4 cannot make a daily close into the closing range of wave 1. Modification I've made to the accepted E-wave rules is the wave 4 rule with daily data. The typical E-wave rule is wave 4 cannot trade into the range of wave 1. My modification to the rule is wave 4 cannot make a daily close into the daily closing range of wave 1. Over the past 20 plus years, I've seen a market trade a few ticks into the wave 1 range and then continue the trend to complete an otherwise perfect 5-wave trend so many times that I modified the rule, and it has served me and others very well over the years. The SPX daily chart in figure 3.18 illustrates the 3 trend rules. Guideline 1, that a wave 2 may not exceed the beginning of a wave 1, is logical. If a market took out the beginning of wave 1, it would have made a new high or low and voided any logical beginning of a new trend. In Chapter 4, you will learn how we can use Guideline 2, where the wave 3 cannot be the shortest in price of waves 1, 3, and 5, to project the maximum trend price target in certain circumstances. Guideline 3, where a wave 4 may not close into the daily closing range of wave 1, is related to the correction overlap rule. An overlap of the daily closing range of wave 1 signals the market is probably not making a trend, but a correction. Before you learn more about the most typical trend pattern, I want to make something very clear. Not every trend makes a 5-wave pattern that conforms to the trend guidelines, but many trends do. And knowing that a trend is usually at least 5 waves or sections provides us with valuable information to recognize when a trend may be in the final stages before a major trend reversal. Let's take a look at some trends and see how the probable trend pattern can help us to make practical trade decisions. Figure 3.19 is the continuous British pound weekly closing data. As of the last data point on the chart, the BP has made an ideal 5-wave decline to a new low, although the potential wave 5 may not be complete. How does the pattern of the BP data through the last data point help us? If most trends are complete with 5 sections that conform to the 3 trend guidelines, what we know is the BP has met the guidelines to complete waves 1 through 4 and may be in the final section of the bear trend. The downside could be relatively limited. This itself can be valuable information. While the BP had been in a bear trend for months and just broke out to a new low, typically a very bearish signal for swing traders, we would be aware that the bear trend could be very near the end, just at a time when many traders would be extremely bearish. We are always making decisions based on the data through the last data point, but we trade the right side of the chart, the side to the right of the last data point. We're making the best guess possible based on the known data and probable market position. The information from the pattern position of the data on the weekly BP chart is that the downside may be limited, and the next weekly swing low is likely to be followed by a rally greater in time and price than any since the beginning of the bear trend. That is valuable information. The momentum, price, and time position will help us to identify the next swing low and potential W5 low. Figure 3.20 is daily SPX data. What do we know as of the last bar on the chart? With the decline below the swing low labeled 3, there are 4 completed sections that meet the trend guidelines. The wave 4 did not close into the closing range of wave 1, and the SPX has made a new low for a potential wave 5 to complete the bear trend. The downside should be limited before a wave 5 low is made, and a rally greater in time and price than any rally in the bear trend, the W2 or W4 corrections, begins. This is a description of what we know and the likely outcome. How did it turn out? Go back to figure 3.18, which illustrated the 3 E-wave guidelines for 5-wave trends. It includes the same data on this chart, plus a couple of additional weeks of data. The SPX made a sharp rally. The bear trend made 5 sections. Don't make wave counting difficult. Think in logical terms. If a correction is greater in time and price than any previous correction of the trend section, we can count it as a completed wave or section. Let's illustrate this. In figure 3.21, I've labeled a 5-wave bull trend on the QQQQ daily chart. The wave 2 decline lasted just 4 days, but was greater in time and price than any correction during what is labeled the wave 1 advance. Since that decline was greater in time and/or price, more than likely it is a completed correction to the trend section or a wave 2. The QQQQ then made a significant rally to a new high above what is labeled a wave 1, and beginning with what is labeled the wave 3 high, made a correction much greater in time and price than any correction since the wave 2 low. It should be a wave 4 low. The QQQQ then made a new high to complete 4 sections. Since most trends are complete with 5 waves, the upside would probably be limited before the wave 5 is complete, and either a corrective decline greater than any correction within the 5-wave trend or a new bear trend began. The key is, once the new high above the probable wave 3 high was made, more than likely the QQQQ was in the final stages of the bull trend from the August low, and a significant decline would soon begin. The decline below the wave 4 low signaled the end of the 5-wave trend. Keep this whole business of counting or labeling waves or sections simple and logical. Don't fall into the E-wave paralysis of analysis trap. We are only interested in the 2 types of patterns that are useful to help us understand the position of the market and to make practical trade decisions. Let's take another look at the QQQQ daily data. As of the last bar on figure 3.22, the QQQQ has traded above the probable wave B swing high, confirming a 3-wave decline. Trends should be at least 5 waves, so the market has clearly indicated by the pattern that a correction to the bull trend was being made. The correction may continue in a complex correction, but, and here's the key information, the QQQQ should eventually make at least a 5-wave trend to a new high. That is powerful information as of the last bar on the chart. The downside should be relatively limited, and the upside has significant potential. Let's add some more data to the chart. As of the last bar on the chart in figure 3.23, the QQQQ has made a new high as anticipated. The new high signals a trend should be underway. Trends should be at least 5 waves. Only waves 1 and 2 could be complete as of the last bar. That means there should be waves 3 through 5 still to come, taking the QQQQ higher, possibly much higher. Again, this is powerful information based on simple correction and trend pattern recognition guidelines, and the logical position of the market based just on the pattern as of the last bar. More data is added in figure 3.24. The last bar on the chart has made a new high following a probable wave 4 low. Since most trends end with 5 sections, the upside should be relatively limited before the entire trend up from the WIC low is complete. You know what happened. I started this series of examples with the end result. A few bars later, a high was made, followed by a sharp decline. I don't want you to become a so-called Elliott wave expert. I just want you to use simple logic on what trends and corrections usually look like, what guidelines to use to recognize the probable position of the market within a trend or correction, as well as the probable outcome, and to think in a logical step-by-step manner as new data is added. No complex counting systems, no detailed subdivisions of subdivisions and waves of different degrees. Just know a couple simple patterns that are reliable and how to recognize them as the market unfolds. Greater in time and price. Earlier, I identified corrections as greater in time and price than any prior correction in the section to help identify a new section in the trend. W.D. Gann called this an overbalance of time and/or price. It is a simple but reliable way to help determine whether a section is complete. Figure 3.25 is daily QQQQ day and shows a 4-bar decline, which is labeled a wave 2. Up to this point in time, the largest decline was just 2 bars, which was much shorter in price than the 4-bar decline. Once the QQQQ made a new high, the larger 4-bar correction is probably a wave 2 correction to the bull trend up to that point. No matter what approach to technical analysis you use, you always have to make assumptions based on the information at hand. The outcome is never certain, but using the greater in time and/or price correction assumption is a good one, at least until more data is available that may prove it wrong. The other, greater in time and/or price assumption is that once a trend is complete, The minimum expectation is that a correction greater in time and price should follow than any correction within the trend. In other words, the minimum expectation is a correction greater than either the wave 2 or wave 4 corrections if a 5-wave trend should be made. This is very valuable information that you will use over and over again. Note that I said the minimum expectation. Once a trend is complete, either a correction to that trend will be made or a new trend in the opposite direction may begin. It depends on the position of the just completed trend within the larger timeframe trend. If we were going to get into different degrees or timeframes of trend, we would just complicate matters and have to learn about subdivisions of trends and more. Frankly, that is an entire course in and of itself, and we just don't need it to make practical, high-probability trade decisions day by day. Fifth waves are the key. The most valuable piece of information regarding trends is that once waves 1 through 4 are confirmed, the trend should be in the final stages. In our DT reports, we often say, the trade to a new high, if a bull trend, confirms a wave 4 should be complete and the upside should be limited before a wave 5 high is complete, which should complete the bull trend. If a market is making new highs, the natural inclination for most traders is to be very bullish. This is a good inclination in the early stages of a trend. It can be a very costly inclination in the later stages of a trend. If we are aware that all of the guidelines to complete waves 1 through 4 have been met, the swing to a new high could be a wave 5 and the probable last swing up in a larger time frame. This information will be a huge advantage and help us to be prepared for a top and major reversal just when most traders are very bullish. If we just focus on this one pattern tendency of trends to usually make at least 5 sections with no overlaps, that information alone will be of enormous benefit if 4 sections are complete. If a market is in a probable wave 5, the next momentum reversal could be the early signal the wave 5 is complete, and we can adjust our trade management strategies accordingly. I will teach you more on how to use momentum to confirm pattern position in the chapters to come. Figure 3.26 is General Motors GM daily close data. Based solely on the probable pattern position, what would you anticipate for GM in the days or weeks ahead? GM has made a new low, so the decline should be a trend, not a correction. If so, 3 waves could be complete. If this is the case, following the completion of a wave 4 corrective high, GM should make a new low. Not good news for the stockholders, given that GM has already declined over 30% in a month. And based on the pattern position, more than likely GM will continue lower before the decline is complete. Unless you're short. Figure 3.27 is 15-minute data for the GBP USD. What should you anticipate as of the last bar on the chart? The GBP USD has made a 5-wave decline, confirmed by the trade above the probable wave 4 high. What do we anticipate following a completed 5-wave trend just based on pattern? At least a corrective rally greater in time and price than any correction within the bear trend should follow. More than likely, the GBP USD should be sideways to up for a while longer before the bear trend has the potential to continue. Corrections usually have overlapping sections. Trends usually do not. But markets don't always follow the rules. Figure 3.28 is daily SPX data for more than a 2-year period. The SPX was in a relentless bull trend, making higher highs and higher lows, but each bull section overlapped with the prior section. A trend structure is not supposed to do that, but sometimes they do. Within the larger time frame overlapping sections, the S&P made lots of tradable minor trends and corrections. That is why pattern position is not the only factor on which to base a trade decision. It is one of the 4 key factors, which also include the momentum, price, and time position, plus low risk, high probability trade strategies that make up a complete trading plan. Let the Elliott wave obsessives go crazy with a labeling scheme for this bull trend. All we want to do is make money and use practical pattern guidelines to help us make high probability trade decisions. Before we go on to the next chapter and learn how to make high probability price targets in advance for support, resistance, and trend reversal, let's take a quick look at how we will use what we have learned so far about momentum and pattern position to help make trade decisions. Momentum and pattern position. In Chapter 2, You learned how to use dual time frame momentum position as the filter to identify probable trade setups. How do we use what we have learned so far about momentum and pattern together to up the odds for a successful trade and lower the initial capital exposure? Let's revisit the QQQQ daily chart with figure 3.29 and include a momentum indicator. The pattern signal that a 5-wave trend is complete occurs if the market takes out the wave 4 extreme, in this case a low. The wave 4 extreme may be far from what may end up to be the wave 5 high. Ideally, we have a much earlier signal than a decline below the wave 4 low. As of the last bar on the chart, the momentum made a bearish reversal. The QQQQ price was well above the probable wave 4 low. The pattern position of a probable wave 5 high with a momentum bearish reversal is a setup to signal the wave 5 is probably complete. It is a setup for a short trade with very minimal capital exposure. As you will learn as we put all of the factors together to develop a simple but comprehensive trade plan, it is when several completely independent factors all indicate the same position that the best setups with the highest probability outcome and smallest capital exposure are made. Figure 3.30 is the AA daily data we used for an example in the correction section. The initial pattern signal that an ABC correction may be complete occurs if the market trades into the range of the potential wave A low, making an overlap. As of the last bar on this chart, AA has clearly made a 3-section decline for a potential ABC correction and has made a bullish momentum reversal. Pattern position and momentum reversal together are giving an early warning of an ABC low setup for a long trade before an overlap is made. Momentum and pattern, not enough. Potential pattern position and momentum reversals are a powerful combination to identify trade setups, which you will learn much more about in the chapters ahead. But the combination of just these two factors is not as powerful as when we add the price and time position, which you will learn in the next 2 chapters. Chapter 4, Beyond Fib Retracement High Probability Price Targets for Support Resistance and Trend Reversal. In this chapter, you will learn new and unique ways to project in advance very narrow range price targets for any market condition. The dynamic price strategies you learn will put you miles ahead of traders who only use typical Fibonacci retracements. Are you ready to learn how to identify in advance narrow range price zones for trend and counter trend reversal? I'm not talking about just identifying support and resistance. I'm going to take you beyond simple support and resistance and teach you how to project high probability trend reversal price targets for any market, any time frame. That's information every trader can use every day and make an important part of a trading plan. So many trading books talk about Fibonacci, fib retracements, and imbue them with magical properties that will result in endlessly profitable trade strategies. Fib retracements by themselves can be useful, but they are only entry-level price strategies compared to the more comprehensive dynamic price strategies you will learn in this chapter. Fib retracements are only one type of price technique and fail to include key ratios for a complete price strategy approach. Most trading software includes a fib retracement routine. While many corrective highs and lows are made at fib retracements, most traders have not been taught how to identify in advance which retracement is likely to be support, resistance, or trend reversal. Plus, the fib ratios are a limited set of ratios that do not include other important geometric ratios that are equally important for a complete price strategy. It is not enough to know that a reversal should be made near one of the retracement levels. With 3, 4, or 5 retracement levels on a chart, it is imperative that the trader have some method to identify which retracement level is likely to be the support, resistance, or trend reversal. In this chapter, I teach you not only how to identify in advance which retracement level is likely to be the target for a trend reversal high or low, but some new and very important ratios to project the end of trends and corrections that are not typically used by most traders. In addition, you will learn unique and very effective ways to identify high probability price target zones to use for practical trade strategies. In this chapter, you will learn the difference between internal and external retracements and alternate price projections, and how together they identify not just support and resistance, but narrow-range price zones where corrections and trends usually end. Even if you are familiar with fib retracements, don't skip through this chapter, as there should be a lot of new information for you. Prepare to take your price analysis to a whole new level with real-world, practical price trade strategies. I have taught this approach for almost 2 decades to all types of traders, from day traders to position traders, and for all types of markets, including Forex, futures, stocks, exchange-traded funds, ETFs, and even mutual funds. I call this approach to price dynamic price strategy. Why not just call it Fibonacci price strategies? For 2 reasons. 1, we use some ratios that are not a direct part of the Fibonacci series, but are just as important as the typical fib ratios. And 2, we use the ratios in ways other than the typical retracement approach usually taught. I have refined and simplified the dynamic price strategy approach over the years to get to the core of practical, real-world price strategies that you can use for any market and any time frame. Let's begin by learning internal retracements. Internal retracements and corrections. There are 2 types of retracements, internal and external. The price retracements with which most traders are familiar are what I call internal retracements. If it is necessary to distinguish between internal and external retracements in this chapter, I will use the label INRET for internal retracements. Internal retracements are less than 100% and are primarily used to identify the price target to complete a correction. Even if you're familiar with so-called fib retracements, don't skip this section. I want to be sure we are on the same page with the language, terms, and specific ratios used with the dynamic price strategy. The ratios used for internal retracements are 0.382, 50, 0.6118, and 0.786. They are often expressed as a percentage. The first 3 ratios, 382, 50, and 0.618, are commonly called fib retracements, although 50 is not actually a fib ratio. The 4th ratio, 0.786, may be new to you unless you've taken some of my courses over the years. It is not a fib ratio, but is closely related and an important retracement ratio that should always be included. It is the square root of 0.618. I won't go through the history of the Italian Fibonacci and the ratios named after him. The history and significance of the ratios is thoroughly covered in other trading and non-trading books. There is a huge body of trading and mathematical literature about Fibonacci numbers and ratios for those interested. The history is simply not relevant. I think I have almost every book relating to Fibonacci, sacred and philosophical geometry, sacred architecture, and related subjects available in the past 30 years, including many that are out of print. It is a very, very interesting subject. But all those books and $3 will get you a cup of cappuccino at the local overpriced coffee shop. We'll just stick to the practical application. All you need to know are the numbers for trading. Feel free to spend your spare time learning about the fascinating history and historical application of these geometric and harmonic numbers and ratios. It is time well spent, but not relevant to the course of study at hand. I'm also not going to discuss why markets seem to respond to these price and time harmonics. That is another fascinating subject, not yet fully understood. But there is a lot of evidence that our brains are hardwired to respond to these proportions. Since market trends and corrections are simply the consequence of crowd psychology, a natural consequence is for trends and countertrends to be in the proportion of these harmonics. Robert Prechter has done a good job of addressing the whys and hows of these harmonics in price data in his books. Socionomics, the science of history and social prediction and pioneering studies in socionomics, New Classics Library, 2003. If you want more background, knock yourself out with this fascinating study. But I digress. Back to internal retracements. What are they and how do we make and display them on a chart? Figure 4.1 shows the 4 key internal retracements for a bull section of the 60-minute data for an S&P Mini Futures ES contract. Trading decisions are based on key information and on having the key information quickly and clearly available. On the charts in this book, swing highs and lows are often labeled with an arrow pointing to the high or low, as shown on the chart in Figure 4.1. These are called date labels in the Dynamic Trader software. The user has a choice of what information to include with the labels, such as the date, time, if intraday data, price change, percentage change, number of trading bars or calendar days, and the rate of change, ROC. The dynamic trader software automatically calculates the price change, percentage change, number of trading bars or calendar days, and the ROC from the last date label, so the user may have a lot of information included with the label. It is helpful if your trading software is able to at least label the date, time, and price of swing highs and lows on any chart. In Figure 4.1, the ES made an advance of 120.25 points from 1406.75 to 1527 zeros. The low and high are labeled on the chart, and the range of the advance is shown in the top label. The range of 120.25 is proportioned by the 4 key ratios, with the results subtracted from the high price to arrive at the 4 retracement levels. Most trading software will have a retracement function. If yours doesn't, your trading software is probably not fully functioning, or it is not designed for professional traders, and you need new trading software. Your trading software should allow you to enter any ratio you choose and should allow you to choose to make the retracements by either the range of price, highs and lows of the bars, as shown on the chart, or by closing prices. Figure 4.2 is the price retracement ratios menu from my dynamic trader program. The menu includes all of the possible options to choose ratios and how they are displayed and labeled, including the thickness and color of each line. Your trading software should at least give you the ability to choose any ratios to include for retracements, including ratios greater than 1. As you will see later in this chapter, ratios greater than 1 are a key component of the dynamic price strategy. Because internal retracements are always less than 100%, they are used to help identify price targets for corrections. Why is it helpful to know the key retracement price levels for any market we trade? Most corrections in every actively traded market and time frame end at or very near one of the 4 key retracements. That is why retracements are a key to help identify where a correction will end and why dynamic price strategies are a very important part of a trading plan. Figure 4.3 includes about 2 years of weekly SPX data and shows that the 4 primary corrections during this period were each made at or very near one of the key internal retracements. Each corrective low for the SPX for this period was not made exactly at one of the key retracement levels, but all were made within just a few points of either the 50% or 61.8% retracements during this period. I could put up dozens of charts of many markets and time frames and show how almost every corrective high and low is made at or very near one of the 4 key retracement levels. But that wouldn't be instructive at this point, so let's just assume it to be the case for now. Even given that assumption, which I have found to be fact over the past 20 plus years, you have to be asking yourself, or really asking me, the big question. If there are 4 key retracement levels, how do I know which retracement level is likely to end the correction? Am I supposed to make a reversal trade every time a market reaches one of the 4 retracement levels? Showing simple fib retracements is usually as far as most trading educators go, but this chapter is called Beyond Fib Retracements. I promise to take you to another level with price strategies, and that is exactly what I'm going to do. Retracement levels by themselves are not of much use for practical trade strategies. You could go broke making trend reversal trades every time a market reached a retracement level. There has to be more to the price strategy that will help identify which retracement level is most likely to be the end of a correction. We are not just looking for support or resistance. We want to identify that the price level that will complete a correction, so we can either cover a counter trend trade or enter a trade in the direction of the larger time frame trend at the end of a correction. Plus, we must be able to discern if there is a relatively narrow range of price around the retracement level that is a trend reversal price zone, so we don't get hung up expecting the reversal to be made right at the retracement price. I'm not going to show you dozens of examples of highs, lows, and corrective trend reversals made at the retracements. It is not instructive at this point. For now, all you have to know is that most corrective highs and lows are made at or very near one of the four internal retracements and how the retracements are made. How do we identify in advance which retracement level is most likely to be the price near where a correction is complete? We do this by also making alternate price projections and external retracements, which will help to identify the internal retracement level that is likely to end a correction and not just be temporary support or resistance. Even though external retracements are more closely related to internal retracements, we are going to first learn how to make and use alternate price projections to help qualify which internal retracement is most likely to be the price target for a corrective trend reversal. I also want to emphasize at this point that the objective is not just to identify temporary support or resistance. That is not particularly helpful. The objective is to identify the probable price target that should end the entire corrective or trend structure. Dash internal retracements. The four internal retracement levels are 38.2%, 50%, 61.8%, and 78.6%. Most corrections end at or very near the 50% or 61.8% retracement. The 38.2% retracement level usually does not end a correction, but is only temporary support or resistance. The 78.6% retracement is typically the maximum retracement for a correction. If a market closes above the 78.6% retracement, typically it is not making a correction, but will continue to trend to a new high or low. Alternate price projections. Qualify internal retracements. Alternate price projection, AP, is the second method for dynamic price strategies. An alternate price projection compares swings that are in the same direction, alternate swings, while a retracement compares sections that are in opposite directions. The ratios used for alternate price projections for a corrective structure are 0.6118, 1.00, and 1.62. The ratios used for a trend structure are 0.382, 0.618, and 1.00. Let's first look at alternate price projections in a corrective structure. Figure 4.4 shows the APs on a USD-JY daily chart. The objective is to identify a probable target for the next swing up that may complete an ABC correction. Swing OA is measured. It is proportioned by 0.618, 1.00, and 1.618. And these proportions of swing OA are projected from the B low. Each AP is labeled on the chart with the price of the ape, the type of projection, and the ratio used. We are only interested in potential targets above the A high. The 0.618 ape is below the A high, so is not relevant. Most corrective highs are made at or very near an APHIP. If most corrective highs are also made at or very near an internal retracement, a corrective high is likely near the INRET that is near an AP. In other words, if an INRET and an AP are near each other, they form a relatively narrow range zone from where a corrective trend reversal is probable. The AP points to which INRET is likely to be the corrective high or low in advance. Figure 4.5 is the same data as the previous figure, but includes the INRETs along with the APs. The 100% AP is just a few ticks above the 50% retracement, labeled Zone 1. The 162% AP is so close to the 78.6% retracement for Zone 2 that the numbers can't be read. There are no APs near the 61.8% retracement. With no APHIP near the 61.8% retracement, more than likely, the 61.8% retracement will not be significant resistance or end the corrective rally. If the JY is making a corrective rally, it is likely to end near either the 50% retracement or the 78.6% retracement, and not near the 61.8% retracement. The 100% AP is the most frequent AP target where highs and lows are made, so the odds are a corrective high would be made near 117.66 to 118.114, Zone 1, which includes the 50% retracement and the 100% AP. If the JY continued higher beyond this zone, it would likely continue all the way to near the 78.6% retracement before a corrective high would be made, bypassing the 61.8% retracement. Figure 4.6 is the alternate price projection menu from the Dynamic Trader software. Like the retracement setup menu, any ratio may be used and projections may be made from swing ranges, high-low, or closes, and by price range or percentage change of price. Your trading software should have similar choices. In some software, this routine is called extensions instead of alternate price projections. Extensions is not a properly descriptive term, but as long as you are able to make a projection from 3 points, 2 points to measure the range, and make the projections from a third point, you will be able to accomplish the same thing. Alternate price projections are an equally important price strategy as retracements. Be sure you are using trading software that allows you to make these key price projections. Let's make a short review of the key price factors you've learned to be sure you have the concepts down cold before we continue. Most corrective highs and lows are made at or very near one of the 4 key internal retracements. The most likely retracement for a corrective high or low is a retracement that has one of the 3 key alternate price projections near it. In other words, the APP helps to identify in advance which retracement is likely to be the price target to complete the correction. The focus is always on the 100% alternate price projection. The retracement and alternate price projection often result in a relatively narrow range zone for trend reversal. If an APP does not fall relatively near a retracement, it is not significant for other than minor support or resistance, and the focus for a corrective high or low is on the retracements. Figure 4.7 shows another ABC correction which made a bottom right at the narrow range zone that included the 61.8% retracement and 100% A. The 106.62% APP was far from the 78.6% retracement, which suggested in advance that the most probable target for a corrective low was near the 61.8% retracement. Once again, I could take up a lot of space and amaze you with dozens of examples of corrective highs and lows made right at the narrow range zones, created by a retracement and alternate price projection. My objective is not to impress you with a myriad of perfectly executed after-the-fact examples, but to teach you how to do it. The objective has been to show you how the alternate price projections are made and how they often identify in advance which retracement level is likely to complete a correction. There will be many more examples of how to use the internal retracements and alternate price projections later in this chapter, and especially in Chapter 6. Needless to say, often the alternate price projections do not fall near a retracement to create a narrow range target zone, but when they do, the odds increase significantly that a narrow range zone made at the confluence of these 2 important price projection techniques will complete a correction and offer a great low-risk trade setup. Always remember, the objective is to identify conditions with a high probability outcome and acceptable capital exposure, not to trade any particular market all of the time. Focus on being a successful trader and not on trading activity. Focus on having the patience to only consider a trade when the conditions are optimal. More alternate price projections. Figure 4.8 is the S&P mini futures contract of 60-minute data. The period shown is a bear trend, and I've labeled the pivots from 0 through 4. Alternate price projections can help to identify the probable high or low price target for a trend, just as they were used in previous examples to help identify the high or low price target for a correction. The chart shows the 100% ape of the 2 completed bear sections, 0 to 1 and 2, 3, projected from the 4 high. Frequently, a high or low is made at or very near the 100% API of a past section within the trend structure. Sometimes all of the sections are approximately the same length and price. We always want to be aware of the 100% apps of each prior trend section. The 100% apps by themselves are not enough for high confidence price targets. Other price projections should fall near them to create a relatively narrow range zone with 2 or more of the key projections near each other. Figure 4.9 is the same ACE 60-minute data with different alternate price projections. On this chart, I've measured the range from the 0 pivot high to the 3 low, proportioned it by 38.2% and 61.8%, and projected from the 4 high. The 2 projections shown on the chart are the result. These 2 apps can also be described as the 38.2% and 61.8% apps of the range of waves 1 through 3, projected from the wave 4 extreme. A trend wave 5 is often made at or very near one of these 2 apps. Figure 4.10 includes both sets of projections shown on the previous 2 charts. The 100% app of 0 to 1 from 4 and the 61.8% ape of 0 3 from 4 are only 1 point apart, which is why the labels overlap each other and are difficult to read. The narrow range price zone where these two projections coincide at 4104.50 to 4105.50 is a high probability price zone for the next pivot low and potentially to complete the bear trend. Figure 4.11 is the EUR/USD 15-minute data and shows another use for alternate price projections. Corrections within a trend are often very similar in price range. The chart shows the 100% apps of the A, B, and C, D corrections projected from the E-pivot high. The prior two corrections were similar in price, so the two 100% apps made a relatively narrow range target for another minor correction. The next minor corrective low was made right in the target range, and the EUR/USD then continued to a new high. Most market reversals are made at one or more proportions of prior sections of the trend or correction. Don't ask me why markets have this symmetry over and over again in all actively traded markets and all time frames. The why isn't relevant. The fact that it happens over and over again provides the basis of the dynamic price strategy, where we proportion the various sections of the trend or correction, make the projections, and identify if there is a narrow range price zone that includes at least 2 or 3 projections. The beauty of this approach is we are working with a relatively limited number of key projections and ratios, which allow us to identify in advance probable support, resistance, and, best of all, trend reversal. The alternate price projections, corrective sections, 61.8%, 100%, and 162%. Trend sections, 38.2%, 61.8%, and 100%. The most frequent app of a corrective structure is the 100% app. Be very alert if a correction reaches a narrow range zone that includes one of the key internal retracements and the 100% app. Corrective sections rarely exceed the 162% app. The 38.2% and 61.8% apps for trend targets are used to project the range multiple sections, such as waves 1 through 3, from a wave 4 high or low of a potential 5-wave trend. External retracements help identify the final section of a trend or correction. There is a second type of retracement that many traders do not use but should. An external retracement, XRET, is greater than 100%. The ratios usually used are 1.27, 1.62, and 2.62, and are often shown as percentages rather than ratios. XRETs are made just like the more familiar INRETs. The external retracements are most useful to identify the final section of a trend or countertrend, such as a wave 5 of a 5-wave trend, the wave C of an ABC correction, or the final section of complex correction. Of course, we never know for sure if a market is making the final section of a trend or countertrend, but if the pattern conditions have been met such that it could be the final section, the external retracements are an important factor to help identify the probable price target for trend reversal. Figure 4.12 is the same USD/JY daily chart used in an earlier app example, but only shows the 3 external retracements. The 127%, 162%, and 262% external retracements are shown for the AB range. The 2 most typical XRETs where a trend reversal is often made are the 127% and 162%, which we always focus on. In this example, the 262% XRET is above the high of the bear trend section, so it is not relevant to identify the end of a correction for this data. Let's add the INRETs and apps to the chart to see if there are 1 or 2 relatively narrow range zones that ideally include 1 each of the 3 sets of projections. Figure 4.13 is the same USD/JY daily data. I've zoomed in a bit so it will be easier to see the labels for the projections. The chart includes all 3 types of price projections you have learned so far: internal retracements, alternate price projections, and external retracements. I have labeled 3 relatively narrow range price zones that include at least 2 projections. Zone 1 includes the 50% internal retracement, 100% alternate price projection, and 127% external retracement. Zone 1 is the only zone to include 1 projection from each of the 3 sets. Therefore, Zone 1 is the most probable target for an ABC corrective high. Figure 4.114 shows that the corrective high was made in Zone 1, followed by a decline to a new low. External retracements are used primarily to help identify the end of the last section of a correction or trend. The preceding examples have shown how they are used to help identify the end of the last section of a possible correction. The next example, figure 4.15, shows Dow Jones Industrial Average, DJIA, daily data and how the last section of a 5-wave trend was made right at the 162% XRET of the wave 4 correction. Figure 4.16 is another example of a low in the 60-minute EUR USD made at the 162% XRET. Not every trend ends with just 5 sections, as you learned in Chapter 3, but many do. If a market has met the guidelines to have completed 4 sections, always include the 127% and 162% external retracements of the potential wave 4 as probable price targets to complete a wave 5. External retracements. The ratios usually used for external retracements are 127%, 162%, and 262%. External retracements are important to help identify the final section of a trend or counter trend. External retracements are not used on their own for price targets, but to confirm an alternate price projection and/or internal retracement. Pattern price targets. In the past 20 years, I've identified the most consistent price targets typically reached for each of the most frequent E-wave patterns. I call this approach end-of-wave, EOW targets. In Chapter 3, I focused on just the 2 most frequent patterns for all markets and all time frames, the ABC correction and 5-wave trend patterns. Of all the potential patterns, they are the simplest, most useful, and most reliable patterns to project the specific price target where they will complete. Many traders who have learned from my practical trading educational material over the years focus on just these 2 patterns for all of their trades. You might also consider specializing in just 1 or 2 types of very high probability setups for your trading as well. You may have fewer trade setups, but like specialists in other businesses, there is a good chance your success will be greater. While many corrections make a pattern other than an ABC, if the minimum conditions for an ABC have been made, it is essential to consider the potential for an ABC and project the price target for a wave C. While many trends do not complete with 5 sections or waves that meet the guidelines for an E-wave 5-wave trend, if 4 sections are complete that meet the guidelines for a 5-wave trend, it is essential to make the price projections for a possible wave 5, which may complete the entire trend. This does not mean that the dynamic price strategies are not useful for any other pattern structure. Later in this book, I include lots of examples of how all the trade strategies are useful for non-3-wave ABC corrections and non-5-wave trends. Since the 3-wave ABC corrections and 5-wave trends are so prevalent in all markets and all time frames, we will focus on making the high probability end-of-wave EOW price targets for each of these patterns. ABC price targets. A simple ABC correction is a frequent type of correction. An ABC correction is also called a Gartley pattern. It has well-defined minimum guidelines to recognize if 2 sections are complete. Once 2 sections are complete, waves A and B, there are very specific price strategies to help identify the EOWC price target. The probable end of wave C price target is identified in advance, mimicking 3 sets of projections you have already learned. In fact, a couple of the earlier examples used projections for an ABC price target. We can never know for sure if a market is making a correction. What you are going to learn to predict the probable price target if the market is making an ABC correction. End of wave C price target projections. In RETs of prior trend, 38.2, 50, 61.8%, and 78.6%. Apps of wave A, 61.8%, 100%, and 162%. X-RETs of wave B, 127%, 162%, and 262%. The ideal target zone for a wave C includes 1 projection from each of the 3 sets. INRETs are first in the order of importance of the 3 sets of projections, since most corrections end near one of the 4 INRETs. The second most important are the APEs. The third most important are the XRETs. A high probability wave C target zone should include an INRET and an APE. When the 3 sets of projections are made, the ideal target zone will be a relatively narrow range zone that will include 1 projection from each of the 3 sets. The order of importance of the 3 sets of projections is INRETs, APPs, and XRETs. A target zone should include at least 1 INRET and 1 APP. Figure 4.117 is the EUR-USD daily data and shows all 3 sets of projections. At first glance, it would seem there are so many price lines on the chart. that a low will inevitably be at or very near one of them. You are correct in thinking this. The big question is, can we identify in advance the probable target to complete a corrective ABC low out of the many targets shown? The answer, of course, is yes. Two zones in figure 4.17 contain a relatively tight grouping that includes one projection for each of the three sets. Zone 1 includes the 50% INRET, 62% AP, and 127% XRET. The last daily bar on the chart is a wide range bar that took out the wave A low and closed below Zone 1, all in one day. Zone 1 would not be relevant. Zone 2 includes the 62% INRET, 100% API, and 162% XRET. If the EUR/USD is making an ABC correction, the probable target for a wave C low is the Zone 2 range. The bottom three projections do not provide a relatively tight grouping for a potential support zone. Of 10 separate price projections, we are able to identify in advance which relatively narrow range zone is likely to complete a corrective ABC low. We never know in advance if a market is making a correction, but we often make assumptions as to whether it is, based on the larger timeframe momentum, price, pattern, and time position. We never know if a correction will be a simple ABC or something more complex, but we always assume a correction will be at least 3 sections. We can make completely objective price projections and identify relatively narrow range price zones based on the 3 sets of price projections, with the focus on the internal retracements, and be prepared in advance for the high probability price target to complete an ABC correction. If a market reaches that zone, it has met the price conditions for a probable reversal. Trading, like every other business, requires that you identify what you know, what you don't know, and what is probable. This is the information from which decisions are made. Figure 4.18 is the Gold Silver Mining Stocks Index, XAU, daily close data. All 3 sets of projections have been made for the probable wave C price target, the one relatively narrow range zone that includes one projection from each of the 3 sets is circled. If the XAU is making an ABC correction, this is the zone where a wave C low is likely to be made, based on daily closing data. For these last 2 ABC price target examples, I have purposely not shown the outcome. The objective right now is for you to learn how to make the projections and identify in advance the high probability target zone, S, near one or more of the key retracements. Once you are able to do this, you are set to be prepared for a corrective trend reversal for any market and any time frame. I have been making these trend reversal target zones for almost 20 years. We do it virtually every day in our daily DT futures, stock ETF, and Forex reports on most of the major markets, from intraday to monthly data. Once you incorporate these dynamic price strategies in your trading plan, you will be amazed at how often reversals are made at the trend and correction price targets that you have projected and for which you are prepared in advance. I've often had students over the years initially complain that it is too much work to make all the projections to identify the probable support resistance and trend reversal zones. My answer has always been, if you're not willing to do the work necessary for the information you need to make a trade decision, you have no business with a trading account. In recent years, wannabe traders have a distorted view of what it takes to be successful in the business of trading because of all of the trading software available and scam system sellers. No specific software or system will make you a successful trader. Powerful computers, comprehensive trading software, and inexpensive data have not made anyone a trading success. All that each of these can do is provide you with the information you need to make trading decisions more quickly and accurately. They will never be the cause of success. Only your own work, knowledge, and experience can result in trading success, the same as with any other business. End of Wave 5 target zones. As you learned in Chapter 3, a 5-section trend is the most frequent trend pattern. Not all trends complete in 5 sections that meet the E-Wave guidelines you learned in Chapter 3, but whenever 4 sections are complete, you should always anticipate the trend is likely to be complete once the 5th section is complete. Over the years, I have identified the key price targets where a Wave 5 is usually complete. It happens over and over again, as we demonstrate daily in our DT reports. So be sure and make these projections and identify the narrow range EOW5 target zone whenever 4 sections are complete. End of wave 5, price target app of waves 1 to 3 from wave 4, 38.2%, 61.8%, and 100%. APEEP of wave 1 from wave 4, 100%. XRED of wave 4, 127%, 162%, and 262%. The ideal target zone for a wave 5 includes one projection from each of the 3 sets. The order of importance of the 3 sets of projections is the 38.2% or 61.8% of waves 1 to 3, the 100% APE of wave 1, and the 127% or 162% XRET of wave 4. The 100% APE of waves 1 to 3 and the 262% XRET of wave 4 are rarely met except for commodity market fifth wave extensions. Figure 4.19 is the ES 60-minute data used for an earlier alternate price projection example. I have made the 3 sets of projections for the EOW5 price target on the chart. The 3 sets of projections are 1. The 100% APE of the range of wave 1, 0 to 1 from the wave 4 extreme. 2. The 38.2% and 61.8% APEs of the range of waves 1 to 3, 0 to 3 from the wave 4 extreme. And 3. The 127% and 162% XRET of the range of wave 4, 3 to 4. There is one very narrow range zone that includes one target from each of the 3 projections, 1404.50 to 1405.50. This zone includes the 100% APE of wave 1 from the wave 4 high, the 61.8% APIP of waves 1 to 3 from wave 4, and the 162% XRET of wave 4. If the ES continued to decline and reached 1405.50, we would be very alert to any momentum or pattern reversal signal for a potential wave 5 low. How did it turn out? That is not important at this point. What is important is that you learn how to make the EOW5 price targets whenever 4 sections are complete. It would be easy to show you dozens of after-the-fact examples that worked out perfectly, but we need to take this one step at a time. As you progress through the book, you will learn how to integrate the momentum, pattern, and time position with practical, low-risk trade strategies from entry to exit to take advantage of this critical information. Figure 4.20 is Costco daily data and another example of a high-probability EOW5 target zone. The 3 sets of EOW5 projections were made. The 71.66 to 72.56 zone includes one projection from each of the 3 sets. As of the last bar on the chart, Costco is only a couple points from that zone. While Costco had a strong bull run for 3 months and made a new high as of the last bar on the chart, a trader should be very alert that the upside may be very limited and a significant decline may be forthcoming. In this section, you have learned to identify in advance the probable price target S for the 2 most frequent patterns, the ABC correction and 5-wave trend. Don't fail to be prepared for a possible wave C high or low if 2 sections of a probable correction are complete, and for a possible wave 5 high or low if a trend has completed 4 sections. You will find that these end-of-wave and dynamic price strategies will be a very important factor of your trading plan and will give you a huge edge for your trade strategies and trade management. Price, pattern, and momentum. If price strategies were able to pinpoint the exact support, resistance, or trend reversal at every market reversal, that is all we would need to make a trading decision. While the dynamic price strategies you learned in this chapter are the most quick, easy, and reliable of any price strategy I have devised or seen from other traders or educators for the past 20 plus years, not every high and low is made right on a key price target identified in advance. If we don't make trade decisions based solely on the price position, how do we use these support, resistance, and trend reversal strategies as part of a complete trading plan? In the previous 2 chapters, you learned about the momentum and pattern factors. I want you to see how we are building up a complete trading plan, step by step in each chapter. So let's take a look at just a couple of examples of how the momentum, pattern, and price factors all work together to set up conditions for a high probability trade. Figure 4.21 is the XAU daily close data that was used earlier to illustrate the price projections for an end of wave C target. I only showed 2 of the projections that are part of the target zone, so you can clearly see the price labels on the chart. Note the C that is just after the description, XRET and RET on the price lines. When a price projection is made from closing data in Dynamic Trader, the C for close is included in the price line labels. The decline was recognized as a potential ABC correction. XAU reached the wave C price target, which was identified in advance. 2 days after the XAU tagged the end of wave C price target zone, the daily momentum made a bullish reversal from the oversold zone. Pattern, price, and momentum conditions had all been made to complete a wave C corrective low, which should be followed by an advance to a new high. As of the last daily close on the XAU chart, we don't know if the XAU has made an ABC corrective low. For all we know, the XAU may immediately continue to decline to a new low or work out a complex correction. What we do know is the XAU has met the minimum pattern conditions typical for a correction, 3 sections. It has reached the ideal wave C price target zone, and the daily momentum has made a bullish reversal. Remember, we trade what we know. We know the conditions are in place for a high probability outcome with acceptable capital exposure. You don't need any fancy and expensive trade management software or spreadsheets to know that the initial capital exposure for a long trade would be just 2 to 3 points, the difference between the last bar's close and the lowest daily close so far, and the potential gain, 35 points or more, to above the high on the chart where the potential correction began. If these conditions were in place, would it seem like a worthwhile trade to you? If it doesn't, close the book now, go out and play golf or whatever you do for fun, and come back later when you've gained some sense and understanding about what the business of trading is all about. Figure 4.22 is the ES, or S&P Mini 60-minute futures data that was used to illustrate the end of wave 5 price targets earlier. You might remember that the 3 key targets all fell within less than 2 points of each other for a high probability target zone. Only the 100% app is shown on this chart, so it can be easily read. As of the last bar on the chart, the S&P has reached the high probability price target for a wave 5 low and made a bullish momentum reversal on a bullish momentum price divergence. This is an ideal setup for a long trade with minimal capital exposure and a lot of upside potential. Once again, what do we know? We know the pattern, price, and momentum are all in a position typical to complete a 5-wave trend low. We know the downside is relatively limited to find out if a low is complete and the upside is substantial. We don't know if the S&P has made a trend reversal low that will be followed by a substantial advance. The S&P may continue lower. However, we have identified conditions with a high probability outcome and acceptable capital exposure, the objective of all trade plans. That is what trade setups are all about. These have been just a couple of examples to give you a preview of how the momentum, pattern, and price factors are each used as part of a trading plan. You will see lots more in chapters 6 and 7, plus specific entry to exit plans. We'll get there before long, but first you will learn about the time factor in the next chapter. No excuse. 20 years ago, I used to do all of the price strategies you learned in this chapter with hand-drawn charts and a calculator. Then I graduated to spreadsheets. In the late 1980s to mid-1990s, there were only 1 or 2 trading programs that could do the retracements and alternate price projections and allow the user to include any ratio they chose. I used the best one until its development and distribution was discontinued. I decided to design my own charting and trading software, so all of the routines would be complete and easy to use, and would properly display the output on a chart. In the late 1990s, I released Dynamic Trader version 1 with many routines not found in any other trading software. Today, many charting programs have caught up with more complete price functions that will allow you to do the retracements and alternate price projections with any ratio you choose. If yours doesn't, find one that does. The cost of the proper trading tools is minimal to the business of trading. So, you have no excuse not to have the right tools to provide you with the best information to make trade decisions. If you are interested in only a few markets, knock yourself out with hand-drawn charts and a calculator. I did for years. However, there is one type of software to avoid like the plague. A few programs are available that claim to make support, resistance, and trend reversal price targets automatically. Like software that makes Elliott wave counts and system software, they cater to the inexperienced, unknowledgeable and lazy wannabe traders who believe a software program can automatically give them buy-sell signals. These auto price target systems must make assumptions based on the data that can lead you into big trouble, because not all the variables can be programmed. Since a software program is nothing but instructions to a glorified calculator, the computer, the quality of the output is limited to the quality of the input algorithms. As the late Bruce Babcock, editor of the Commodity Trader's Consumer Report, said, "You can't buy success." If you want to be successful in the business of trading, you have to take the time to gain the education and experience and make your own decisions. Sounds like every other business, doesn't it? That's because it is. If you are willing to learn to make logical decisions based on relevant information, you have a good chance to become a successful trader. If you believe you can buy success through a trading system or any sort of automatic price or time system, find a deserving charity for your trading funds instead of donating them to the educated, serious, and successful traders. Because if you think you can buy success, you are in for a very expensive lesson. Up to now, we have been primarily concerned with identifying conditions for a trade entry. In later chapters, you will learn about specific objective entry strategies, stop loss adjustment, exit targets, and more as part of a complete trading plan. We are taking it one step at a time. It is time to learn about the fourth and final technical factor of the trade plan, market timing. Chapter 5, Beyond Traditional Cycles. In this chapter, you will learn how to project in advance very narrow range time targets for support, resistance, and trend reversal for any market condition. The dynamic time strategies you learn will put you miles ahead of traditional cycle analysis with timing tools for practical trade strategies. When most traders think of market timing, they think of traditional cycle strategies. Traditional cycle strategies project a low or a high based on an average length of low to low or high to high cycles of past data. This type of cycle analysis makes assumptions that usually prove to not hold up in reality. Traditional cycles are based on an average cycle length. An average cycle length is usually pretty useless because it does not consider how tight or widespread the range of numbers is that make the average. If most of the cycle repetitions that were used to come up with the average cycle were tightly grouped, the average would be useful. Unfortunately, an average can be made of any series of numbers which may be widely dispersed. The average may be meaningless to predict the next repetition. Traditional market cycle analysis also assumes a cycle length is static, and the static cycle will continue indefinitely into the future. It just doesn't work that way. Price and volatility cycles change over time. What might have been a fairly regular cycle in the past may no longer be evident in recent market activity. Cycles are not static, but dynamic. The typical low to low or high to high cycle lengths are generally different for bull and bear markets, and will fluctuate over time as volatility and price cycles fluctuate. Plus, markets generally make their highs and lows at dynamic proportions of past trends and counter trends. Just as you discovered in Chapter 4 that most trend and corrective highs and lows are made at or very near proportions of recent sections of the trend or correction, a similar approach to dynamic time proportion will help identify time targets for reversal. In this chapter, you will learn a logical and practical approach to time target analysis that I have developed over the past 20 years. I have taken the dynamic time strategies from a very complex to a simplified approach that every trader should make a part of his trading plan. In many cases, you will be able to identify in advance high probability, narrow range time targets of just 3 to 4 bars for trend reversal for any market and any time frame. Let's begin by learning about time retracements. Time retracements and corrections. Time retracements are made in the same way as price retracements, except time units are used instead of price units. If most corrections are made at or near one of the key price retracements, why shouldn't they also be made at or near a time retracement? That is a question I asked myself many years ago when studying Gann price and time strategies. Gann price and time analysis often seems very complicated, but for the most part, it boils down to a simple concept. Most highs and lows are made in proportion to one or more previous sections of the trend or counter trend. In Chapter 4, you learned how to make price retracements and alternate price projections to help identify in advance the probable price target for support, resistance, and most important, reversal of trends and corrections. If most reversals are made at or very near the key proportional price target zones, shouldn't they also be made near key proportional time target zones? Over the past 20 years, I have found this to be the case. Time retracements are made just like price retracements, but on the time axis, and they use some of the same ratios used for price retracements. The ratios for time retracements are 0.382, 0.50, 0.6118, 1.00, and 1.618. In most cases, we just use the 0.382, 0.618, and 1.00 proportions to help identify time targets for corrections. The ratios are often expressed as percentages, just like with price retracements. Figure 5.1 is daily XAU data. From mid-August to early November, the XAU made a strong bull trend for 58 trading days. The date time range label above the high on the chart shows the top was made November 7, 2007, 58 bars, or trading days, from the August 16 low. As of the last bar on the chart, the XAU has made a sharp decline. Along the bottom of the chart, the 0.382, 0.6118, and 1.00 time retracement dates are shown. The 58-bar bull trend was proportioned into the 0.382, 0.6118, and 1.00 ratio segments, and the results projected forward in time from the November 7th high. The time retracements were made in the exact same way as price retracements. The number of time units of the bull or bear trend is measured, then proportioned by the time retracement ratios, and the results are projected forward in time from the last bar of the bull or bear trend. A correction to a bull or bear trend is usually complete in the 38% to 62% time retracement zone. With internal price retracements, we look at a specific price for each retracement. With time retracements and corrections, we first look at the relatively broad 38% to 62% time retracement zone as the high probability target where a 3-section correction is usually complete. This simple piece of information itself, the 38% to 62% time retracement zone for a simple correction, is very useful. If a market is making a correction, it will probably not be complete prior to the 38% time retracement, and it will probably be complete by the 62% time retracement unless the correction develops into a complex structure. If a market is correcting into a price target and momentum reversal, but has not reached at least the 38% time retracement, more than likely the best to expect is temporary support or resistance. It is not likely to complete a correction. If the correction reaches price or momentum support and is in the typical time retracement zone for a correction, the setup is complete to make a corrective high or low. Figure 5.2 is the menu for the time projection ratios using two dates function in the dynamic trader software. It looks similar to the price retracement ratios function. This function is used whenever time projections are made using any 2 points. The time range between the 2 points is measured, proportioned by the ratios the user chooses, and projected forward from the second point. The time projections are shown along a horizontal line on the chart with the ratios and target dates, as shown in Figure 5.1. If your software does not have the ability to make these types of time projections, they can easily be done with a spreadsheet for daily data. That's how I made them for years. It is not so easy to make intraday time projections using a spreadsheet, so if you want to do this type of time analysis, you should use trading software that allows you to make the projections on a chart, or stick with daily data for the longer time frame trends. The 38% 62% time retracement zone may be a fairly broad time range. Are there other time factors that may narrow a relatively broad time zone to pinpoint the probable time target for a corrective high or low? Alternate time projections are the second time factor. Sound familiar? They are made in the same manner as the alternate price projections, but on the time axis instead of the price axis. Time retracements 38.2%, 50%, 61.8%, 100%, 162%. Most simple 3-section ABC corrections are complete in the 38.2 to 61.8% time retracement zone. If a correction makes a complex structure, the maximum time retracement typical to complete the correction is the 100% time retracement. Alternate time projections. Narrow the time retracement range. Alternate time projection, or ATP, is the second time factor for dynamic time strategies. An ATP compares the time range of swings that are in the same direction, in the same manner that alternate price projections pair alternate price swings. The ratios used for alternate time projections for a corrective structure are 0.618, 1.00, and 1.618, the same ratios used for alternate price projections. Let's see how an ATP is made. Figure 5.3 is the same daily XAU data used for the time retracement example, except I'm only showing the data from the November high. The time range from O to A is measured, 8 trading days, proportioned by the 3 key ATP ratios, and the results projected from the potential December 11th wave B high. The 3 alternate time projections are shown on the chart. Typically, all 3 time projections are shown on one horizontal line. Since in this case, the 3 projections are fairly close to each other, and the labels would overlap each other if shown on the same line, I've made each projection separately and stacked them so the results can be easily displayed and read on the chart. The 62% ATP should be the minimum time target for the third swing in a 3-section ABC correction. In this case, it falls on December 18th. The 100% ATP is the most frequent ATP target where a wave C is made. In this case, it falls on December 21st. The third section of a correction will usually not exceed the 162% ATP, which in this case is December 31. We've accomplished 2 important things by making the 3 alternate time projections. We've established the probable minimum and maximum time target for the third section of an ABC correction, and we are able to eliminate any of the 3 ATPs that fall outside the 38.2 to 61.8% time retracement zone. Time retracements and alternate time projections work together in a logical manner to help identify specific time targets to complete a correction. Figure 5.4 shows the time projection ratios using 3 dates menu. The user may choose any set of ratios. The time range of the first 2 data points is measured, and the proportions are made from a third data point. The 3 ATPs give us a minimum, probable, and maximum ATP to complete the third section of a correction. By themselves, they provide useful timing information. When used with the time retracements, they provide even more important information. Figure 5.5 is the same XAU daily data with both the time retracements and alternate time projections shown on the chart. The first important thing to note is that all 3 of the alternate time projections fall within the December 11 to January 2nd 38% to 62% time retracement zone. The minimum 62% ATP is December 18th, and the maximum 162% is December 31st. So right away, the target zone for a corrective low is narrowed by several days from the time retracement zone. Because the 62% ATP is December 18th, more than likely a corrective low will not be complete prior to December 18th, and typically would be complete around December 21st, the 100% ATP. The maximum time target to expect a wave C low is December 31st, the 162% ATP. So far, you can see how time retracements and alternate time projections work together to help identify a time target in the same manner as price retracements and alternate price projections. They are both made in the same way using price units or time units. Alternate price projections qualify which price retracement is likely to be where support, resistance, or trend reversal is likely to be made. Alternate time projections help to narrow a relatively wide time retracement zone to a narrower time target for reversal. Let's add one more time factor and see if it will help us to narrow the time range for a corrective low even more. More time factors. There are several other possible time factors or proportions of prior sections that can be made. The most important is the recent high-high or low-low cycles. If projecting for a possible low, the time range of recent lows will help to identify when the next low is probable. If projecting for a possible high, the time range of recent highs will help to identify when the next high is probable. This approach is similar to traditional cycle analysis, but focuses on the most recent few cycles, particularly the last completed cycle. Figure 5.6 is again the same XAU daily data. The chart shows the most recent 100% low-to-low projection on December 19th. Since the last several low-to-low cycles have been in the 16 to 20-day range, a low around December 19th is probable. If the recent cycles have been in a relatively tight range, project the range forward from the last completed high or low for a time range when the next low is probable if the recent time rhythm continues. Figure 5.7 shows the recent low-to-low time range projected forward from the last completed low. If the recent low-to-low time rhythm continues, the next low is probable in the December 13 to 19 period. The time target zone. It may seem like there are projected dates all over the place, but there is method to the madness. All of these time projections are not just a bunch of random dates without specific meaning. Each set of projections provides a unique piece of information. There is a logical progression arriving at a probable time target based on all of the projections. We initially assume a correction will be at least 3 sections, or a simple ABC. It may not turn out that way. A correction may eventually continue to a complex corrective pattern, but we never know that ahead of time. We make an assumption based on the minimum expectations. Most 3-section corrections are complete in the 38.2% to 61.8% time retracement zone. That is our first focus of attention. This time zone can be relatively broad, depending on the time range of the prior trend. The objective is to use the alternate time projections and low-low or high-high time projections to help narrow the relatively broad zone. Once 2 sections of a potential correction are complete, the 62% and 162% alternate time projections may be made. The next swing low and potential end of the correction is likely to fall on or very near one of the 3 key ATPs. Any of the 3 ATPs that fall outside the time retracement zone are eliminated. Next, make the 100% low-low or high-high projection. If the recent low-low cycles have been in a relatively narrow range, the next low is likely to fall near the 100% low-low projection. You can also make projections for the minimum to maximum range of the recent low-low cycles if they have been in a relatively tight range. The most recent cycle is the focus. Each set of time projections has a specific reason and purpose. Each is a logical proportion of prior sections. We begin with the broad time retracement range and narrow the time range with the position of the ATP and cycle projections. If a relatively narrow time range is made from the 3 sets of projections, it is a high probability time target to complete a corrective low. Does this approach sound familiar? It is the same basic approach used with the dynamic price strategy to identify in advance the probable price zone or zones for a corrective high or low. Figure 5.8 includes all 3 sets of time projections. I realize the chart is a bit crowded, showing all 6 projections together, but let's see how we can make a logical choice for a probable time target for a wave C if the XAU is making an ABC correction. The last bar on the chart has made a new low on December 17 from the November 7 high. The XAU has already reached the December 11 to January 2nd, 38% to 62% time retracement zone. So far, so good. The 3 alternate time projections range from the 62% on December 18th to the 162% on December 31st, with the 100% ATP on December 21. Because the 62% minimum ATP and 100% typical ATP are only 3 days apart, we should focus on the December 17 to 22 period. 1 bar plus or minus these 2 ATPs. They are too close together to focus on each individually. The 100% low-to-low projection is December 19th, right in the middle of the ATP projections. The ATPs and the low-to-low cycle projection have narrowed the relatively broad time retracement zone to December 17 to 22, a 4 trading day range, with a weekend included, when a wave C low and possible end of a corrective decline is probable. This is powerful information based on the actual time range of sections of the recent trend and possible correction, not based on so-called historic cycles, which are likely to no longer be relevant to recent market trends and volatility. Figure 5.9 shows how it turned out. A wave C low was made on December 18th, right in the December 17 to 22 time target for a low, which was projected in advance. The XAO reached a price target for the low where the 50% price retracement and 62% alternate price projection coincided, also projected in advance, and where the daily momentum was oversold and made a bullish reversal 2 days after the extreme low in price and time. Time, price, pattern, and momentum were all pointing to the same thing. A probable wave C low and an ideal setup for a continuation of the bull trend to a new high. Is every corrective low made in the 38 to 62% time retracement zone? No, but most simple corrections are. At the least, this range gives us the typical minimum time target for a corrective low, a very valuable and practical piece of information by itself, to warn us that a new low made prior to the 38% time retracement is not likely to complete a correction. Is every simple corrective low made at one of the three alternate time projections? No, but most are, so they are very valuable to help identify when a corrective low is probable. Is every corrective low made at the recent 100% low-to-low or high-to-high projection? No, but many are, particularly if several of the recent low-to-low cycles are in a relatively narrow range. The dynamic time strategy is used in a logical sequence of time projections to narrow a relatively wide time target zone to a narrower zone, sometimes as little as just 2 or 3 bars. This same strategy is used on all actively traded markets and all time frames. So far, we've used one example of a simple ABC correction to illustrate the whole process. The dynamic time strategy is used for all market conditions, not just simple ABC corrections. We never know in advance what form a correction may take. For that matter, we don't even know for sure if a correction is being made or a new trend. But if the larger time frame trend analysis suggests a correction is being made, the first assumption is it will be at least 3 sections. If it continues beyond 3 sections, don't despair. The dynamic time strategy will still help provide the time target to complete the correction. Let's take a look at a couple of more examples. Figure 5.10 is 15-minute EUR GBP data covering less than 2 days of data. I don't want to encourage day trading. In the final chapter, you'll read my thoughts about day trading and why most traders should avoid it. But even if you're not a day trader, you can use intraday setups to position yourself for a swing or position trade. The EUR GBP made a 5-wave decline to the low on the chart test, followed by a choppy advance. The advance had overlapping sections, which warns it is probably some sort of complex corrective advance and not a new bull trend. The objective is to identify the probable time target to complete a corrective high. The top horizontal line shows the 62% and 100% time retracements. The advance has already gone beyond the 38% to 62% time retracement zone, which is the typical time target for a 3-section ABC correction. Most complex corrections will be complete by the 100% time retracement. This is logical. The time range of a corrective section will usually not exceed the time range of a trend section. The 100% time retracement is just a few bars past the last bar on the chart. A corrective high should be complete soon. The 100% high-to-high projection is just a couple of bars past the high made as of the last bar on the chart. Another sign a high is due soon, if not already complete. The alternate time projections are not shown with the horizontal lines like in previous examples because it would crowd the chart. However, the last 2 low-to-high time counts were 5 and 7 bars. The last high shown on the chart was 8 bars, which is just 1 bar beyond the most recent alternate time projection of 7 bars. This is another time factor that suggests at least a minor high is at or near completion. If the EUR-GBP is making a corrective rally, as the overlapping pattern suggests, the corrective high should be complete within the next few bars, if it is not already complete as of the last high on the chart. Consider the logic of the time factors. The 100% time retracement of the 5-wave bear trend is just a few bars away. The 100% time retracement is typically the maximum time retracement for a complex correction. The 100% high-to-high cycle is just a couple of bars away. The last high on the chart is within 1 bar of the recent low-to-high counts, or alternate time projection. All 3 time factors suggest the corrective rally is at or near completion. If this is the case, the EUR-GBP should soon begin a decline to a new low, not just a minor decline. The pattern and time factors don't suggest merely a short-term high, but the final minor high of a complex correction that will be followed by a continuation of the bear trend to a new low. Is this valuable information you could use to make a specific trade strategy? You bet it is. Figure 5.11 shows what followed. The EUR-GBP tagged the 62% price retracement, made a momentum bearish reversal, and soon declined to a new low. The time factors didn't point to the precise 15-minute bar of the high. They did clearly warn the trader that the URGBP was within a few bars of the maximum time probable to complete a complex corrective high, and to prepare to establish short positions for a probable decline to a new low. Not just a short-term day trade, but a short position based on 15-minute data that would probably last at least several days and make a new low. While time factors often project a very narrow range time target to complete a trend or corrective high or low, their value is often to warn what is probable and not probable. In this case, they warned the trader the EUR-GBP was very near the probable maximum time for a corrective high, and to be prepared with trade strategies to take advantage of a probable decline to a new low. When the time position is considered with the pattern, price, and momentum position, the trader has a very powerful set of strategies for high probability trades with minimal capital exposure. Figure 5.112 is 15-minute ES, or S&P Mini futures data. If the advance off the low on the chart is a correction in a bear trend, what is the probable time target for a corrective high? With 15-minute data, we can often identify the time target for a corrective high within just an hour or two range. How helpful do you think this would be for your trading? Do you also see how it could be helpful to identify when to enter a position on a minor correction in order to hold a position in the direction of the larger timeframe trend? The chart shows the 61.8% time retracement, 9 a.m., January 8, typically the extreme of a three-section ABC correction, plus the 100% ATP, 9:15 a.m., January 8, and the 100% high projection, 2 p.m., January 7th. I've also added the 18-bar high-to-high count from the last high. Since the beginning of the bear trend shown on this data, the longest high-to-high count has been 18 bars. So we would anticipate the next high should be complete by the 18-bar count, 8:45 a.m., January 8. As of the last bar on the chart, the ES has already made a new high beyond the 100% high-to-high projection. All three of the other time factors fall within a 45-minute range, from the 15-minute bar ending 8:30 through 9:15. If the ES is making a three-section corrective rally, the probable time target to complete a corrective high is from 8:30 to 9:15 on the morning of January 8. Before we look at the results, once again consider the logic of how we use the three key time factors to identify a probable corrective high. We never know what form a correction may take, but the ES is in a position to complete an ABC, three-section correction. Typically, an ABC correction is complete by the 62% time retracement and near the 100% alternate time projection. The maximum recent high-to-high count has been 18 15-minute bars. All three of these time factors are within 3 15-minute bars on the morning of January 8th. If the ES continues to advance into this narrow range time zone, we would be very alert to the price and momentum position for a probable corrective high and a go short strategy for a probable decline to a new low. Figure 5.13 shows the outcome. The ES made a wave C high on the 8:30 15-minute bar, just one bar prior to the 3-bar range projected for a wave C high. The ES was at the 50% retracement with momentum overbought, an ideal time, price, momentum, and pattern setup to complete a corrective high, followed by a decline to a new low. Not every corrective high or low is made when all four factors of time, price, pattern, and momentum are in place for a reversal, but many are. Your job is to identify in advance the conditions with a high probability outcome and be prepared to take advantage of those conditions. That's the objective of all technical analysis and trade strategies. Figure 5.14 is IBM daily data. The advance up from the low has all the characteristics of a corrective pattern. There is not a tight group of time factors, but as of the last bar on the chart, IBM has reached the 100% time retracement on December 11. This is typically the maximum time retracement for a complex correction. The last minor swing up was 6 trading days, the 100% low to high alternate time projection. The recent 100% high to high factor is almost a week away. Based on the time factors, IBM has reached the maximum probable time extreme to complete a corrective high. It has also tagged the 50% price retracement and made a momentum bearish reversal. This looks like another ideal setup to complete a correction, followed by a decline to a new low. Figure 5.15 shows how it turned out. IBM declined for several days and then advanced to a new high. The final corrective high was made on December 26th, nowhere near any of the time factors. Once IBM made a new high beyond the 100% time retracement, the dynamic time strategy you have learned so far is not of much use. I wish I could tell you every high and low will be made at the projected time target, but they are not. What we have is a time strategy approach that identifies relatively narrow range time targets and maximum time targets when a reversal is probable, but not certain. That is the best we can ask for and expect. If the trade strategies you learn in a chapter later in the book execute a trade, the loss will be acceptable and part of the business of trading. Remember, the objective is not to be right every time. That's not going to happen. The objective is to identify conditions with a high probability outcome and acceptable capital exposure. Time bands. Time bands are similar to the traditional style of cycle analysis, but with a more relevant and useful approach. Walter Bressert, who is considered the father of financial cycle analysis, developed this approach in the early 1980s. This method of identifying time targets for a low or high in any market and any time frame is quick and simple to apply. As usual, let's jump right into a real-world example to learn how to make time bands. Figure 5.16 is several months of DJIA daily data. The date and time range markers along the top of the chart point to some of the highs made during the period. The date markers show the date of the high and the number of bars between the dates. Of the highs shown, plus several to the left of the chart not shown, the high-to-high periods range from 10 to 21 trading days. If this high-to-high time rhythm continues, the next high would be made 10 to 21 trading days from the last completed high made on September 21st. This is too broad a range to be of much use. There are two high-to-high outliers, the 21-day and 10-day counts in June and July. If most of the periods are grouped in a relatively small range, I eliminate the extreme short and long outliers when making the counts. In this case, the range of all the high-to-high periods, not including the extreme short and long outliers, was 13 to 18 trading days. Interestingly, in this case, the back-to-back 21 and 10-day periods total 31 days, which is about twice the average of the rest of the high-to-high periods. The last completed high was made September 21st. If we count forward 13 and 18 trading days from the September 21 high, the result is October 10th and October 17th. If the recent high-to-high time rhythm continues, the next comparable high should be made between October 10 and 17. This is a relatively narrow range of time to anticipate a high, but we should be able to do even better than that and narrow the range to fewer days. Before you learn how to complete the time band for a more narrow range time target, a few comments are necessary. First, you have to use some judgment in choosing the high or low pivots. In most cases, the relevant pivots are the obvious swing highs and lows, but also look for periods of market consolidation that fit in with the typical high-to-high counts that have been made. Over the past 20 years, I've tested many approaches to automatically identify cycle highs and lows, including percentage change of price movement, factors of average true range, Gann swing charts, momentum cycles, and more. None has proved satisfactory. Each of these approaches has inherent weaknesses that either miss relevant pivots or include irrelevant pivots. I have built into the Dynamic Trader software an auto swing mode, which will pick highs and lows either by percentage change in price or by factors of the average true range. While it saves a lot of time on the first run through to pick the highs and lows, in almost every case when the auto swing mode is used, I find I need to edit the swing file because not all the relevant pivots were picked by the auto mode. Beware of any so-called cycle software that allegedly identifies pivots without any user input. As I've said many times before, all aspects of trading are like any other business. You can't buy success. You have to gain knowledge and experience and make decisions. While identifying the relevant pivots for time band targets is mostly objective, With any set of pivots, you will still have to use some common sense and make decisions about which pivots to include. Another decision you will have to make is whether to eliminate outlier counts. In most cases, it is obvious. If most of the periods are within a relatively narrow range, like the DJIA in figure 5.16, and there is one outlier on each end of the range, they can be eliminated. If the periods are fairly evenly spread through a wide range with no obvious outliers, the entire range of periods is used, but will probably result in too wide a range for the time band projection to be useful. You have to use whatever information the market provides and then make decisions to arrive at the best results. The final decision is how many repetitions are enough for a reliable time band projection. Probably not as many as you think. As few as 5 or 6 are enough. I rarely go back more than 10 or 12 pivot highs or lows. If cycle periods have stayed within a relatively narrow range of time, the assumption is the recent time rhythm will continue. We are interested in the recent time rhythm of the market, not the time rhythm of the distant past. We are trading today's market and are interested in the current trends, volatility, and time rhythms, not what happened months or years ago. Let's complete the time band with the second set of counts and see if we can narrow the relatively wide high-to-high band to a more narrow range. The second set of counts, when making a time band for a high, is the low-to-high counts using the same high pivots used to identify the high-to-high cycles. On the chart in figure 5.17, I've marked the lows between the high pivots. The new time counts that are part of the high markers now represent the low to high counts of each advance. I've reduced the number of bars so the pivot markers can be read. The range of low to high counts is from 5 to 13 trading days. There were several counts on the data to the left of the chart not shown that were in the low end of the 5 to 13 trading day range. There were no obvious outliers, so the entire 5 to 13 trading day range is used. This is a very broad range and not of much use by itself. I have only shown the maximum 13-day low to high count on the chart since the DJIA is already well past the minimum part of the low to high range. The 13 trading day count from the last low on September 25th is October 12th. If the recent low to high time rhythm that has been made for the past several months continues, a comparable high should be made by October 12th. The time band combines the high to high count range and the low to high count range. The overlap of the two ranges is the time band and a high probability time target for the next comparable high. Just with the information in figure 5.117, we can see the overlap period would be October 10, the minimum high to high count, to October 12, the maximum low to high count. Figure 5.18 shows the result. A high was made on October 11th, right in the 10 to 12 time band for a high. The dynamic trader software includes a time band function and displays the time bands in the indicator window. The center range of dates along the bottom of the indicator is the time band of the high to high and low to high overlap period, October 10 to 12. The time band range is also displayed in the overbought zone above the indicator, so we have an easy visual of the time band and momentum position. On October 11th, right in the time band for a high, the DJIA made an outside reversal day with a momentum bearish reversal, a nice setup for a short trade. Earlier, you may have noted that I said a comparable high should be expected. A high made in the time band should be comparable to the highs made for the period of the raw data for the time band. In this case, since the DJIA was in a bull trend during the period, the declines off the recent highs have been from a few days up to 2 weeks. The time band itself does not provide any information as to whether the high will be more significant than recent highs, only that a high comparable to the recent highs should be made. That itself is good and usable information for a trade strategy. If the pattern and or price and or larger time frame momentum position suggested the market is in a position to make a larger time frame reversal, the time band would be very helpful to identify the narrow range time target when the larger degree high or low should be complete. With each part of the trade strategy, the lower time frame can help to identify a narrower range of time, price, momentum, or pattern when a higher time frame reversal may be made. Figure 5.19 is the time band menu in the Dynamic Trader software. The first column identifies the market or symbol and the time frame of the time band, such as daily or 60 minutes. In the case of the daily DJIA example we just looked at, the 5 to 13 low to high and 13 to 18 high to high ranges are entered, and the time band result is displayed in the indicator window, as shown in the prior figure. The Dynamic Trader time band menu contains columns labeled bull high and bull low, as well as bear high and bear low. The time rhythms in bull and bear markets are often different, so we include a section for each. Time bands can be made on any market and any time frame of data. The next example is for the EUR/USD on 60-minute data. The highs are marked on figure 5.20. Only a limited amount of data is shown, so the markers will not overlap and become unreadable. The highs going back several more repetitions to the left of the chart were in the 22 to 27 bar range. One high to high count shown on the chart was 57 bars, which is about twice the range of the other counts. We'll eliminate the 57 bar outlier and use the 22 to 27 bar range of all the other counts, which includes several repetitions to the left of the chart. Figure 5.21 shows the same EUR/USD data with both the lows and highs marked. The bar count with each high label is the low to high count. The low to high range of counts is from 7 to 16, which includes several low to high counts to the left of the data on the chart. The overlap of the high to high and low to high ranges of counts is a time band for a high from the 8 p.m. 20 bar on January 24th to midnight, January 25th. If the recent time rhythm from the last few weeks continues, a high lasting at least from 10 to 18 bars should be made in this time band. The last 60-minute bar on the chart is the 8 p.m. 20 bar on January 24th, which is the first bar of the time band range for a high. Momentum is overbought in a position where highs lasting at least several hours have been made. The EUR/USD is in a position to make a high lasting at least 10 to 18 hours, a comparable high to recent highs, not including the outlier that made a 43 bar decline. How did it turn out? Figure 5.22 shows the results. Note that I frequently stated if the recent time rhythm continues. No matter how narrow the range of the recent cycles, we never know if the next high or low will continue the recent time rhythm, so I'm always careful what I say, which reflects what I believe. As stated over and over again throughout this book, every trade strategy or technical analysis approach only has a probability of defining what the future holds. In this case, a market could make a high earlier or later than the time band. But since the time band was made based on the recent time rhythm, we have to consider that it will probably continue, and the next high or low has a high probability of being made in the time band. A high probability outcome is the absolute best we can expect. It is enough to use for low risk, high probability trade strategies. Time bands are a very logical and effective approach to identify in advance high probability time targets for any market and any time frame to make highs and lows. If you include time bands as part of your trading plan, you will find them extremely useful, and they will become a regular part of your strategy to identify conditions with a high probability outcome and acceptable capital exposure. More time factors. In the preceding sections on the dynamic time strategies, I have taught you how to identify time targets to complete a correction. If you can identify the conditions with a high probability to complete a correction, you are in a position to enter a trade in the direction of the major trend, which is why we put a lot of focus on corrections. The same approach is used to identify in advance the time targets to complete 5-wave and other trend structures. I have not included dynamic time strategies for trend targets because they involve more sets of projections and more ratios from a wider variety of sections. They are also more difficult to apply unless you have the Dynamic Trader software to make the projections. So we'll have to leave dynamic time strategies for trend targets to another time. But don't despair. They aren't necessary for the complete trade plan from entry to exit that you will learn in the chapters to come. As you have seen from the time strategies outlined here, a chart can become crowded if all of the time projections are made and saved to a chart. The Dynamic Trader program has several unique time projection routines, including the Dynamic Time Projection, or DTP, report. The DTP routine makes all of the sets of time projections you learned here, plus a few additional ones that are unique to different pattern structures, and displays the results as bars in the indicator window. The bars represent those times in the future with the greatest number of hits. These bars are a visual representation of the clustering of the time retracement, alternate time projection, and high-to-high and low-to-low projections that you learned earlier, plus a few others. Figure 523 shows the Wave C dynamic time projection for the XAU example used earlier. The highest scoring date was December 18, the same time target we arrived at by looking at all the individual time factors. The DTP report uses the same information you've learned in this chapter, but processes the data instantly to arrive at the time targets. A dynamic time projection target can be made for any pattern structure. Figure 5.24 shows the DTP for a Wave 5 low for 60-minute ES data. This is the same data used in Chapter 4, where you learn to identify the probable price target for the 5-wave trend low. The highest DTP score was for a Wave 5 low in the late afternoon of November 26, right when the low was made. If you want to make the dynamic time strategies a regular part of your trading plan for all market conditions, you might check out the Dynamic Trader program. You don't need it to apply what you've learned so far, but it can save you a significant amount of time. Conclusion. In this chapter, you've learned practical time strategies, including time bands and dynamic time strategies. Use them every day across every market and time frame, and you should see a meaningful improvement in your trading results. In the chapters so far, we've focused on identifying conditions with a high probability outcome to consider a trade. Now it's time to move forward into execution, learning specific entry strategies and the initial protective stop price in the next chapter. After that, you will learn exit strategies and trade management to complete a full trading plan, from entry to exit. Chapter 6, Entry Strategies and Position Size. In this chapter, you will learn 2 completely objective entry strategies, including the specific entry price and initial protective stop for all market conditions, plus the maximum position size for any trade. Objective entry strategies are a key to a successful trade plan. They will eliminate emotion and indecisiveness once the trade decision is made. Knowing the maximum position size for any trade will be a key factor in your trading success. So far, you have learned the 4 factors of multiple time frame momentum: pattern, price, and time used to identify market conditions with a high probability outcome to consider a trade. This doesn't mean a trade should be entered every time these conditions are met. It simply means there is a potential trade. Now we set the specific conditions to execute the trade, including the entry price and initial protective stop loss. Most of the time, a trade will be executed. However, sometimes the market will not react as anticipated and will not meet the trade execution conditions. While there is some judgment involved in identifying the best trade conditions based on what you have learned so far, the trade entry strategy itself is completely objective. Once the conditions are in place for a probable correction reversal or trend reversal, there is no more thinking and no more judgments to be made. The entry strategy is objective. In this chapter, you will learn just 2 specific entry strategies. Both are similar in that they require the market to move in the anticipated direction before the trade is entered. This is crucial. I don't recommend buying or selling at a price target. There is too great a risk of the market continuing through the price target. Why not wait for the market action itself to give some evidence that it is going to do what you anticipate it should do before entering the trade? An entry strategy must have a specific buy or sell price and a specific initial protective stop price. You may have been taught vague strategies in the past, such as, you could buy around here and place your stop around here. That's not a strategy, that's a suggestion. You can't place an around this price order with a broker. Brokers don't take vague or approximate orders. They take specific price orders. So that is what you are going to learn: practical, simple, and most important, logical entry strategies based on the market position. Stops are always placed at the exact price that will void the setup. That's the key to stops. What can the market do that will void the very condition that prompted the trade? That is where the stop loss is placed. If a market voids the condition that caused the trade to be taken, there is no reason to remain in the position. You want to be out quickly with an acceptable loss rather than potentially ending up with an unacceptable and possibly ruinous loss. This chapter is just about entry strategies, which include the specific entry price and initial protective stop loss. It is not about how to adjust the stop loss if the market moves in the anticipated direction, and it is not about exit strategies. Those are the subjects of Chapter 7. For most of the examples in this chapter, the focus is on the specific entry strategy, not in-depth analysis of momentum, pattern, price, and time. Some of these factors are shown, but the emphasis is on execution. We will bring everything together when you learn to plan a complete trade from entry to exit in later chapters. In this chapter, you will also learn about other completely objective decisions, including maximum capital exposure or risk and maximum position size for any trade under any conditions and for any market. Entry strategy 1. Trailing one bar entry and stop the trailing one bar high or low entry, TR1BHL, is very simple and logical and will usually put you into the trade with a very close stop. Once the conditions are in place for a reversal, and following the lower time frame momentum reversal, trail the buy stop or sell stop to enter the trade one tick above the high or below the low of the last completed bar. Place the initial protective stop one tick beyond the swing high or low made prior to entry. Let's take a look at an example. Figure 6.1 is the XAU daily data. As of the last bar on the chart, the XAU has reached the 50% retracement, is near the 100% low-to-low cycle, and has made a daily momentum bullish reversal. There are several other time and price factors for support that you've learned in previous chapters, but the ones shown here are just a couple that demonstrate the XAU is in a position for a possible wave C low. We'll assume for now that the higher timeframe weekly momentum was either oversold or bullish, which are the higher timeframe momentum conditions to consider a long trade following the lower timeframe daily momentum bullish reversal. In Chapter 2, we saw that if a market has reached a higher timeframe oversold position, the immediate downside should be limited, and the next momentum bullish reversal on the lower timeframe is likely to be quickly followed by a bullish reversal on the higher timeframe. A higher timeframe oversold momentum is in a position to prepare for a long trade. Since the XAU is at time and price support for a potential wave C low, and the smaller timeframe daily momentum has made a bullish reversal, the entry strategy is to go long one tick above the daily trailing one bar high and place the initial protective sell stop one tick below the swing low made prior to entry. Figure 6.2 shows the results. The next day, the XAU took out the high of the prior day and continued to advance in the days ahead without hitting the stop. At this point, it is not relevant how far the XO advanced or how the stop was adjusted or the trade exited. We are only concerned with how the trade was executed once the conditions were in place for a reversal. The trailing one bar high or low entry and stop strategy is very simple and logical. The market must make some positive action in the anticipated direction by taking out a bar high before the trade is entered. The entry will not always be executed on the next bar. It may take several bars before the trailing one bar high or low is taken out and the trade is executed. Figure 6.3 is a close-up of a momentum bearish reversal and how the trailing one bar low entry was adjusted at each bar until execution. The bar labeled 1 was the bar when the momentum bearish reversal was made. Beginning with the next bar, a sell stop one tick below the low of the last completed bar is placed to enter a short trade. Neither bar 2 nor bar 3 took out the prior bar's low, so no short trade was executed. Bar 4 took out the trailing one bar low and executed the short trade. The initial protective buy stop was placed one tick above the bar number 3 high, the highest bar made since the momentum bearish reversal and recent swing high. Following the lower timeframe momentum bearish reversal, the trailing one bar low entry strategy continues as long as the momentum remains bearish and does not reach the oversold zone. If the momentum makes a bullish reversal or reaches the oversold zone before a one bar low is taken out and the trade executed, The entry is canceled. The lower time frame momentum conditions are no longer valid for a short entry. It may take several bars before the trade is executed, if executed at all. The beauty of the trailing one bar low or high strategy is that if the market does not immediately begin to trend in the anticipated direction, the entry is often at a better price and with less capital exposure than if the entry was immediately taken following the reversal. Figure 6.4 shows a situation where the entry strategy would have been voided before a trade was executed. The bar labeled 1 is the first bar following a momentum bearish reversal. Using the trailing one bar low entry strategy, for the next 3 bars, the low of a prior bar was not taken out, so no short trade would have been elected. 4 bars later, at the bar labeled 2, the momentum made a bullish reversal, voiding any further short setup. The entry strategy is canceled. Another short setup would not be made until the momentum made the next bearish reversal, as long as the higher time frame momentum was still bearish and not oversold. As of the last bar in figure 6.5, the 60-minute momentum made a bullish reversal at potential wave 5 support. Let's assume the higher time frame daily momentum was either bullish or oversold, creating the conditions to consider a long trade following a smaller time frame, 60-minute momentum bullish reversal. We begin to trail a buy stop to go long one tick above the last completed bar's high, which so far is 1431.25. If the trade is executed, the initial protective sell stop is one tick below the swing low made prior to trade entry, in this case, 1406.50. If the swing low is taken out, it is not a valid reversal, which was the basis for entering the trade. The trade conditions would be voided, and there would be no reason to remain in the trade. If this long trade were executed at 1431.25, one tick above the one bar high, the stop must be placed at 1406.50, one tick below the swing low, for a capital exposure of 24.75 per contract. The stop cannot be placed closer to the entry, as only a trade below the swing low would void the setup, not some arbitrary price between the entry and swing low. A 24.75 point capital exposure per contract is a larger exposure than a highly leveraged futures trader would probably accept. We don't determine the entry price, stop price, or initial capital exposure. The market does, through the range of bars it is making. We don't control the potential risk of the setup. We do control whether to accept the risk, and we control the position size. Later in this chapter, you will learn how to objectively determine the maximum capital exposure and position size for any trade. There are 2 solutions to an unacceptable capital exposure, such as this setup. First, once the setup is made on the 60-minute data, you could move down to the next smaller time frame, like the 15-minute data, and wait for the setup to be made there. There is no guarantee a trade setup will be made on the smaller time frame, but if it is, the initial capital exposure is likely to be much smaller. Or you can take the trade with less or even no leverage using an exchange-traded fund, such as the SPY, which represents the S&P. Take advantage of the work you've done to identify a high-probability setup and execute it with lower capital exposure. For now, let's continue to focus on entry strategies. Figure 6.6 is IBM daily data. Assume the higher timeframe weekly momentum was either bearish or overbought for a short setup on the smaller timeframe daily data. In mid-December, the daily momentum made a bearish reversal with price at the 50% retracement. 2 days later, IBM took out the trailing one bar low to execute a short trade with an initial protective buy stop one tick above the swing high made prior to entry. Several days later, the trade was stopped out with a small loss. The entry price and initial protective stop are completely objective with the trailing one bar high or low strategy. The advantage is that the entry is usually very close to a reversal, and the capital exposure is usually very small in the event of a loss. If stopped out of a trade, continue with the same strategy as long as the trade conditions are still valid. In the case of IBM, as long as the higher timeframe weekly momentum remains bearish or overbought, the next daily momentum bearish reversal becomes another setup for a short position. The rally in IBM still appeared corrective, so any daily momentum high could result in the final minor swing high of the correction. Figure 6.7 is the daily EUR GBP, which has reached a Wave 5 price target zone. As of the last bar on the chart for January 15th, the daily momentum made a bearish reversal. The strategy for entry is to move down one time frame to the 60-minute data for execution. Figure 6.8 is the 60-minute data for January 15th and 16th, just following the higher time frame daily momentum bearish reversal. On the morning of January 16th, the EUR GBP reached the 61.8% price retracement, just a couple of bars short of the 100% time retracement. The upward pattern has all the characteristics of a correction. The 60-minute momentum made a bearish reversal to complete the setup and initiate the trailing one-bar low entry strategy on the 60-minute data. 2 bars after the 60-minute momentum bearish reversal, the trailing one-bar low was taken out, executing a short trade with the initial protective buy stop 1 pip above the corrective high. If you want to make real money trading, focus on major trends. There is probably no better trending market than currencies. Trade the weekly and daily setups for the major trends. Trade for points, not for ticks, or in Forex, pips. Figure 6.9 is weekly EUR-USD data. As of the last weekly bar on the chart, the weekly MACD made a shorter bar from below the signal line, a bullish reversal for the MACD. Since the MSD does not have overbought or oversold zones, we must wait for a momentum reversal, a shorter bar from below the signal line, before considering it a valid higher time frame setup. Price had tested the 38.2% price retracement 3 times in a probable corrective pattern. Traditional chartists and swing traders would wait for the breakout above the trading range high to go long. This would require a very wide stop. With the dual time frame momentum setup and trailing one-bar high entry strategy, a long trade can be made with relatively small capital exposure. If the EUR-USD doesn't end up making a bull trend, the loss will be very small. Figure 6.10 is the smaller time frame daily USD. The weekly momentum bullish reversal was made the week ending October 20th. I've marked the daily October 20 bar at the top of the chart. The objective entry strategy is to execute the daily trailing one-bar high following a momentum bullish reversal on the daily data, as long as the weekly bullish reversal, a longer bar from above the signal line. The following day, a long trade was executed 1 tick above the prior day's high, with a stop 1 tick below the swing low made prior to the bullish reversal. Currencies frequently have consistent trends that last for weeks and months. Using the weekly and daily data are the ideal timeframes to enter position trades with minimal capital exposure and significant profit potential. Currency ETFs can be used for minimal to no leverage for potential long-term positions. The trailing one-bar high or low entry strategy is completely objective and usually sets up with minimal capital exposure. It has some strong benefits. The trade will not be executed unless the market moves in the anticipated direction by taking out the trailing one-bar high or low. The initial capital exposure is always known before the trade is executed because the setup defines the exact entry and stop prices. If the capital exposure is too large to be accepted, either pass on the trade or take it with minimal or no leverage using an ETF or mutual fund instead of a futures contract or highly leveraged Forex position. If the market does not immediately move in the anticipated direction and take out the immediate one-bar high or low, the trade may still be entered within the next few bars, possibly at an even better price or with less capital exposure. If the setup conditions are voided by a smaller time frame momentum reversal against the higher time frame momentum direction, the trade is voided until the next setup is made. Most of the previous examples showed successful trades where the trade was executed and the market moved in the anticipated direction. The objective was to help you understand the entry strategy and exactly where the entry and stop prices were in each situation. You will also have losses, trades where the entry is executed and the market immediately reverses and stops you out. But the losses will usually be relatively small, while the potential gains are relatively large. There will also be many setups that are never executed, as shown earlier in the chapter. In the next chapter, you will learn stop-loss adjustments and exit strategies to manage the trade from entry to exit and take advantage of as much of the trend as possible. Now let's look at the second entry strategy, the swing entry. Entry strategy 2. Swing entry and stop concepts matter. The concept must make sense before action is taken. In this case, the concept is simple. The market must move in the anticipated direction and take out a swing high or low before a trade entry is made. This is the same core idea as the trailing bar entry strategy. The initial conditions are also the same. The dual time frame momentum, price, pattern, and time conditions for a corrective or trend reversal must already be in place. The higher time frame momentum is either bullish or oversold for a long trade, or bearish or overbought for a short trade. The smaller time frame momentum then makes a reversal in the direction of the higher time frame. Once these high probability conditions are in place, the swing entry strategy requires the market to take out a swing high or low in the direction of the anticipated trend. With the swing entry strategy, the capital exposure is usually greater than with the trailing one bar strategy, because the entry price is typically further from the initial protective stop. However, the trade-off is a higher probability of success. Every entry strategy has a trade-off. Entering earlier gives lower risk but lower certainty. Entering later gives higher certainty but higher risk. Don't confuse the swing entry strategy with so-called swing trading. Swing trading has become a buzzword and doesn't represent a specific method. Pure swing trading, buying every new swing high or selling every new swing low, works in strong trends but fails badly in choppy markets. In this approach, a swing entry is only taken after a proper setup is in place, and the entry is made on a lower time frame swing to control risk. Let's look at an example. Figure 6.11 is 60-minute S&P mini futures data. The low on the chart is a potential wave 5 low. To keep the chart uncluttered, the time and price targets near the low are not shown, but they indicate end of wave 5 support. The higher time frame daily momentum, not shown, is bearish and oversold, a condition to consider a long trade following a smaller time frame, 60-minute momentum bullish reversal. A bearish oversold position implies downside is limited and a bullish reversal is probable after the lower time frame turns. The last bar on the chart is the final 60-minute bar for November 27th during pit trading hours. The 60-minute momentum has made a bullish reversal. The swing entry for the following day is one tick above the prior swing high. If the entry is executed, the initial protective sell stop is one tick below the swing low made prior to entry. We don't know if the market will continue higher and take out the swing high. It could just as easily decline or move sideways. What we do know is that as of November 26th, the ES is in a position to complete a wave 5 low. A move above the swing high would confirm that the low is complete. If the ES takes out the swing high, it would invalidate any logical bearish pattern and signal a pattern reversal. In that case, the market should rally for at least 2 to 3 weeks, given that the prior bear trend lasted over 5 weeks from the early October high to the November 26 low. The initial capital exposure would be relatively large if the trade is executed, so this setup may not be suitable for a leveraged futures position for a smaller account. However, it is an excellent setup for a lower risk position using an ETF such as SPY or an S&P index mutual fund. The advantage of this daily and 60-minute combination is that you can identify the setup using intraday data without needing to watch the market constantly. The buy stop at 1449.50 can be placed after regular trading hours. If it is executed the next day, the protective sell stop at 1411.25 is automatically placed. Most trading platforms support conditional orders. If the buy stop is triggered, the sell stop is placed immediately. If the ES does not trade above the swing high the next day and the buy stop is not executed, you simply reassess the setup the following evening and place a new order if conditions remain valid. If the trader is available to monitor the market the following day, the next smaller timeframe 15-meter data may be used for the swing entry setup. This doesn't mean you have to be glued to the screen all day. Set an alert to notify you when a 15-meter momentum bullish reversal is made. Then you can identify the swing, high or low, and place the buy stop to execute the trade. Figure 6.12 is the ES 15-meter data for just the period from the November 26 high shown on the 60-minute chart. The last 15-meter bar on the chart was made late afternoon November 27 with a 15-meter momentum bullish reversal. Both the daily and 60-minute momentum were already bullish for a 3-time-frame momentum setup. The ES had made a decline to the 78.6% retracement. We don't know if the ES is going to advance and take out the 15-meter swing high at 1431.50 or not. What we do know is with the November 26 low in a probable position to make a wave 5 low, which should last at least 2 to 3 weeks, and with the daily and 60-meter momentum bullish, taking out a 15-meter swing high is a good sign the trend is reversing to bullish. If a swing entry long trade is elected on the 15-meter data, the initial capital exposure would be much less than if only the 60-minute data and November 26 high were used. To identify the setup and determine the swing entry and stop price on the 15-meter data would require the trader to be able to monitor the market during the day. Again, that does not mean sitting in front of the computer all day. The final condition to place the trade is a 15 meters momentum bullish reversal. Set a momentum reversal alert on your trading software, turn up the computer's volume, and go about your business during the day with an earshot of the computer's alert. If the alert is made, take a look at the chart to identify the swing high for the swing entry buy stop price and swing low for the initial protective sell stop. Place the buy stop order and contingent sell stop order and go about your business. No need to stay glued to the computer. You already have all the specific information needed to place the order. The market will either execute the buy stop or it won't. Figure 6.13 is IBM weekly data into the October 2007 high. IBM has made 5 distinct sections up from the July 2006 low for a possible 5-wave trend. We don't know if October 2007 has made a wave 5 high to complete the bull trend, but if time and price factors indicate this could be the case, we would look for market action to either exit longs or initiate shorts, because a decline lasting at least several months should follow if a 5-wave trend is complete. As of the last weekly bar on the chart, the weekly stock momentum has made a bearish reversal for a swing entry short setup on the daily data. Figure 6.14 is IBM daily data around the October 2007 high shown on the weekly chart. The weekly momentum made a bearish reversal the week ending October 19th. It wasn't until October 31st that IBM made a daily stock momentum bearish reversal. IBM had tagged the 50% retracement at the 100% time retracement, 7 trading days down, 7 up. The pattern up from the October 22nd low appears to be corrective with overlapping sections. If IBM takes out a swing low, the odds are a wave 5 high is complete and the bear trend will continue for weeks, if not months. Most people who trade stocks have regular day jobs and don't sit in front of the computer watching ticks all day. Weekly and daily data are all you need to position trade stocks, or any other market for that matter, for probable trends of several weeks to several months. In this IBM weekly daily example, if a 5-wave trend is complete at the October high, the minimum to expect is a corrective decline greater in time and price than any since the October 2006 low, which was the beginning of the potential 5-wave trend into the October 2007 high. It would definitely be a time to not be long IBM, and a good time to consider a short position. If you have an aversion to short positions, get a job, because you definitely can't consider yourself a trader. Markets trend up and markets trend down. Take advantage of both potential trends. How about very short-term setups, including day traders? The exact same strategies are used. Figure 6.15 is the 15-media ES data for January 17 through the 11:15 bar. The next higher time frame, 60-minute momentum, was bearish going into this day. Only short trades should be considered on smaller time frame bearish reversal setups. The 15-meter momentum made 2 bearish reversals prior to the 11:15 bar, one just above the oversold zone and one in the oversold zone. Neither was in the position to initiate a short trade. By the 11:15 bar, the ES 15-meter momentum had reached the overbought zone, a setup for a short position on the smaller time frame 5-meter momentum. I recommend for day trades to have 2 higher time frames momentum in the direction of the smaller time frame momentum for the best opportunities for a successful trade. In this case, the 60-minute momentum was bearish, and the 15-minute overbought. So a 5-minute bearish reversal would put 3 intraday timeframes in the same bearish momentum position. Figure 6.16 is the 5-minute data for January 17, the same day as the 15-minute data shown on the previous chart. The date time marker along the top of the chart points to the 5-minute 11 and 15 bar when the 15-minute momentum became overbought. A few 5-minute bars later, 5-minute momentum made a bearish reversal for a swing entry short trade setup below the minor swing low at 1356.25. A short position was elected on the next bar with an initial protective buy stop 1 tick above the swing high made before entry at 1362.75. In this example, the ES made a consistent bear trend throughout the day with just 2 minor corrections through the data shown. However, the short-term 15-minute and 5-minute position only set up for a short trade on the second correction. It can be aggravating to start the day with a bearish bias because of larger time frame factors, such as the 60-minute bearish momentum. But unless the conditions are complete on the smaller time frame for a high probability multiple time frame setup, a trade should not be initiated. It is always easy to be an after-the-fact trader and know what the market was going to do. But the trade decision is made from the last bar on the chart, when you never know what is going to happen. If you do not have the patience and discipline to wait for conditions with a high probability outcome according to your trade plan, you are not a trader. You are a game player with no respect for rules that should keep you safe, and you will eventually contribute your trading account to the professionals who have patience and follow the rules. Get smart. Have a plan and trade the plan. Give yourself the edge you must have to put the odds for success in your favor. The swing entry strategy is the second of 2 entry strategies that may be used for any market, any time frame, and any condition. Never buy or sell at a target price. Always require the market to move in the direction of the anticipated trend to execute a trade, and I'm sure you will find your results improve substantially. Position size. Capital preservation is a key to long-term successful trading. Almost everyone has seen the numbers of how much percentage gain it takes to make up a loss. A 20% drawdown takes a 25% gain just to get back to break even. A 50% drawdown takes a 100% gain to get back to even. It takes a lot to recover from a significant loss. Too many traders swing for the fences with visions of big profits from big positions. That's a pipe dream. Big positions can result in big losses that are very difficult to recover from. There will come a time when you think you've got the market wired. Every technical position, from short to long term, points to one thing: a major trend. You break every common sense risk rule and commit your account to the position with a wide stop to give it room. The market moves against you, and you think it is a buying opportunity to add even more positions at a better price. You know how this ends. The market keeps moving against you, and you either exit with a major loss or are taken out by the broker when you run out of margin. A major loss is very difficult to recover from, both emotionally and financially. Successful traders always have a relatively close stop. If stopped out, it is an acceptable loss. It is absolutely critical to minimize losses and preserve capital. It is that simple. Assume any trade you place could be a loser, and never risk more than a small amount of capital on any one trade or any group of open trades. The best professional traders rarely have a greater than 50% win rate. That's right. Long-term successful traders usually have more losing trades than winning ones. Most amateur traders simply don't accept this reality, which is why they are not disciplined about limiting losses. Listen carefully. If you have better than a 50% win rate over time, you are among the trader elite. If you get good at trading, you will likely have around a 30 to 40% win rate. That is why it is absolutely, positively, unquestionably critical that losses are relatively small and profits are relatively large. There is no other path to trading success. Up to this point, you have learned how to identify trade setups and objective entry strategies with a defined entry and initial protective stop, so you know exactly what the capital exposure is per trade before execution. Now it is time to define what maximum capital exposure is acceptable for any single trade and for all open trades combined. I use the term capital exposure to define the dollar amount that may be lost on a trade. Most trading educators call this risk, but risk is actually the probability of an event happening. Capital exposure is a more accurate term for the amount of money that could be lost. Let's get practical. The maximum capital exposure for any trade must be small, and the capital exposure per trade unit determines the maximum position size. There are many complicated position sizing methods, but the simplest is the best. When I started trading in the mid-1980s, I followed W.D. Gann's rule to never risk more than 10% of account capital on a trade. Over time, I learned expensively at 10% is far too much. Professional traders risk very little per trade. A widely accepted standard is 3% maximum capital exposure per trade, 6% maximum capital exposure across all open trades. These are solid guidelines. The maximum exposure should be based on your available account equity. If your account is $20,000, then maximum per trade equals $600, sirs, 3%. Maximum across all trades is $1,200, 6%. If you exceed these limits, you are stacking the odds against yourself and not operating responsibly. Most traders also define a maximum monthly loss. If that limit is reached, they stop trading for the rest of the month. This should not exceed 10%. If you hit a 10% drawdown in a month, stop. Either you or your system needs a reset. There will always be opportunities next month. Now let's connect this to position size. Maximum position size is determined by 1. Maximum capital exposure per trade, 3% of account. 2. Capital exposure per unit based on entry and stop. First, calculate 3% of your account. Then calculate the per unit risk from entry to stop. Finally, divide the total allowable risk by the per unit risk to get your position size. Figure 6.17 is 15-minute ES data. Assume conditions are in place for a long trade. Using the trailing one-bar high entry, entry equals 441.75, one tick above the high. Stop equals 435.25, one tick below the low. Capital exposure per contract equals 6.5 points. Since each point is $50, total equals $325 per contract. With a $20,000 account, 9 is 3% risk, 600 means $600 for the $325 equals 1.84, round up to 2 contracts. Maximum position size equals 2 contracts. If you trade more than that, you are ignoring capital preservation, one of the most important principles in trading. Position size is not about confidence. It is about control. The formula is simple. Maximum position size equals maximum allowed capital exposure per unit capital exposure. Figure 6.18 is Google daily data. Let's say you've been following Google for a couple of years. You missed buying it at $200, missed again at $300, and missed again at $400. Each time it rallied $100, $200, and more in a matter of weeks or months. Not only are you not going to miss buying Google again after it completes its next correction, but you are going to load up for a big gain to make up for the earlier missed opportunities and to set yourself up for early retirement. As of the last bar on the Google daily chart, if Google just takes out the potential wave B swing high, an ABC correction should be complete, and off goes Google for another quick $100 to $200 gain. If you have $50,000 of available capital, what is the maximum number of Google shares you can buy with the swing entry strategy to enter above the potential wave B swing high, with an initial protective sell stop one tick below the minor swing low at 505.79? The maximum number of shares you can buy is 72. The maximum capital exposure for any one trade is $500. $50,000 multiplied by 3%. The trade unit capital exposure is $21.05, 526.83 cents minus 505.78. The maximum number of shares you can buy is $1,500 divided by $21.05, which equals 72 shares. If you buy 73 shares, close your account right now. Even if you get lucky with Google, you will eventually lose most or all of your account because you have broken an essential rule of capital preservation. You lack the discipline to make logical and sound trading decisions and are operating outside the framework of professional trading. You have risked more capital than allowed by any logical trading plan. How to calculate maximum position size? Available capital multiplied by 3% divided by capital exposure per unit equals maximum position size. If this math confuses you, stop trading right now. You need to understand simple concepts and basic mathematics to be a successful trader, and this is as simple as it gets. Years ago, I set up a simple spreadsheet to calculate maximum position size. All I have to do is enter the entry and stop price, the value of each tick, and the account balance, and it gives the maximum position size. You can set up a simple spreadsheet yourself or download one in Excel format from the website. In most cases, you won't need a spreadsheet or even a calculator to quickly estimate the maximum position size. It is not complicated. The maximum capital exposure for all open positions should be 6% of available capital. Never exceed this limit. Always remember, capital preservation is critical to success. All successful traders limit the potential loss on any one trade to a relatively small amount. Limited capital exposure does not guarantee success, but it gives you the opportunity to succeed. Conclusion. In this chapter, you have learned 2 objective entry strategies that can be used with any market, any conditions, and any time frame. Both strategies require the market to move in the anticipated direction before a trade is executed. That is a key concept every entry strategy should have. With an objective entry strategy, there is no decision to be made about the entry price and initial protective stop once the high probability trade conditions have been identified. These are determined by the market position and the strategy itself, and you will know the maximum capital exposure before the trade is executed. You have also learned that limiting losses on any one trade to a relatively small amount is critical to long-term success. You now know how to calculate maximum position size quickly and objectively. Now that you know how to identify optimal trade conditions and execute trades with defined risk, it is time to complete the trading plan and learn trade management and exit strategies. Chapter 7, Exit Strategies and Trade Management. Sound and logical trade management and exit strategies are the key to maximizing the return on each and every trade. In this chapter, you will learn how to manage the trade from entry to exit, including how to adjust the stop loss and exit the trade. Up to this point, you've learned how to identify the optimal conditions for a trade setup and the objective entry strategies, including the exact entry price and initial protective stop loss price. Identifying good entry setups is only one part of a complete trading plan. You can't make a single dollar with even the best entry strategies. You only make money on a closed trade. There can be an enormous difference in your net success depending on how well you manage the trade and your ability to consistently stay with a trend until the market conditions suggest the trend is at its conclusion. The maximum return you can gain from any trend is entirely dependent on the market. You don't control how far or how long a market will trend. You do control how long you stay in a position. The best you can do is stay in the position for the majority of the trend. It would be ideal to stay in every trade from the early stages of a trend to the later stages, but that's not realistic. No matter how good your analysis or trade management, the market will often get you in late or out early. That's part of trading. What you can do is recognize the conditions that are typically present near the end of a trend, so you can protect profits or prepare to reverse your position. Sometimes you will capture a large portion of the trend. Other times, you will exit early and miss part of the move. There is an old saying, you can't go wrong taking a profit. That idea is misleading. It encourages traders to exit too early and miss the larger trend. Taking profits too quickly can severely limit your overall returns. After doing the work to identify a high probability setup and entering with controlled risk, exiting too early wastes the opportunity. There is nothing more frustrating than closing a trade for a small profit and watching the market continue much further in your direction. The objective is to understand where the market is in its trend and stay in the trade for as much of that trend as possible. That is the purpose of this chapter, multiple unit trading. Multiple unit trading can significantly improve your results. It has been used by successful traders for decades. Every position should have at least 2 units. A unit could be 1 futures contract, 10 contracts, 100 shares, or 1,000 shares. The size of the unit can vary, but every trade should include at least 2 units. If the trade works and the market moves in the anticipated direction, one unit is typically exited relatively quickly for a smaller profit. The second unit is held to capture the larger trend. This approach works across all time frames, whether you are day trading or position trading. The concept is simple. For the first unit, assume your analysis may be wrong and that the market is only making a minor correction, not a new trend. Exit that unit early to secure a small profit. For the second unit, assume the trend will develop as expected. Hold that unit to capture a larger move. This allows you to benefit even if your analysis is only partially correct. Two-unit trade concept. First, assume you are incorrect about the trend and the market is only making a minor correction. Exit one unit when conditions suggest the correction is complete. Second, maintain the other unit to take advantage if a larger trend develops. This approach allows you to be wrong on the bigger picture and still make money. Risk-reward ratios. Some trading educators place heavy emphasis on so-called risk-reward ratios and even base trade decisions on them, but this concept is often misunderstood and misused. Risk-reward is supposed to compare the initial capital exposure to the potential profit. Traders are often told to only take trades with a 3-to-1 ratio, but even the terminology is often used incorrectly. A 3-to-1 risk-reward ratio would imply 3 times more risk than reward. What is actually meant is a reward-to-risk ratio of 3-to-1. More importantly, the risk side of the equation is known in advance. If your entry is at $40 and your stop is at $35, your risk is $5. That is clear and measurable. But what about the reward? The reward is an estimate. It is a projection. It is not known. The potential reward is based on assumptions: price targets, support and resistance, wave projections, or percentage moves. These can be logical, but they are still estimates. You can define your risk precisely. You can only estimate your reward. That's the key limitation of risk-reward thinking. The potential reward estimate should be based on the same factors used to make a trade decision, not on some factor not related to the same conditions used to execute the trade. If you believe a market is in a position to complete a correction, the minimum expectation is the market will resume the trend direction prior to the correction and make a new extreme beyond the high or low where the correction began. That extreme should be the minimum reward for the trade. The 100% alternate price projection is another logical reward target. Whether a market is in a trend or countertrend, the next section will often reach the 100% alternate price projection. Not always, but we assume that should be the case, and the 100% pip can be the reward target. In every case, the reward is a best guess. Usually, it is an optimistic guess by the trader to justify the trade. Some market educators make the so-called risk-reward ratio a key trading strategy and never consider a trade unless the ratio is a minimum, such as 3-to-1, reward to risk. Most professional traders don't pay much attention to a risk-reward ratio. They focus on identifying optimal trade setups, good trade execution, and good trade management through the trade exit. If the focus is on these positive factors, closed profitable trades will usually be several times the initial capital exposure. I don't make too much of a risk-reward ratio because I know it is only a best guess. I suggest you don't get too hung up on it yourself and avoid any trading educators who claim they teach you how to only take trades with some minimum risk-reward or reward-to-risk ratio. It is a somewhat meaningless buzzword that can often hook you into expensive and often irrelevant trading education programs. In the trade management examples in this chapter, you will see how we quickly determine if there seems to be enough profit potential in a trade to initiate the trade. You will see how it is a quick and common sense decision. Risk-reward ratio. Forget about it. It's only a best guess. Focus on positive and logical trade management, and the risk-reward will take care of itself. Get hung up on so-called risk-reward ratios before taking a trade, and there is a good chance you have caught the dreaded paralysis of analysis disease. Exit strategies. Once again, concepts are important. Start with a logical concept and devise a strategy based on the concept. There are 4 important concepts for exit strategies. The first, always let the market take you out by moving against the position. Do not exit at a predetermined price target. A market will often blow right through a price target, sometimes by a substantial amount. If you exit at the price target, you may miss maximizing the profit potential of a trade if the trend continues beyond expectations. Price targets or other conditions may be a reason to adjust the protective stop closer to the current market position, as you will learn in this chapter. But they are never a reason to exit the trade at a specific price. What you give back by letting the market move against the position a small amount before exiting should be more than made up by those times a market trends right through a price target. I guess you should never say never. One situation where you might use a specific price objective to exit would be if you were about to leave for vacation and would not be able to update your data each night to assess the current position and make decisions. In that case, you will have two open orders in the market, the protective stop and the take profits exit price order. The second important exit strategy concept is that the exit strategy should be based on the same market conditions that determine the conditions to identify the trade entry in the first place. If the dual timeframe momentum position was a key factor to enter a trade in the direction of the larger timeframe trend, a dual timeframe momentum position should be a key factor in the exit strategy. The factors of momentum, pattern, price, and time that are keys to identify a trade entry are the same factors used to identify the exit strategy. The third important concept is to determine the general exit strategy and trade management of both units before the trade is entered. That doesn't mean pick a target price and exit the trade if the target price is reached. It does mean to identify the trade objective and what conditions will require a stop loss adjustment and exit strategy for each unit before the trade is entered. Specific actions are taken if the conditions are manifested. Fourth, and very important, the trade management and exit strategy may change as the market provides more information. As each new bar is made, whether a weekly or intraday time frame, new information is available. As the market structure, or pattern, develops, it may provide important clues to the position of the trend and where a stop should be adjusted. Price targets will often be adjusted depending on the pivot highs and lows made as a trend develops. Changes will probably be made to the trade management plan for any specific trade as the market provides new information. I wish there was one fixed rule-based exit strategy that could be used with all markets, all conditions, and all timeframes. There isn't, if you want to maximize the potential return for any position. It is easy to make up a completely objective rule based on price or momentum and call it an exit strategy. But no rule-based exit strategy will maximize the potential reward for a trade. As I've stated over and over again throughout this book, trading is a business like every other business. You have to gain knowledge and experience and constantly make decisions. You can never eliminate the decision-making process by rules, systems, or any software if you want to succeed in the business, any more than you can eliminate decision-making from any other business and succeed. However, it is very important that any changes to the trade management and exit strategies as a trade progresses are logical decisions based on the same factors that the trade decision was based on in the first place. As you will see in the comprehensive trade campaign examples in this chapter and the next, each decision should be a very logical conclusion to the information available at the time. Exit strategy concepts. 1. Let the market take you out of the trade with a trailing stop by moving against the trade direction. Never exit at a predetermined price target. 2. The trade management and exit strategy should be based on the same factors and market conditions that the entry strategy was based on. 3. Determine the general exit strategy of both units before the trade is entered. What is the objective of the trade? 4. The trade management and exit strategy may change as the market more information. Any changes should be a logical consequence of the new market information. Trade management. Trade management is the all-inclusive term for how the trade is managed from entry to exit, including the entry strategy, multiple unit position, adjusting the stop loss on each unit, possibly pyramiding the position, and the exit strategy for each unit. Most of the preceding comments about exit strategies also pertain to trade management. Whenever a trade is considered, there must be a trade management plan before the trade is executed. That doesn't mean you take a lot of time to devise a different management plan for each trade. The plan does not need to be a rigid list of rules, but it must include clear guidelines for taking action based on the trade objective, including what actions to take as the market provides new information. In a static format like this book, it is difficult to illustrate all the relevant factors of a trade campaign from entry to exit with just charts and commentary. There will be detailed commentary in the examples that follow, explaining the rationale behind each decision. Multiple charts will be used to show key milestones along the way. However, the most effective way to learn this process is to observe the market bar by bar. That is covered in the accompanying material. But first, the goal here is to understand how to think through each decision logically. The examples that follow are after the fact. The objective is to teach you how to think in a progressive and logical way, making decisions based on the information the market provides, one step at a time. Once you learn how to think and make logical decisions, you can trade any market, any time frame, and any condition. Now, let's begin. Weekly daily setup for a position. Trade figure 7.1 is XAU weekly data. The XAU is a gold and silver mining stock index. The ETF GDX closely tracks the XAU. Traders interested in mining stocks should monitor this index to understand the broader trend. As of the last bar on the chart, the week ending August 17, 2007, the XAU has made a sharp decline after being in a broad trading range for over a year. A trading range like this is typically a consolidation or a complex correction. From a longer-term perspective, it is more likely that the XAU will eventually break upward from this range, not downward, and begin a new bull trend. With a complex correction, there is no clear pattern to identify the final decline. Any low could be the final low. The objective is to identify conditions that suggest a weekly low is forming in order to position long for a potential breakout. As of the last weekly bar, the XAU has tested the 50% retracement of the May 2005 to May 2006 bull trend for the fourth time. Based on the weekly cycles over the past 18 months, the time band for a weekly low is a narrow 2-week period, from the week ending August 10th to the week ending August 17th. The weekly momentum is oversold. If the recent momentum rhythm continues, a bullish reversal should occur within the next 1 or 2 bars, followed by a rally lasting several weeks. Summary of XAU weekly position as of the week ending August 17th. Momentum. Oversold. A weekly momentum low is likely within the next bar or 2, followed by a rally lasting several weeks. At a minimum, downside should be limited. Pattern. Corrective. The trading range suggests a consolidation pattern, typically followed by a move to new highs. Price. The 50% retracement zone has been tested multiple times. Price is currently back in that area. Time. The time band for a weekly low falls between August 10th and August 17th. Trade strategy. Go long. With momentum, pattern, price, and time aligned, the strategy is to look for a long entry on the smaller timeframe daily chart. The short-term unit will aim to capture a corrective rally. The long-term unit will aim to capture a breakout to new highs. Daily setup figure 7.2 shows the XAU daily chart through August 17th. Summary of XAU daily position and trade strategy momentum. Daily bullish reversal with weekly momentum oversold. Pattern, possible ABC decline. Price, just below the 50% retracement and near the 127% external retracement. Time, daily time factors support a low. August 22nd is the 100% low-to-low projection, and August 13th is the 100% time retracement. The weekly time band adds weight to the August 16 low. Entry strategy. Go long using the trailing 1-bar high with a stop 1 tick below the August 16 low. The 1-bar high as of August 17 is 132.33, and the swing low is 120.41, resulting in nearly 12 points of capital exposure. Position size should be calculated so that no more than 3% of account capital is at risk. The expectation is that the XAU will eventually break upward from the trading range and move above the July 2007 high. There is no need for complex risk-reward calculations here. If the XAU exceeds the July high, the potential reward is well over 3 times the risk. That's sufficient. From a practical standpoint, there is strong upside potential relative to the limited capital exposure. That alone justifies considering the trade. Now comes the key question. What if we are wrong? What if instead of a new bull trend, the market only produces a minor corrective rally before continuing lower? Trade management, short-term unit. Trade management for the short-term unit. Trail the stop at the 1-bar low if the XAU either reaches the 61.8% retracement or following the second daily momentum bearish reversal. Why wait for 2 bearish reversals? Even if the XAU is only making a corrective rally, corrections usually have at least 3 sections, an ABC structure, which will make 2 momentum bearish reversals, one at the wave A high and one at the wave C high. I used to trail the stop loss on the short-term unit after the first smaller timeframe momentum reversal against the weekly trend for a quick profit. But I found the market usually went higher or lower to make a second momentum reversal, even if I was wrong about a more extended trend developing. This is the basic short-term unit exit strategy for many trades. Why trail the stop at the 1-bar low if the 61.8% correction is reached, even if the daily momentum has not made 2 bearish reversals? If the XAU is only making a corrective rally and not a new bull trend as anticipated, most corrections are complete by the 61.8% retracement. So I want to be out of the first unit around that level, but only by using a trailing 1-bar low, not by exiting at the 61.8% retracement price itself. Long-term unit objective. The objective of the long-term unit is to maintain the position with a relatively wide stop in the event the XAU makes a bull trend to a new high as anticipated. Trade management for the long-term unit. If the weekly momentum reaches the overbought zone, the bull trend should be in the final stages, and the stop will be adjusted relatively close to the current market position. We will define the specific exit strategy for the long-term unit as the trend progresses and the market provides more information. True trade progress through September 10th. Figure 7.3 is the daily chart with data through September 10th. There is a lot of information on the chart, so here are the key events and trade management decisions. 1. A long trade was executed on the trailing 1-bar high on Monday, August 20th at 132.34, one day after the daily momentum bullish reversal. The initial protective sell stop was at 120.40 sus, one tick below the August 16 low, for an 11.94 capital exposure. 2. Over the next 9 trading days, the XAU continued to rally, making a daily momentum bearish, then bullish reversal, and a trade above the August 24 minor swing high. The stop on both positions was adjusted to 132.59, one tick below the minor swing low made on the momentum bullish reversal. This was not a predefined action in the trade plan, but it was a logical one. Once the August 24 minor swing high was taken out, a decline below the August 28 minor swing low would have voided any logical bullish pattern and suggested the rally could be complete. There would be no reason to remain in a long position. Note that the stop loss was adjusted only after the minor swing high was taken out, confirming that the minor swing low should hold. If the XAU had immediately declined and hit the new stop, at least a small profit would have been secured. 3. On September 4th, the XAU reached the 61.8% retracement before making a second daily momentum bearish reversal. The stop on the short-term unit is now trailed at the 1-bar low. No changes made to the stop on the long-term unit. Trade result. Short-term unit on September 9th, the XAU took out the trailing 1-bar low and stopped out the short-term unit at 150.36. Entry was 132.34. Profit on half the position, 18.02 points. As of September 9th, the XAU has reached the 100% alternate price projection of the first swing up, projected from the August 24th minor swing low. Trade management, long-term unit. The stop on the second unit is adjusted to a close at 139.42 or below, which is the potential wave 1 or A closing high. If the XAU declines and closes below this level, it would create an overlap and void any probable bullish pattern. That would be a clear reason to exit the second unit. Trade progress through October 9th. Figure 7.4 includes data through October 9th. The XAU continued in a strong bull trend to a new high, as anticipated. On Friday, September 21st, the weekly momentum reached the overbought zone. This date is marked on the daily chart. Looking back at the weekly chart over the past 18 months, a weekly momentum bearish reversal typically occurred within a couple of weeks after reaching the overbought zone. This suggests the upside may be limited. Stop adjustment decision. A key decision during this period was when and where to adjust the stop on the long-term unit. From early September through September 21st, the XAU did not even make a 2-day correction. The daily momentum remained in the overbought zone and did not cycle to a bullish reversal that would provide a logical place to adjust the stop. Trade management, long-term unit. Following the wide range up day on September 18th, the stop was adjusted to the September 5th low. Why here? There was no exact rule. It was slightly below the 61.8% retracement from the September 18 high and aligned with the low of a narrow range day before another strong up move. Many traders would not keep such a wide stop with a large unrealized profit. But the objective is to remain in the trade until there is evidence the trend is nearing completion. Most trends develop in at least 5 waves or sections, as discussed earlier. As of September 18th, only a possible Wave 1 and Wave 2 had formed. A Wave 3 high, followed by a Wave 4 correction, and another new high, would still be expected. A typical Wave 4 retracement is 38.2% to 50% of Wave 3. Therefore, the stop is kept outside that range to avoid being prematurely stopped out. Most traders fail to maximize returns because they trail stops too tightly and get stopped out before the trend completes. 2 key conditions must be monitored: higher time frame momentum, trend structure, or pattern. If the higher time frame momentum has not reached an extreme, the assumption is the trend is not complete. If the minimum pattern structure, 5 sections, has not formed, the assumption is the trend has more room to continue. Trends can end early. Anything can happen, but decisions must be based on the information available at the last bar. As of mid-September, no conditions suggested the trend was near completion. As of October 9th, the XAU had completed a 3-section correction, likely Wave 4, followed by a new high above the potential Wave 3. Trade management, long-term unit, adjust the stop on the second unit to 163.48, 1 tick below the potential Wave 4 low. The 179.15 to 182.76 price zone includes the 162% external retracement of Wave 4 and the 100% alternate price projection of Wave 1. Both are typical targets for a Wave 5. In addition, the weekly momentum is overbought. The immediate upside is probably limited to this price zone. Trade management for the long-term unit. If the XAU trades to 179.15, or if the daily momentum makes a bearish reversal, trail the stop on the remaining unit 1 tick below the daily 1-bar low. Figure 7.5 adds the data through the date the second position was stopped out on October 15th. On October 11th, the XAU reached 179.15. The following day, the stop on the long-term unit was adjusted to the low of the prior day and trailed at the 1-bar low. Trade results. Long-term unit. The long position was stopped out just 3 days after the XAU reached the price target for a 46.111 profit, 178.45 minus 132.34. You should reread this commentary and study each chart carefully. Each trade management decision to adjust the stop on both units was based on the information available at the time and on the principles of momentum, pattern, price, and time. None of the decisions were arbitrary. Stops were never adjusted simply because there was a certain amount of unrealized profit. Stops were never adjusted at a fixed or arbitrary distance from the current price. Every adjustment had a clear and logical reason. If you follow a logical decision-making process and make tactical adjustments based on actual market behavior, you will usually capture a large portion of the trend. Was October 11th a Wave 5 high, marking a perfect trade campaign, from near the low to near the high? Figure 7.6 adds 2 months of data following October 11. October 11 marked only a minor 1-week correction, followed by a new high into early November, before a more substantial correction began. However, as of mid-October, conditions were in place to complete the bull trend, including overbought weekly momentum. It was appropriate to trail the stop close to the market. Every trade should be reviewed. Ask yourself one key question. Did I make logical trade management decisions based on the information available at the time? Weekly, daily, 60-minute setup for long trade. The next example is the S&P. We will use the weekly and daily charts for setup conditions and the 60-minute chart for trade execution and management. For every trade, you must be aware of at least the next higher time frame. The higher time frame momentum determines the trade direction. For even higher probability, the momentum of two higher time frames should align. This results in fewer trades, but a higher probability of success. Figure 7.7 shows S&P daily data through November 22nd. Summary of S&P position as of Friday, November 23rd. Pang. Momentum. The weekly momentum has been oversold for 2 weeks, suggesting downside is limited. A daily bullish reversal should align with a weekly bullish reversal. The daily momentum made a bullish reversal on November 23rd. Pattern. Potential 5-wave trend low. Trends often end with 5 distinct waves. After 4 waves, the trend may be near completion. Price. The November 21st low reached the probable wave 5 target zone. This includes the 127% and 162% external retracements of wave 4, the 100% alternate price projection of wave 1, the 61.8% alternate projection of waves 1 to 3, and the 78.6% retracement of the August low to October high. Time. The November 21st low is just 2 bars beyond the 62% time retracement of the August to October move. If not already complete, the wave 5 low should form within the next 2 to 3 trading days. Trade strategy. Go long. With momentum, pattern, price, and time aligned, the expectation is a corrective rally at minimum, potentially reaching the 50% retracement at 15.1175. The short-term unit targets a correction of the last decline. The long-term unit targets a larger corrective rally or potential new trend. Now move to the 60-minute chart for execution. Figure 7.8 shows 60-minute ES data from the November 14th potential wave 4 high through midday November 27th. On Monday, the market made a slight new high, then declined to a new low. The structure suggests a 5-wave decline. The daily momentum remained bullish. The low reached the lower end of the wave 5 target zone. A 60-minute bullish momentum reversal was confirmed. All conditions are in place. Entry strategy, both units, 60-minute trailing 1-bar high. The S&P may not complete a full 5-wave trend. It may only produce a minor correction. Trade management, short-term unit. If the S&P reaches the 61.8% retracement at 1462, or after the second 60-minute momentum bearish reversal, trail the stop at the 1-bar low. The objective for the long-term unit is to hold the position with a wider stop until the weekly momentum becomes overbought or turns bearish. If a 5-wave decline is completed, at least a 3-section corrective rally should follow, possibly more. Trade management, long-term unit. If the weekly momentum reaches the overbought zone, trail the stop on the daily 1-bar low after the second daily momentum bearish reversal. Alternatively, trail the stop if the S&P reaches a probable wave C price target. Figure 7.9 shows 60-minute data through early November 29th. The long position was executed on November 27th at 1431.25 with a stop at 1406.50, resulting in a 24.75 point capital exposure per contract. If this exposure is too large, the SPY ETF can be used instead. On November 28th, the S&P reached the 61.8% retracement. The stop on 1 unit was then trailed at the 1-bar low, as per the short-term plan. Trade results, short-term unit. On the first bar of November 29th, the protective sell stop was executed at 1466.25. Entry was 1431.25. Profit on the short-term unit, 35 points. Figure 7.10 adds the 60-meter data through early December 6th. The S&P has made a probable wave B decline and traded above the probable wave A high. Adjust the stop to 1462.75, 1 tick below the wave B low. If the S&P is making an ABC correction, the ideal wave C target is 1510.25 to 1508.00, which includes the 61.8% retracement of the 5-wave decline, the 162% X-red of wave B, and the 61.8% ache of wave A. The weekly momentum has not reached the OB zone and the daily momentum is bullish, but just below the OB zone. The immediate upside should be relatively limited. Most important, the 60-meter momentum is OB, the same position as when the wave A high was made. The objective of the long-term unit was to hold until either the weekly momentum was overbought or a wave C price target is reached. Trade management, LT unit, adjust the stop on the long-term unit to the TR1BL if either the S&P trades to 1510.25 or the 60-minute momentum makes a bearish reversal. Figure 7.11 adds the 60-member data through early December 7. On the last bar of December 6th, the S&P reached 1510.25, the beginning of the ideal wave C price target zone, and the stop on the long-term unit was trailed at the 1B as planned. Trade results. LT unit stopped out at 1507.0 on the second 60-meter bar the morning of December 7 for the long position taken November 27 at 14:31.75 for a profit of 75.25 points. The S&P did continue higher the following day, eventually reaching 1527.00 on December 11th, about 9 points above the 61.8% retracement, to complete a wave C high, followed by a decline to below the November low. The daily momentum made a bearish reversal on December 11th. Only the fast line of the weekly momentum reached the OB zone, the WE, December 21, with a bearish reversal the following week. Let's review this trade campaign. The initial capital exposure per contract was relatively large at 24.25 points. The beauty of the objective maximum position size is capital exposure per unit is not relevant by itself. It is only relevant by the position size. It's the total capital exposure of the position size relative to the account side is relevant. So no trade is taken if the capital exposure of the total position is greater than 3%. It doesn't matter if you have a small or a large position. The risk will never be more than 3% as long as you follow the maximum risk per trade rule. The objective is to identify conditions with a high probability outcome and take advantage of those conditions. In this case, the initial capital exposure per futures contract would be $1,212.50, 24.25 times 50. Two contracts units totaled $2,425. You would have to have $80,800 available capital to take a 2-unit futures trade, $2,425 divided by 0.3s. If this is larger than your account, no worries. Take the position with the SPY, S&P ETF, which trades tick for tick with the S&P. On an unleveraged SPY position, the first unit returned approximately 2% in 2 days. The second unit returned approximately 5.3% in less than 2 weeks. The initial capital exposure was less than 1.8%. If these returns don't impress you, you shouldn't be trading because they are impressive returns over a very short period of time on a very low risk, low capital exposure trade. If you are a futures trader, you are no doubt freaking out about the wide stop, probably because you are focusing on the capital exposure per contract instead of the far more important maximum capital exposure per trade. No worries. You have a solution to take advantage of the probable Wave 5 reversal on November 26. Move down to the 15-meter data for trade execution. More than likely, you will have an execution setup with much less capital exposure. Figure 7.12 is the 15-EMER data for November 26 and 27. The 60-minute momentum bullish reversal was made on the 11:30 bar, which is marked on the chart. Later in the day, a 15 meters momentum bullish reversal was made on the 15:30 bar. The TR1BH entry was made at 1422.50, 1 tick above the 1422.50 bar high, with a stop at 1411.25, 1 tick below the swing low, for an initial capital exposure per contract of just 11.25 points versus the 24.25 points on the 60-meter data. Ratcheting down to a lower time frame won't always result in lower capital exposure, but it often will if you are able to give your attention to the screen during the trading day. The short-term unit was taken off very quickly for a small profit at a minor retracement, and the stop on the long-term unit was adjusted to break even. This ensured at least a small profit if the outlook was not correct, and the S&P did not complete a 5-wave bear trend, and the rally was only a minor correction. I know, if the first unit was managed like the second unit, the net profit would have been substantially greater. But we never know in advance what the market will do. Many times a market will only make a minor correction, even though all factors point to a larger time frame trend. Always trade 2 units and take the first unit off at a minor correction target. I'm sure you will find your net results over time will be much greater with this logical 2-unit strategy for all trades. The stop on the second unit was kept at break-even until the S&P had completed 2 sections for a potential ABC correction. Only then was it advanced to the potential wave B low. The stop was then trailed very close to the market at the 60 ME per 1BL, once the 60 minute momentum was OB and price had reached the probable wave C target zone. Each trade management decision was a logical choice based on the market position as new bars were added. I wish there was a fixed formula for price targets or momentum position for an exit strategy, so we didn't have to think about how to manage a trade as it progresses. I know some trading educators claim they have discovered the secret. They haven't. Trading is like every other business. You have to make decisions based on the available information. Every market, every day provides new information. It is your job to understand and apply that information to logical decisions. A market can do just about anything. Momentum reversals aren't always made at the OB or OS zones. Price targets are not always reached. Wide range reversal bars can result in a significant price movement before a momentum reversal signal is made. Highs and lows are sometimes made outside of any typical time factors. Anything can happen, but you must make a decision based on the probable position with the information you have as of the last bar on any chart. Stock setup figure 7.13 is the daily data for OIH, the Oil Services ETF. The February 20th low was in an ideal position to complete an ABC correction. Summary: position of OIH as of February 21st. Momentum: weekly momentum is bullish. Daily momentum made a bullish reversal February 21st. Pattern: probable ABC low, which implies a continuation of the bull trend to above the December high. Price: February 20th low made at the extreme probable target for a wave C low, including the 61.8% retracement and 162 cent AP of wave A. Time: February 13 to 21s is the daily time band for low. February 20 is in the 38 to 62% time retracement zone. Trade strategy: long on the TR1BH following the February 21 daily momentum bullish reversal. Strategy for the ST unit is a wave C target at 145.59 to 146.70, which includes the 100% AP and 78.6% retracement. The general objective for the long-term unit is a continuation of the bull trend to above the December high. Specific objectives will be made if the trend progresses. OIH looks like a great setup for a long position. If we are not correct about a continuation of the bull trend to a new high, the strategy is to take off the ST unit if an ABC correction up to the probable wave C target, beginning at 145.59, is made. The short-term unit target is at the 100% alternate price projection of what is labeled the wave 1 or A range, projected from the February 20 probable wave 2 or B low. If OIH is not continuing the bull trend to a new high as anticipated, this would be the ideal target for a 3-section correction. Trade entry: a long position was executed on February 23rd at 136.93, one tick above the tier 1BH. The stop is placed at 132.0, one tick below the potential February 20 wave C of wave 2 or B low for an initial capital exposure of 4.93. Figure 7.14 adds about 10 days of data to the OIH daily chart. OIH declined and the long position was stopped out on March 5th. Trade result: both units, 4.93 loss. The initial protective sell stop was not adjusted. The weekly momentum was still bullish, although the fast line had reached the OB zone. Daily momentum made another bullish reversal on March 6th. Is this another setup for a long trade? With the new high after February 20 and sharp reversal to take out the swing low on March 5th, which stopped out the long trade, the pattern cannot be considered bullish. It definitely has the overlapping characteristics of a correction. The current pattern position knocks OIH out of the high probability setups to try another long trade. How did it turn out? About 2 weeks later, OIH broke to new highs and didn't look back for several months, continuing the bull trend to $200. The weekly momentum soon reached the OB zone but stayed there for several months, not giving another bullish reversal below the OB zone until August for another opportunity. Did we miss a major trend? No. The information did not support a high probability setup to re-enter. Weekly, daily 60 MAM setup for long trade W. DGAN said it clearly. The big money is made with the big trends. You can trade for ticks and maybe cover costs, or you can trade for points and actually grow capital. Even short-term traders must understand the higher time frame position. Figure 7.15 is EUR/USD weekly data through August 2007. The market had been in a consistent bull trend since November 2005, making higher highs and higher lows. There were no strong time factors, but pattern, price, and momentum suggested a correction was completing. The EUR/USD had reached the 78.6% retracement, with weekly momentum oversold, forming a potential ABC correction. This is a strong long setup. Figure 7.16 shows the daily chart through August 17th. The EUR/USD is in position for a wave C low. The daily momentum has made a bullish reversal. Using TR1BH here would require a very wide stop due to the large range of the bar. If this is only a correction, the expected move is toward the 61.8% retracement at 1.3657. The reward does not justify the risk on the daily time frame. Solution: move to the 60-minute chart for execution. Figure 7.117 is the 60-minute data from August 16th to August 22nd. It shows two long setups. Entry strategy, both units. Long TAR1BH following a 60-minute momentum bullish reversal. The first setup on August 20 would have resulted in a small loss. First trade, long 1.3479, stopped at 1.3458 for a 21 pip loss. 2 days later, another 60-meter bullish reversal formed. Second trade, long at 13469 with a stop at 1.34451 and 18 pip capital exposure. Figure 17 continues the chart. The EUR/USD traded above the wave 1 or A high on August 22nd. Trade management, both units. Adjust the stop to 13465, one tick below the minor swing low. If the EUR/USD is only making an ABC correction, the ideal wave C target zone is 1.3636 to 1.3656, where wave C equals 100% of wave A and aligns with a 61.8% retracement. Trade management, short-term unit. If the EUR/USD reaches 1.3636, trail the stop on the short-term unit at the 60-meter one-bar low. As of August 23rd, the daily momentum has reached the overbought zone. This implies the immediate upside should only have a day or two to go. Once a higher time frame momentum reaches the overbought zone, the lower time frame momentum usually has only one or two reversals left before the higher time frame makes a reversal. We want to keep the stop on the short-term unit relatively close to the market. A logical strategy is to adjust the stop to one tick below the swing low made prior to any smaller time frame momentum bullish reversal. That is exactly what to do with the short-term unit. Trade management for the short-term unit: adjust the stop to one tick below the low made prior to each 60-meter bullish reversal. As of the last bar on this chart, that would be 1.3544. Also, trail at the one-bar low if the EUR/USD reaches 1.3636, the beginning of the wave C target zone. The stop on the long-term unit is kept far from the current market position until the market provides a reason to adjust it. In this case, the next adjustment should not be made until the daily momentum makes another bullish reversal. That should be several days away, as the daily momentum has only now reached the overbought zone. Do not lose sight of the objective. The market information implies the EUR/USD should move to a new high above the July high at 1.3852. If recent bull sections are a guide, it could go much higher. The short-term unit is already in a position for a solid profit if stopped out. The long-term unit would still make at least a small profit if stopped out. Do not risk taking a small profit too soon when a large profit is probable. Do not lose sight of the trade objective. Figure 7.9 extends the 60-meter data through August 25th. On August 24th, the 1.3636 wave C target was reached, the trailing one-bar low exit strategy was initiated, and the short-term unit was stopped out a couple of bars later at 1.3625, one tick below the trailing one-bar low. Trade results: short-term unit, long at 1.3469. Stopped out at 1.3625 for a 156 pip profit. The short-term unit produced a substantial profit, 156 pips on an 18 pip capital exposure. Each action, from entry to stop adjustment to exit, was based on logical decisions using the information provided by the market. Remember, this was only the short-term unit, exited quickly in case the EURUSD was only making a corrective rally rather than continuing the larger bull trend. At this point, the 60-min data is no longer needed. The long-term unit will be managed using weekly and daily data. Figure 7.20 shows the daily data through September 5th, the day the daily momentum made a bullish reversal. Trade management, long-term unit. Adjust the stop to one tick below the low made prior to the daily momentum bullish reversal. The stop is now adjusted to 1.3549. Until the weekly momentum reaches the overbought zone, continue adjusting the stop to one tick below the swing low made prior to any subsequent daily momentum bullish reversals. Most new and unsuccessful traders focus on very small timeframes. They trade for ticks or pips instead of trading larger trends for meaningful moves. The objective of this trade was to capture a larger weekly daily trend that could exceed the July 2007 high. The intraday chart was only used for executing the short-term unit in case the move turned out to be just a correction. Now the focus shifts entirely to the larger time frame. Figure 7.21 shows the daily chart through Friday, September 28th, when the weekly momentum became overbought. During this period, the daily momentum made another bullish reversal, and the stop on the long-term unit was adjusted to the swing low made prior to that reversal. Once the weekly momentum reached the overbought zone, a weekly high became probable within a couple of bars. The upside should be relatively limited. Additionally, as of September 28th, the EURUSD had completed 4 sections. A potential 5-wave bull trend may be near completion, which also suggests limited upside. Note that during the same week, the weekly momentum became overbought. The daily momentum made a bearish reversal. The next daily momentum bearish reversal is likely to align closely with a weekly momentum bearish reversal. This provides a logical exit framework. Trade management, long-term unit, adjust the stop to one tick below the swing low following the next daily momentum bullish reversal. Then, following the next daily momentum bearish reversal, trail the stop one tick below the daily 1-bar low. A daily momentum bearish reversal after the higher time frame, weekly momentum reaches the overbought zone often coincides with a weekly high. The stop should be trailed very close to the market once this dual timeframe momentum position has been made for a probable larger timeframe high. Figure 7.22 extends the daily data through Tuesday, October 9th. The EURUSD made a daily bullish reversal on October 5th. The stop on the long-term unit was adjusted to 1.4030, the low made prior to the daily bullish reversal. On Tuesday, October 9th, the long-term unit was stopped out as the EURUSD traded below the 14031 swing low. Trade results, long-term unit, long at 13469. Stopped out at 1.430 for a 561 pip profit. The long-term unit had a large profit of 561 pips. The daily momentum never reached the overbought zone or made a bearish reversal before the trade was stopped out. The trade management strategy remained logical throughout, with stops adjusted based on the information provided by the market. The long-term unit trade lasted almost 6 weeks and resulted in an enormous profit. That success came from keeping the stop relatively far from the market during the early stages of the trend. Once the short-term unit was exited, there was no need to monitor intraday data. Managing the trade required only a few minutes per day. Most days required no changes. Only occasionally did the market provide new information that required adjustments to the trade management plan. It appears this was an exceptional trade, entered near the low and exited near a high, with weekly momentum overbought. But let's look at what happened afterward. Figure 723 shows the EURUSD weekly data. A weekly momentum bearish reversal occurred the same week the long-term unit was exited. The following week, the EURUSD began to rally again, and the weekly momentum did not make a bullish reversal until 3 weeks later. The EURUSD continued to rally for another 6 weeks into a high in November. We exited near the low of a correction, just before the continuation of the bull trend. Did we make a mistake? Should the position have been held longer to capture more profit? Was the October correction actually a buying opportunity? No. Based on the dual time frame momentum framework used as the primary filter, the decision was correct. The weekly momentum made a bearish reversal from the overbought zone. This typically leads to sideways or downward movement for several weeks, which is not a condition to hold long positions. Unless the weekly momentum reaches the oversold zone or makes a bullish reversal, long trades should not be considered within this framework. Never lose sight of the objective of trading, to identify conditions with a high probability outcome, not to capture every trend. That is exactly what was done in this trade. The entry was logical. The management was logical. The exit was logical. That is the best you can do. Trade only the high probability, optimum setups. These trade campaigns have taught more than just entry and exit strategies. They demonstrate how to make decisions based on momentum, pattern, price, and time as the market evolves. Each decision must be a logical response to the current market position. If you learn how to think this way, you can manage any trade in any market across any time frame. The same process applies to everything, from short-term intraday trades to longer-term position trades using daily and weekly data. You have not just seen a few after-the-fact examples. You have learned how to identify high-probability trade conditions, execute objective entry strategies, define initial risk clearly, adjust stops logically as the trade progresses. These are practical tools you can apply in real-time trading. The accompanying material provides additional examples across different markets and timeframes, presented step by step. It is designed to reinforce what you have learned here, but do not rush ahead. Finish the book first. The later material assumes you understand everything covered so far. After completing the book, you may also explore additional examples and updates available through the book's website. In the next chapter, you will study real trades from traders around the world who apply these strategies. Their examples cover multiple markets and timeframes, and will show how successful traders think and make decisions as new market information unfolds. Part 2, Trading the Plan. Chapter 8, Real Traders, Real Time. In this chapter, you will learn from real-time trade examples from a variety of traders who apply the high-probability trading strategies you have learned in this book. The strategies are applied to a variety of markets and timeframes by traders who use a logical decision-making process to manage each trade from entry to exit. I have taught the high-probability trading strategies you have learned in this book for years to traders all over the world. I asked some of my students and dynamic trader software owners if they would like to submit their own trade examples for a chapter of this book. I've included examples from several students from around the world who trade a wide variety of markets and timeframes. Some of the examples submitted included detailed commentary about the trade from entry to exit. Others were just chart screen captures with comments right on the chart. For some examples, I've included the comments just as submitted by the trader. For those examples that only included brief comments on their charts, I've expanded on the comments with the trade description. In every case, I've recaptured each chart with chart notes to make as clear as possible the market position and trade decisions made by each trader. While each trader does not have the same trade plan, there is a consistency in approach to recognizing a high probability setup and managing the trade. You will also learn that a trade management plan may be changed as a trade progresses, and as new market information appears that may change the probable position of the market from what was originally anticipated when the trade was entered. Adam Sawinski, your USD, long trade, higher time frame, daily, lower time frame, 60 meter. Adam is Polish and English is not his native language. The comments that follow are his, but I have added a few explanatory comments of my own in italics, in parentheses. I have also recreated the charts he sent and included chart comments so you can more easily follow the trade. This was an ideal ABC setup, and Adam used all of the factors taught in this book, which he learned from prior Dynamic Traders Group educational material. The EUR USD setup, major trend bullish, possible ABC correction, possible long trade. My assumption was that a corrective ABC should unfold. In my trading methodology, I trade on the hourly time frame in the direction of the higher daily time frame. I used DT oscillator momentum position to help me get into the trade. What I saw on the chart was a 3 legs down move, or a potential ABC. Wave C divided into a nice 5-wave pattern with subdivision of waves 3 and 5. I have made all necessary price projections, which give me a narrow zone of 1.4299 to 1.4308 for support. This price zone included 1.4303, 78.6% retracement of the October 22nd to November 23 rally. 1.4305, wave C equals 100% ape wave A. 1.4299, wave 5 of C equals 162% ape wave 1 of C. 1.4208, wave 5 of C equals 162% ape, wave 1 of 5 of C. The EUR-USD hit that zone on December 20th at 1 p.m. Central European Time. This low was 1 bar after the 62% ATP of wave A, not shown on the chart. The 8-daily DT oscillator was deep in the oversold zone. It was a very strong candidate for a wave C low. The trade plan. My trading plan for this setup was to trade 2 units. I would enter the trade with the 1-bar high strategy, 60-minute trailing 1BH, following the next 34-hourly DT oscillator bullish reversal. In case I am wrong, I would trail my first unit with a 1-bar low exit strategy, 60-minute trailing 1BL, at the 50% retracement of the December 18 to 20 decline, if price reaches the 50% retracement. I will adjust my stop loss for the second unit 1 tick below the low prior to each 34-hourly DT oscillator bullish reversal until stopped out. Trade management. The 2-unit long trade was triggered on December 21st at 2 a.m. CET at 1.4341 with a 35 pip stop loss at 1.4306. My minimal profit objective, the 50% retracement, was hit on December 20th at 7 a.m. I started to employ my first unit exit strategy, 60-minute trailing 1-bar low, which exited at 1.4387. From now on, I was in a small profit no matter what happens next. I stayed with my second unit, and according to my plan, my stop losses were adjusted every time the 34-hourly DT oscillator made a bullish reversal. Trade result, 292 pips profit. Unit 1, 46 pips profit. Unit 2, 2 and 46 pips profit. What I have learned. Although I could have gained more from the second unit, I followed my trading plan, which I have learned from Dynamic Trading Workshop. I am very successful with this approach, and the most important thing I have learned so far is to do your homework. Make all price and time projections and wait. I waited for this trade to the point where I had all the conditions in place. I think this is why this trade was so profitable. Trading is not an easy business. You must work hard and wait for the best opportunity. I discovered that patience and hard work is the key to success. Patience is also necessary for proper money management and not to overtrade. So in case of multiple losses in a row, you can be there for tomorrow. Robert's follow-up, Adam had the patience and discipline to wait for an ideal setup. All of the factors were in place December 20th for a potential ABC corrective low. Most important, Adam had a specific trade management plan for both units before the trade was even executed. Once the EUR-USD reached the first price target zone for a wave C low, Adam used the trailing 1-bar high entry strategy following the 60-meter momentum bullish reversal. Adam was quick to take a relatively small profit on 1 unit. Once price reached the minor 50% retracement, Adam trailed the stop at the 60-meter 1BL, taking a relatively small 46 pip profit. At this point, even if the EUR-USD did not make an ABC correction at the December 20 low and reversed to make a new low, stopping out the second unit, he would still have made a net profit of a few pips on the 2-unit trade. Adam held the second unit for the potential of a longer-term trend, which he anticipated from an ABC corrective low. A key feature of his success is he kept the stop on the second unit relatively far from the market, only adjusting the stop following a 60-meter momentum bullish reversal, a very logical strategy. Unsuccessful traders often trail the stop much too close to the market and get stopped out for a relatively small profit when they could have held for a much larger profit. The EUR-USD continued higher a few days after Adam was stopped out, but this did not concern him. He is more concerned with having the patience to wait for a high probability setup and following his trading plan than being an overactive trader and buying low tick and selling top tick. These are characteristics of an accomplished trader. Adam had a total of 296 pips profit in 6 trading days on this trade, thanks to his patience and discipline to wait for a high probability setup and trade management plan. Jagger Singh, London, United Kingdom, GBP and JPY short trades. Higher time frame, weekly, daily. Lower time frame, 60 meter. Jagir submitted 5 examples with as many as 11 chart screen captures for each example. This entire chapter could have been just his examples. The trades he submitted included big winners and small losers, with a good variety of trade situations. Jagir had traded for less than a year when he sent me these examples. He had flown from the United Kingdom to attend a live one-day workshop I offered in Denver in February 2007. He was a new trader at the time and had had some trading instruction in the United Kingdom, but didn't start trading on a regular basis until the spring of 2007, following the workshop in Denver. I think an important reason for his success is that he was new to trading and didn't have a lot of bad habits and ego to overcome when he began trading. He was the ideal student. He treated trading as a business right from the start. As you will see from the 2 examples I include here, he followed the high probability trading plan taught in this book to a T and has found great success. Jagir did not send any text commentary with his examples. All of the comments and key information were right on the charts, which makes it easy for him to keep a record of his trades. I've recaptured the relevant charts with comments and written the text commentary to describe the trade as he described it in his brief chart notes. He gave a few examples with large profits, but I've chosen to show a couple of trades with fairly small profits, where a less experienced trader may have had losses, given the market reversals made during the trades. Jagir made at least small profits on these trades by applying good trading strategies and good trade management. GBP USD short trade setup. Weekly and daily momentum overbought, possible ABC corrective high. As of September 24th, 2007, the British pound weekly momentum had turned bearish and the daily momentum was overbought. The GBP had poked above the 78.6% retracement for a possible ABC corrective high. The time band for a high was September 26th to October 1st, but the high band began on September 21st. The higher time frame weekly and daily positions were ideal for a possible ABC high and a short trade setup. Trade execution. The 60-meter chart shows the possible ABC count into the September 24 high. Jagir showed that the wave C had probably subdivided into 5 waves. Jagir's chart showed several price targets clustered around the September 24 high, including a 78.6% retracement, 100% of wave A, 162% XTRET of wave C, and more. I've only shown the 162% XTRET on the 60-minute chart to keep the chart from being cluttered. Trade management. Once the 60-minute DT oscillator made a bearish reversal, Jagir trailed a stop to go short 2 units at the 60-minute trailing 1 BL. The short position was executed at 2.0254, and the initial protective buy stop was 1 tick above the September 24 high at 2.0322. The objective to cover half of the position, 1 unit, was at the minor 50% retracement at 20200. The GBP declined sharply, hesitating for some time at the 50% retracement, where Jagir exited half of his position at 2.0217 for a small profit of 37 pips. Once the GBP reached the 61.8% retracement and the momentum was oversold, Jagir moved the stop on the second unit to 1 pip above the minor swing high at 2.023, ensuring at least a small profit on the second unit. The GBP advanced off the 61.8% retracement, made a swing high below the protective buy stop level, and then declined in what appeared to be a minor ABC. Rather than hold the short for a continued decline as originally planned, Jagir exited the second unit once it was clear it should be a minor ABC correction, which should be followed by a continued advance. The second unit was exited at 2.0172 for an 82 pip profit. It turned out to be a wise move to exit the second short unit because the GBP eventually continued much higher. Trade result: 119 pips profit. Unit 1, 37 pips. Unit 2, 82 pips. Robert's follow-up. This trade is a great example of how you can make a profit even when dead wrong about the larger time frame trend by using 2 units and making decisions based on the market position as the trend develops. With the bearish weekly and daily momentum, Jagir anticipated a short trade should have a long way to go. He correctly identified a probable ABC corrective high as of September 24th and entered a short position very close to the extreme high on the 60-meter trailing 1BL entry strategy. He took a quick but small profit on half the position at a minor retracement in the event the decline was only a minor correction and not the beginning of a bear trend. He did not adjust the stop on the second unit until the GBP had declined to the major 61.8% retracement and the 60-meter momentum was oversold. He still kept the stop fairly far from the market at a minor swing high. This is another example of how successful traders keep the stop wide on most trades and don't adjust it until there is a technical reason to do so. On September 27th, Jagir changed strategy. The GBP had made a potential minor ABC decline and traded back above the potential wave A low. A confirmed 3-wave decline implies a correction, which implies the advance should continue. Rather than hold the second unit short position, Jagir exited just after the GBP traded above the minor wave A low for another small profit of 82 pips on the second unit. As it turned out, this was a very smart move as the GBP eventually continued to advance to a new high. JPY short trade setup, possible ABC corrective high. As of September 21st, the last bar on the daily Japanese yen chart, the weekly momentum was overbought and daily momentum had made a bearish reversal for a dual time frame momentum short setup. The JPY had reached a minor 78.6% price retracement and 62% time retracement. Everything was in place for a possible irregular ABC corrective high. With a typical ABC, the wave C exceeds the extreme of the wave A. In this case, the potential wave C was below the wave A high, but with momentum, price, and time in place for a high, Jagir considered the correction could be an irregular ABC and a good short setup. Trade execution. The 60-meter chart shows the data following the September 18th possible wave C high that was shown on the daily chart. The JPY declined and made a possible minor ABC advance into the September 21st high. The high was right in the zone of the 78.6% retracement and 100% AP. The 60-meter DT oscillator made a bearish reversal for an ideal short setup. Jagir trailed a go short stop 1 pip below the 60 mem and trailing 1BL. A 2-unit short position was taken at 115.33, not far from the minor wave C high. Jagir took a 35 pip profit on 1 unit when the JPY reached the minor 50% retracement and the 60 min momentum was oversold. Trade management, second unit. As of the last 60 meters bar, the JPY declined to the September 20 low and had made what may be a minor ABC correction. Jagir adjusted the stop on the second unit to the minor swing high at 115.16 after a 60-meter momentum bearish reversal. Jagir also put in an order to add to the short position 1 tick below the minor wave B low at 114.40. The JPY was in a good position for another short trade with the daily momentum bearish and the 60-meter momentum overbought. The JPY did not decline as anticipated, but advanced sharply and stopped out the second unit for a 26 pip profit. Trade result, 61 pips profit. Unit 1, 35 pips profit. Unit 2, 26 pips profit. Robert's follow-up. This is another great example of how a profit may be made even when the market does not do what is anticipated. In this case, make a decline to a new low. Good trade management not only avoided a loss, but locked in a profit. All of the conditions of dual time frame momentum, price, time, and pattern were in place for a corrective high, followed by a decline to a new low. Jagir took profits on half the position at the minor 50% retracement, then adjusted the stop to a minor swing high on the second unit following the next 60-meter momentum bearish reversal. Even if stopped out, at least a small profit would be made on the second unit. Jagir made a good choice to add to the short position following a possible minor ABC correction. It turned out it was not a minor ABC correction, and the JPY advanced sharply, eventually to a new high. The additional short position was never executed at the minor swing low. Jagir waited for optimal conditions to enter the trade, took a small profit on half the position fairly quickly, kept his stop wide on the second half position, and adjusted the stop in a logical manner. Good lessons can be learned from Jagier's trade management in both of these examples. Van Hasselt, Breda, the Netherlands. Gold long trade, higher time frame, monthly, weekly, lower time frame, daily. Sees is a long-time dynamic trader software user and proponent of the type of trading strategies taught in this book. While I've recreated the charts Sees sent, similar charts and most comments shown for this gold trade were on his website beginning in December 2007, with periodic follow-up charts as the bull trend progressed. All of the text comments belong to Sees, with my comments in the Roberts comments and Roberts follow-up sections, as well as some in italics in parentheses within his comments. Sees did not provide specific trade strategies for his gold setup. The gold analysis was information he provided his website visitors for probable gold trend, price, and time targets. Even though this is not a specific trade with specific trade management strategies from entry to exit, I thought it would be instructive to include this example. Gold long trade setup. Breakout of a regular correction to continue the bull trend. December 13, 2007. Gold is still strong and doesn't correct very much. A break above 825.50, February 2008 futures contract, is a first possible long entry. But gold can make first a retrace to the 808-800 area, 807 to 797 continuous daily data. There is still an annoying point that silver is still not breaking out. An outbreak of silver above the first minor resistance of 1485 would give some more power to the upside on gold as well as silver. Roberts comments. The key factor is that Sees recognized that the pattern of trade off the November 8th high was probably a correction, and gold should eventually continue the bull trend. The weekly momentum not shown was oversold, but the daily momentum was overbought. So a minor correction retrace, in Sees's words, was probable before the bull trend would continue. Sees's follow-up comments. The breakout did occur on December 26. This breakout confirmed that we were in wave 3. Gold broke out of the triangle and filled the small gap of November 27. Now that we are in the trade, we are going to predict the probable time and price targets for the wave 5 high. We try to make a high probability guess where and when the top in gold will be made. Time projection for gold high. A dynamic time projection gives us two probable dates for a top, around February 18th or around March 10th, 2008. I made two time bands, a short term and an intermediate term. This gives us a time range of February 19th to March 5th for a probable high. An alternate time projection from the waves 1 and 2 lows projected from the wave 4 low gives us February 19th and March 7. We now have two time zones to watch for a high, February 18 to 27 and March 7 to 10, with possible extension to March 15th. Price projection for gold high. The price projections for a wave 5 high shown on the daily chart are 955 and finally 1005 for a February futures contract. The numbers are 946 and 997 based on the continuous contract shown in the daily chart. The longer-term monthly wave count gives a most likely high target of 1038. This would mean that we are in the final wave 5 of a longer-term wave that should end in the coming months, and that most likely we have to take our profits somewhere around the $1,000 level. We still think we are in the final phase of the gold bull trend. Roberts' follow-up Sees was right on about the breakout to a new high in his mid-December comments and chart. The maximum price targets around 997 to 1038 were both 100% alternate price projections of the range of waves 1 to 3, projected from a wave 4 low for the wave 5 of 5 shown on the daily chart and the higher time frame wave 5 shown on the monthly chart. The 100% alternate price projection of the range of waves 1 to 3 is typically the maximum target for a wave 5. This example is being included in the book in early March 2008. Gold has reached 995, the beginning of the maximum price targets Sees predicted weeks earlier. According to Sees's time projections, gold should complete a final top by mid-March. At the least, according to Sees's charts and comments, we should be in the final phase of the gold bull trend. Readers can check their gold data to see how it worked out. Additional follow-up. As I make the final proof for this chapter for the book in late May 2008, I thought it would be instructive for a final follow-up. Gold made a top March 17th at 10:38.6, continuous contract data. Seiz's latest time target to complete a major high was March 15th. The actual gold high was made March 17th, with the daily closing high made March 14th. Seize projected the maximum price target probable at 10:38. The actual high on March 17 was 1038.6. Talk about a dead center hit. Time and price target bullseye. Seize didn't use any secret strategies not taught in this book. If this doesn't convince you the strategies taught in this book will be valuable to you, close your account and get a job. Tucson, Arizona. Long S&P swing trade higher time frame. Daily. Lower time frame 60 meter. Carey has traded stocks and futures for over 10 years, beginning when he was still working as a real estate broker and investor. For several years, he has offered an intraday alert service for day and swing traders for the S&P, Euro, and 10-year note futures. Like all of the examples in this chapter, the following trade is not after the fact, but is one specifically recommended to his subscribers and updated until the trade was closed out. Carey sent a series of charts with trade strategy and trade management comments right on the chart. The critical information has been reproduced and expanded into text commentary. S&P long trade setup. Possible wave 3 low with daily momentum, oversold. As of January 22nd, 2008, the S&P was potentially at a wave 3 low, just above the 162% alternate price projection, with daily momentum oversold, a strong setup for a long trade. Notice that the wave 3 appears to have clearly subdivided into 5 waves. Entry strategy. The 60-minute data shows a probable minor ABC decline to the 78.6% retracement on January 23rd, the day after the extreme low shown on the daily chart. A 60-minute DT oscillator momentum bullish reversal was made. Carey's entry strategy was to go long one tick above the minor swing high at 13.11 with a stop one tick below the minor swing low at 12.69. This is a very wide stop for a futures trade, so Carey suggested traders might use the SPY ETF stock to limit initial capital exposure. Trade management. Carey's initial strategy was to exit one unit if the ES reached 1360, just below the 38.2% retracement, and exit the second unit at 1390, just below the 50% retracement. Stops were adjusted as the trend progressed. A 2-unit long trade was executed at 1311.25, above the minor swing high, with an initial protective stop at 12.69. This wide stop led Carey to recommend considering the SPY ETF for lower risk. The key idea: don't skip a high probability setup just because futures exposure is too large. Adapt the instrument instead. Early the next day after entry, Carey recommended trailing the stop 10 points below the recent high, locking in at least a small profit if stopped out. He also recommended exiting one unit at 1360. This level was reached near the end of the day, and one unit was exited the following day at 1360 for a 38.75 point profit. On the morning of January 25th, Carey recommended moving the stop on the second unit to 1356.25, one tick below a minor swing low. The market did not continue immediately toward the 50% retracement. The second unit was stopped out later that morning for a 45-point profit. Trade result, 83.75 points. Unit 1, 38.75 points. Unit 2, 45 points. Roberts follow-up. Carey uses 24-hour data, while some traders focus only on pit session data due to lower overnight volume and potential noise. Carey's first target was the 38.2% retracement of wave 3. Typically, the minimum expected retracement is 50%, except in a wave 4 scenario where 38.2 to 50% is common. That explains his staggered exit plan. Although the initial capital exposure was large, the stop was quickly adjusted as the market moved strongly in his favor, locking in profits early. The stop on the second unit was brought closer to the market to secure a reasonable gain if price reversed. The second unit was stopped out on the second day, resulting in a total gain of 83.75 points across both units. Unit 1 achieved approximately 3.0% unleveraged return, and Unit 2 achieved 3.4%, averaging about 3.2% for the full position. For a 2-day unleveraged trade, That is a solid out. Derek Hobbs, Warsaw soybean trade. Higher time frame, weekly. Lower time frame, daily. I first met Derek around 2002 when I lived in Tucson, Arizona, and he was visiting our mutual friend, Larry Pesavento. Derek had been a longtime dynamic trader software owner and subscriber to the DT reports. Derek later published his own trading book, Fibonacci for the Active Trader. He trades for his own account and advises on risk management and hedging strategies for farmers. The trade description and commentary are his, except for additional comments in parentheses and in the Roberts comments and Roberts follow-up sections. The setup for long soybean trade, possible ABC at price and momentum support. In addition to my own trading, I work with many farming operations to develop risk management strategies and assist with hedging decisions for their crops. My analysis is centered around dynamic trading high probability strategies. My analysis considers 5 areas: wave analysis, 2 standard deviation regression channels, Fibonacci price zones, candlestick charts, DT oscillator for momentum. In mid-April 2007, the November soybean contract was in a significant decline after a strong winter uptrend. Many farmers became concerned that the trend was over, and fear began to set in. I was receiving daily calls about taking profits before things turned worse. After running my analysis, it was clear we were likely in a classic 3-wave correction, A, B, C. I particularly favor setups where wave C lands at the bottom of an uptrending regression channel. That appeared to be the case here. A strong Fibonacci confluence zone between 760 and 730 aligned with this regression support. Roberts comments. The most probable wave C target was around 760, based on key retracements and projections. As of April 17th, weekly and daily momentum were oversold, and price was near the regression support channel, an important factor in Derek's decision process. Trade entry. I told the farmers I would not be selling at these levels. Instead, I was looking for a buying opportunity and advised holding off on hedging decisions. To confirm the setup, I waited for a DT oscillator bullish reversal. Once it occurred, I entered long, even as producers were nervously holding their positions. On April 20th, I received the signal, but price moved deeper into the Fibonacci support zone. Without the proper tools and understanding, I could have been shaken out, but I held firm, knowing the setup was still valid. Trade management. The market began to bounce as expected. Soon, the question shifted from fear to timing. When do we sell? My strategy in strong trends is simple. Take partial profits at the regression median and the rest at the top of the channel. On May 8th, after a bounce and structure formation, I moved my stop to break even. On May 30th, after a 2-day sell-off and strong reversal, I raised my stop to 823, using structural support. On June 4th, I exited half the position at the regression median line, while keeping the stop on the remaining position unchanged to allow room for continuation. From June 18 to June 22, the market pulled back sharply, nearly stopping me out. But maintaining discipline with a wider stop kept me in the trade. A strong gap up on June 29 shifted momentum again. After a 6-day consolidation, I moved my stop to 875 once price broke higher. Finally, on July 13th, price reached the top of the regression channel. I exited the remaining position immediately. Trade result Unit 1, $4,287.50 per contract. Unit 2, $9,100.50 per contract. Roberts follow-up. This is a textbook example of capturing a major trend. The key principle, big money is made in big trends. Derek kept his stop far from the market and only adjusted it based on meaningful structure, gaps, swing lows, and consolidations. This is what market structure means, letting price action dictate decisions, not emotions. Part of his plan was fixed, taking profits at the regression median and channel extremes. But the rest was adaptive, based on how the market evolved. He was also clear that this was an ideal trade. In choppy markets, the same approach often leads to small profits or small losses, but that consistency is what allows traders to stay in the big winning trends when they appear. The same principles apply across all time frames, even intraday. Carolyn Burrottstuff, Arizona, ES, S&P Mini, short trade, higher time frame, 15 meters, lower time frame, 3 meters. Carolyn is a longtime friend who has her own intraday trade and chat room at www.fibonacciqueen.com and is the author of Fibonacci Trading. She has worked in the trading industry her entire adult life, starting as a phone clerk on the Chicago Mercantile Exchange as a teenager, and including a short stint working for me in Tucson, AZ in the early 90s. She focuses on index futures markets and very short-term day trades, where a 15-meter chart is long-term. Carolyn sent me a few charts of intraday trades for the day I contacted her. Her text description was brief, so I've recaptured the charts and added the text description that follows for the ES short trade for March 10th, 2008. The setup for a short trade figure 8.23 is a 3-minute chart of ES for Friday, March 7th through the morning of Monday, March 10th. The ES had reached a major resistance area for a possible ABC high. Carolyn calls this a two-step pattern setup. The resistance area included 3 minor 100% APAPs, the 127% XTRET of the wave B, the 50% retracement from the March 7 high, and the 78.6% retracement from the March 10 early morning high. Carolyn calls these symmetry setups when several 100% alternate price projections make a very narrow range zone. Carolyn generally uses two types of entry triggers. One is a decline below a minor swing low, or a trailing 1-bar low, as you've learned in this book. Another is to enter on a commodity channel index indicator setup. In this case, when the 3M14's CCI crosses below the zero line. Carolyn uses the CCI indicator a great deal for entry and exit conditions. I have not described the CCI indicator in this book, but it is a common indicator, and lots of information about it is available online or in other trading materials. Carolyn describes her CCI setups and triggers in detail in her book, Fibonacci Trading: How to Master the Time and Price Advantage. Trade execution and exit strategy figure 824 adds several more 3M bars of data through the trade entry. The 1291.75 1-bar low was taken out to execute the short trade with a stop at 1294.50, one tick above the recent high. The ES later advanced to trade at the 1294.25 swing high, but did not reach the stop, and later declined. The 3M CCI 14 soon crossed the zero line for the alternate entry 2 ticks below the 1291.15 CC, trailing 1-bar low entry. Figure 8.25 shows the data through the trade exit. The ES almost immediately declined sharply and reached the 100% alternate price projection about an hour later. The exit buy stop was placed 1 tick above the 1-bar high at 1281.75 and stopped out on the next bar. The alternate exit was when the 3M CCI 14 crossed above the zero line a few bars later. Trade result: no multiple unit exits, 10 points or $500 per contract. Any market, any time frame. Carolyn did not provide a strategy for multiple unit exits with her example. She also admitted that not all of her intraday trades are in a 10-point profit position in less than an hour. However, you do often get fast moves once an intraday corrective high or low is complete, especially on the short side. Carolyn relies mostly on time and price targets to identify highs and lows for entry and exit setups, with the CCI often the trigger to execute the trade. It is important to note that the general trade plan is the same whether trading a larger time frame weekly daily data or very short-term day trades like this example. Jamie Johnson, Encinitas, California, and Bogota, Colombia. Short trade. Higher time frame, daily. Lower time frame, 60 meters. Jamie Johnson splits his time between Bogota, Colombia, and Encinitas, California. He has been trading for about 8 years. The past few years, his trading has focused on Forex swing trades. He is well grounded in the high probability trade strategies taught in this book, as he is also the chief technical analyst for our DT reports. Jamie rarely looks at a time frame less than 60 minutes for his Forex trades. Jamie has also produced a comprehensive Forex trading course called No BS Forex Trading, available from Dynamic Traders Group. The trade description is Jamie's, with my comments in parentheses italics and in the Roberts follow-up section. The setup. Higher time frame daily trend bearish, short trade on 60-minute bearish momentum reversal. The higher degree time frame, 13, daily DTOSC momentum was bearish, and the January 22nd high was in the position to be a multi-day corrective high. The January 22 low was in the position to be a minor wave 1 or A low, and the January 23 high was in the position to be a minor wave 2 or B high. In either case, at least a short-term decline for a day or two was likely. Following the 34 60-minute DTOSC bearish reversal, I entered a 2-unit short position at 1.0233 on January 24th. The protective buy stop was placed at the pip spread plus 5 pips above the January 23 wave 2 or B high at 1.0328. When the 100% AP of the January 22 wave 1 or A climb was reached, 1.0145, the typical wave C price target, I trailed the protective buy stop for one of the short units 10 pips above the market. I also adjusted the protective buy stop for the second unit to break even. The first unit was stopped out at 1.0119 for a profit. First unit trade result, 114 pip profit. Second unit trade management. As the USD CAD continued to decline, the pattern had more impulsive trend characteristics than corrective. More than likely, the decline was not just an ABC correction, but a bear trend that typically has at least 5 sections. Once the January 24th wave 3 low was taken out, the protective buy stop for the remaining short unit was adjusted to a few pips above the January 28 wave 4 high. Loss adjustment. Once wave 5 appeared to be subdividing in a 5-wave pattern, the protective buy stop continued to be adjusted to a few pips above a minor swing high. Once the January 30 low was in the pattern position to be a wave 5 part 5, wave 5 of 5, low, and the higher degree, 13, daily DTOSC was bear OS, I adjusted the protective buy stop to a few pips above the 0.9972 prior minor swing high, and the second short unit was eventually stopped out at 0.9980 for a 245 pip profit. Trade result, 359 pips profit. Unit 1, 114 pips profit. Unit 2, 245 pips profit. Roberts follow-up. The first chart in this example labeled the first 2 swings off the January 22 high as a wave 1 or A and wave 2 or B. Jamie did not have an opinion if the CAD USD was making an ABC or other type of correction or beginning a bear trend. In either case, the setup was for a probable continued decline to complete a wave C or a wave 3. Jamie took profit quickly on one unit just after the market reached the 100% alternate price projection. If the CAD USD was only making an ABC or other type of correction, this would be a typical price target. The stop on the second unit was also moved to break even when the short-term unit was stopped out. Even if the market reversed up sharply, at least a small profit would be secure for the 2-unit trade. The CAD USD continued sharply lower and didn't make a short-term low until reaching the 162% alternate price projection, which is a typical wave 3 target. The daily momentum was still bearish and not OS, so more than likely the trend would continue lower. Jamie did not adjust the stop closer to the market until the January 22 potential wave 3 low was taken out. This is another example of the difference between experienced and inexperienced traders. The stop loss was kept relatively far from the market activity until there was a logical technical reason to adjust the stop. As the CAD USD continued to decline from the January 28th probable wave 4 high, Jamie then adjusted the stop loss more frequently to just above each minor swing high. On January 30th, the CAD USD reached a major retracement, 78.6%, and minor wave 5 price target, plus the higher timeframe daily momentum was oversold. The CAD USD was in a position to complete a 5-wave trend, and Jamie then trailed the protective buy stop on the second short unit closer to the market. The trade was stopped out on January 31st for a 245 pip profit on the second unit. Each trade management action was taken as a logical consequence to the price, pattern, and momentum position of the market as it unfolded. During this period, the CAD USD appeared to be making textbook E-wave structures, which were helpful to identify the trend position. This is not always the case and is not necessary to make trading decisions, but it is helpful to recognize the probable pattern position if one is being made. Chapter summary. In this chapter, you've seen trades from a variety of markets and timeframes by traders from around the world who have learned the high probability trading strategies taught in this book. The traders varied from relatively new to those with years of experience. Some of the traders used technical indicators not described in this book. Each had a bit different trade plan. But all of the trade management strategies were based on a logical application of the strategies taught in this book. Many other trade examples were submitted that unfortunately could not be included because of space limitations. Check the website periodically for more student and current trade examples for ongoing trading education. Chapter 9. The Business of Trading and Other Matters. Trading is a business like any other business. To be successful at any business or profession takes knowledge and experience. Like every other business, traders must have a plan of how they will use information to make decisions and manage their business. Trading is no different than any other business. I'm always amazed and frustrated that so many new traders who have taken the time to master and become successful at another business or profession think that trading is different. They throw out all the rules of success and believe they can quickly and easily learn to trade, and it will be the path to riches. Trading takes time to learn and master like any other business. You must gain the knowledge and experience, develop a trading plan, test, evaluate, and review to constantly improve, just like any other business. The beauty of trading is you can gain the knowledge and experience without much capital risk. You have the opportunity to trade unleveraged markets with a small account and small risk as you learn to trade. Few other businesses offer this opportunity. Give yourself the opportunity for success. Treat trading like any other business. How much time you have to spend each day for your trading business depends on your trading time frame and how many markets you consider trading. If you are a day trader, you may be sitting in front of the monitors 5 or 6 hours a day, making quick decisions. If you're a swing trader, doing trades that typically last a few days, making decisions based on intraday data, you should only have your attention on the markets once they meet the minimal conditions for a trade. You may only have to put in an hour or two a day in front of the monitor. If you're a position trader making decisions based on monthly, weekly, and daily data, you should only have to spend 30 minutes or so each evening scanning the data and charts for potential setups. Or a bit more time if you are a stock/ETF trader and following a lot of markets. Whatever time frame you trade, the routine is the same. The day begins with a list of markets that are at or near the initial trade conditions. Once the initial conditions are met, entry orders are placed. If a trade is executed and you're not stopped out at the initial stop, the trade is monitored according to your trade plan, and stop-loss decisions are made as the trade progresses. The routine is the same regardless of whether you are day trading off 15 and 5-minute bars or position trading off weekly and daily bars. A very important key routine, even if you are a day trader, is to do most of your analysis and preliminary decision-making outside of market hours. There are few decisions that a swing or position trader makes on a daily basis for any one market because there is not that much new information each day for trades lasting a few days to a few weeks. But even day traders should start the day with a plan by identifying which markets have the best potential for trade setups that day. Every consistently successful trader keeps records of all trades with at least brief notes of why the trade was considered, how it was executed, and the trade management plan. The record keeping may be as brief or as detailed as suits you, but you must track your trade activities. The monthly brokerage statement of trades is not enough. This statement only lists trades, but doesn't provide any information about why and how you got in and out. I used to keep a very detailed journal with a form I made up in Excel to list all the details of the market conditions for considering the trade, the entry strategy, and how the trade was managed, including notes on every stop-loss adjustment. Each form included a copy of the chart when the trade was entered and at least one additional chart with data through the trade exit. This journal has evolved to a simpler format, partly because my trade plan and the information I need to make a trading decision has become much simpler over the years. My trade plan has evolved from very detailed and complex Gann, Elliott, chart geometry, time, and price strategies to much more simple strategies as outlined in this book. Today, I make notes right on the chart and print a copy when a trade is made. I may make additional handwritten notes right on the chart printout. If I'm not stopped out at the initial protective stop, I may make another 1 or 2 chart prints as the trade progresses to note significant decision-making periods. I put the charts with notes in a 3-ring binder and have a complete log to review each trade. It is fast and easy to record trades this way. Fast and easy means it will get done, and all of the relevant information is recorded. Detailed and complex means it probably won't get done on a regular basis. I strongly suggest you develop a trade recording process that suits your temperament. By that, I mean one that you will do in a timely manner on a consistent basis that includes all the relevant information needed to review the trade at a later date. If you are a very short-term day or swing trader, you may need only a single chart with appropriate notes that you print when the trade is complete. Your trading software should have the ability to make notes right on the chart or have a drop-down note function. All you have to do is hit the print button when the trade is made, maybe make a few quick notes on the printed chart, and at the end of the day, you have a complete trade record. There are some software programs available for trade record keeping. You might check them out to see if they are suitable for you. I've found that printing a chart with notes right on the chart printout is suitable for me, but you may want an even more organized and detailed record that a trade record software may provide. You should periodically review your trading activity. This is simply good, successful business practice. A short-term trader will review at least once a week. A swinger position trader may only make a comprehensive review once a month. Whatever method you devise to track and record your trades, you should be able at a later time, even years later, to pull up the information and know why and how the trade was entered and the trade management strategy from entry to exit for all of the trades. One of the key differences between a successful and unsuccessful trader is that every successful trader has a trade record-keeping system to track and record trades with comments, and most unsuccessful traders do not. You don't have a choice in this matter. Record, review, and evaluate. Good trade record keeping does not ensure success, but I believe a lack of it does ensure failure. If you want to have the chance of being successful, keep good records. All consistently successful traders have a trade record keeping system with enough information to review a trade from entry to exit at any time. Why traders win or lose? I believe there is one primary reason traders are not successful. They lack a trade plan. All consistently successful traders have a written trade plan. Most unsuccessful traders do not have a written trade plan. A trade plan does not guarantee success, but lack of one guarantees failure. A trade plan outlines the process and information needed to make a decision. Without a trade plan, decisions are not made on a consistent basis, based on a consistent approach to act on relevant information. A trade plan does not have to be a long list of detailed rules that each market must abide by before a trade is placed. But your trade plan should include at least the minimum conditions that must be met before a trade is considered, objective entry strategies, and narrow guidelines as to how the trade will be managed through trade exit. Throughout this book, you have learned all of these factors to develop a trade plan. You have learned that dual timeframe momentum setups are one way to identify the minimum conditions to consider a trade. You have learned specific objective entry strategies once the minimum conditions to consider a trade have been met. You have learned how to identify time, price, pattern, and momentum conditions to adjust stops to manage the trade through the exit. As a trade progresses, you will have to make decisions, but the decisions should be made in the context of the market position, not some arbitrary fear or greed factor that is not related to the original reasons the trade was made. Some readers will be asking, why don't you just give us a trade plan? There are a couple of reasons. First, you probably wouldn't follow it. You would second guess the objective rules and make unwarranted assumptions when decisions needed to be made. It is very difficult to follow someone else's plan. A few years ago, I trained for and participated in several adventure races over a 2-year period. The adventure races were mostly nonstop 24 hours and included mountain biking, trail hiking/running, kayaking, rappelling, and land navigation. They were brutal. I read several books on endurance training and understood the key training principles. I hired an endurance trainer over several months to make a training plan for each day to work on developing my biking and running endurance. Each weekend, I received an email with the next week's training plan. Did I follow the plan exactly every day? No. The plan was a good guideline of what to work on, but many days I varied the plan to suit my current condition. The training plan kept me focused. I worked within the principles of the plan, but some days made variations depending on how I felt that day. The trainer's plan was a key to improving my performance, but I think I progressed more, or at least kept more motivated and interested in the training by making some changes. In other words, I used the trainer's plan as a guide to develop my own plan. It is very difficult to follow another person's plan. Second, you may want to begin with a more rigid and objective plan than a plan I would suggest. A more objective plan may result in fewer setups that meet your more objective rules and guidelines, but may also result in a higher rate of successful trades. This is usually the trade-off with more rules. Fewer trades are entered, but often the fewer number of trades have a higher rate of success. As you gain more experience, you may broaden the rules and guidelines to allow you to apply your added knowledge to the decision-making process. Prior chapters have given you all the information you need to develop a trade plan and make decisions when necessary. Let's review the major elements of every trade plan to guide you to making your own specific plan. Key trade plan elements. 1. Objective minimum trade setup conditions. What are the objective minimum conditions that must be met to consider a trade? I believe the dual timeframe momentum setups you learned in this book are the best objective conditions to identify potential trades that should be a part of your trade plan. The key is that the dual timeframe setups are logical and objective. They work. The dual timeframe momentum conditions are the best trade filter I've discovered in over 20 years. 2. Non-objective setup conditions. Pattern, price, and time position should be considered for a trade setup. These can be objective or subjective conditions. Have the minimum pattern conditions been made to imply that a correction or trend could be complete? Has the market reached a typical price and/or time target for a correction or trend reversal to be made? There are decisions to be made, but the decisions are within very narrow guidelines, as you have learned in previous chapters. Number 3, objective entry strategy. I have a very firm belief that once the conditions for a trade setup have been made, the entry strategy should be objective. In other words, there are no more decisions to be made as to how and at what price to execute the trade and place the initial protective stop. You have learned 2 objective entry strategies in this book: the momentum reversal and the swing breakout. They are all you need. 4, trade management exit strategy. How are you going to manage the trade through the exit? Here is where most of your trade decisions will be made. You could make this part of your plan highly objective, such as trail the stop on one unit at the trailing 1B LH following the first smaller time frame momentum reversal against the larger time frame trend. Or trail the stop on one unit if the market reaches the 100% alternate price projection. These would be objective exit strategies that will serve you well. However, to maximize your knowledge and experience, you should consider the price, time, and pattern position as part of your trade management strategy. This is where decisions will have to be made depending on specific conditions as a market progresses. You have learned from the trade examples in prior chapters, including those of the traders featured in Chapter 8, that the trade management plan may change as a trend progresses and a market provides new information. A very important part of trade management is to always trade at least 2 units, exiting 1 unit on short-term conditions and holding a second unit for higher time frame conditions. Consider an objective exit strategy for the short-term unit and a strategy based on decisions made according to the market position as the trade progresses for the larger time frame unit. These are the 4 elements to any trade plan. In the trade examples in previous chapters, you have learned all you need to know to develop your own trade plan and make decisions based on these 4 elements. The CD examples will demonstrate more trades from entry to exit based on a trade plan following these 4 principles. Don't be fooled into believing that you can buy success, that you can follow another person's trade plan step by step, or buy a trade system and be successful. You will only be successful if you gain the knowledge and experience and develop your own trade plan that includes these 4 elements just described. Every successful trader has a written trade plan. Most unsuccessful traders do not. Technology, trading timeframes, markets to trade, and leverage. What time frame has the best potential for trading profits? Which markets are the best to trade? The trend in the past 10 years or so is for shorter term trading, particularly day trading with high leverage. Not many years ago, the trading time frame for most traders, including highly leveraged futures traders, was from a few days to a few weeks or months. Today, we would call that swing or position trading. Until at least the early 1990s, real-time data was very expensive. Commissions were relatively high, computers were expensive, and there were very few real-time trading software programs available. All that changed rapidly by the mid-1990s. When I began trading in the early 1980s, very few traders had software charting programs. Most of us made our charts on grid paper that we bought from blueprint shops, or updated a charting service booklet of markets that we received each week or 2 by mail. I also remember sitting at the brokerage office and making 15-minute charts each day by updating my intraday chart booklet every 15 minutes. Trades were not placed with an online trading platform with instant fills. We called the broker with the order, the broker called his representative, the order eventually got filled, and we got a call back with the fill price. The fill price was often a few ticks away from the market at the time of the trade decision due to the lag between dialing the broker and the order being filled. We got all of this great service for as much as $100 per futures contract. We now have very inexpensive real-time data with 1-minute charts, if we like, with all kinds of choices of fabulous trading software and instant order execution for about $3 a trade for a futures contract and a penny a share for stocks. We can make dozens of trades a day if we want. We can leverage up to 100 to 1 with some Forex accounts. How times have changed with the wondrous technology advancements. Are a higher percentage of traders successful today than in the pre-online trading days? Probably not. I suspect even a lower percentage are successful than in the old hand charting days. You are probably aware of the statistics that 70% or more, by some accounts, it's closer to 90% plus, of traders lose most or all of their trading capital within months. I don't have any hard statistics, but after more than 20 years of teaching trading and talking with brokers, that percentage has probably not gotten any better in recent years. I've talked with brokers who, confidentially, say more than 95% of their accounts lose money and are closed out within 6 months. The new technology, software, and real-time data services have not resulted in more successful traders. The new technology only provides more information faster. Traders must still learn how to use that information to make decisions. Leverage has both very positive and very negative ramifications. If you're on the right side of the market, leverage will multiply profits greatly. If you're on the wrong side of the market, it can clean you out very quickly. For every yin, there is a yang. Read this very carefully. If you can't make money with unleveraged trades, you'll never make money with leveraged trades. If you are not a consistently profitable trader in your leveraged futures, Forex, or stock account, why not learn to trade with unleveraged markets where the cost to gain the experience and to develop a trading plan should be very minimal? There are ETFs and mutual funds that track most of the major financial markets, including all the major stock indexes, bonds, gold and currencies, and even some commodities. You can take small positions as you gain experience and develop a trading plan. Once you develop a plan and gain experience and become profitable with the unleveraged trades, you can then apply your knowledge, experience, and trading plan to leveraged futures, Forex, and margin stocks. You don't have to have a large account or take large risks to learn how to trade and develop a trading plan. It's true, you are not going to make a lot of money with a small account and unleveraged trades. You are also not going to lose a lot as you learn. The learning process can be costly with leveraged trades. Until you have developed a consistently successful trading plan that is profitable on a regular basis, your objective is not to make money, but to learn to trade. That may sound odd, saying that your objective is not to make money, but that's the way it is. Once you have learned to trade, the money follows. There is absolutely no reason to take big risks until you have learned to trade successfully. Are you interested in trading futures stock indexes like the ES-mini S&P mini futures contract? Trade the SPY ETF until you are consistently profitable and then move on to the leveraged futures contract. Want to trade Forex? Forget 100-to-1 leverage until you have learned how to trade. Most of the major currency pairs have an ETF you can trade until you have learned how to trade successfully. If you can't make money trading unleveraged, you will never make money trading leveraged. It is that simple. This is a clear distinction between someone who is serious about learning how to trade and someone who thinks trading is a get-rich-quick activity. I realize that day trading has become very appealing in recent years with all the new inexpensive technology. Get in and out quickly. Take your profit or loss quickly. Don't hold a position overnight. Minimize your exposure. It sounds enticing, but I believe the odds of being successful are stacked much higher against the day trader than the swing or position trader, at least until you have learned to trade. Something alters your discipline, beliefs, organization, and decision-making ability when you are watching a screen all day with the intraday bars building tick by tick. It is extremely difficult to remain disciplined, stick to a trading plan, and make logical, sound decisions with very short-term day trades. I strongly encourage traders who are interested in day trading to first develop a trading plan and experience with swing and position trading, preferably with unleveraged trades, before attempting to day trade. If you can't make money with unleveraged intermediate-term trades using weekly and daily data, you are going to get cleaned out fast, making short-term trades with highly leveraged markets. Trade for points, not for ticks. One of the big drawbacks to day trading is the profit potential is limited. Day traders trade for ticks, not for points. There is only so much movement in one day, which means there is only so much profit potential. To make enough money to cover your trading expenses, software, data, education, etc., by day trading, you have to trade size. It is hardly worth your time and expense day trading just 2 or 3 futures contracts, even if you have a very high win rate. I believe day trading provides the least return for your time and investment of any time frame of trading. At the least, even if you are a successful day trader, also consider longer-term positions that last from a few days to a few weeks to capture the longer-term trends with a potential for greater rewards. Put your knowledge and experience to work for greater profit potential. W.D. Gann taught, the big money is made in the big trends. New traders should consider this truth carefully. Trade for points, not for ticks. You can't buy success. Sometimes I'm almost ashamed to be associated with the business of educating traders and developing trading software because the business is rife with outright scammers, making promises and insinuating you can quickly and easily learn to get rich fast trading. You've seen the ads. Learn the secrets of Wall Street or the professional traders and make a killing. You've seen the charts in ads with the little buy and sell arrows where every trade is a big profit, or the ads that claim hundreds of % return if only you follow their system or subscribe to their advisory report, or the trading software, usually very expensive, that will supposedly give you the buy and sell signals for consistently profitable results. If you subscribe to any trading publication or surf some of the trading sites on the web, I know you've seen a lot of these outlandish promises. You've probably taken the bait on a few of them and spent a lot of money with little or no results. You're not the only one. I've been a sucker myself, especially in the early years. I guess it's part of the learning process we all go through when we're learning something new, and actually think there are some secrets we can quickly learn to put us on the road to riches. Beware of any promoter making unrealistic claims. It's just common sense, which unfortunately our fear and greed drives out of our consciousness now and then. There are a lot of good trading educators. Some have been around for years and have a lot of experience trading and teaching traders. The legitimate trading educators never make unrealistic claims. In fact, I don't believe I've ever seen an ad or promotion by a legitimate trading educator that make a results-based claim. They know the best they can do is teach you whatever they have become good at. How and if you apply the knowledge is up to you. The more knowledge and experience you gain, the quicker you will be able to discern what should be legitimate and useful information, as opposed to having your chain pulled. I've said it several times throughout this book, and I'll say it again, just to be sure you get the point. You can't buy success. You've got to earn it through education and experience. You can be a successful trader. You know the odds are stacked against you being a successful trader. You've read the statistics from many sources about how a very high percentage of traders drop out or go bust after just a few months. But you do not have to be one of them. If you apply yourself to learn to trade, you can be successful. Go about it in a business-like manner. Study, evaluate, review, develop a trading plan, and gain experience. Don't make the mistake of most new traders and overtrade with too large a risk for your account size. Consider trading unleveraged markets until you've developed a trading plan and tested it out in real time. While I can't make any promises or guarantees, if you apply the strategies you've learned in this book, I believe you will have great success. If you are already an experienced, successful trader, incorporate the strategies taught in this book into your trading plan, and your results should improve, maybe dramatically. Visit www.highprobabilitytradingstrategies.com for free updated trade examples and to learn more about the trade strategies taught in this book. Best wishes and successful trading, Robert Miner.